seems to be in fine momentum and it's been looking quite good as well. So that will continue to lead the way. But today, you could get some kind of support coming in for tech because HCL Tech's numbers were very, very good. If you look at the revenue growth, the margins, the deal wins, as well as, their talk with regard to reporting AI revenue separately. So that one could fuel up a bit of a rally in the IT stocks, or at least, unlike yesterday, we won't see that kind of a fall on tech, which underperformed yesterday. So that's one stock that I'm looking at. The other two names that I'm looking at is MCX. I was looking at the premium. The average premium on Friday itself was much higher than the Q2 average, which was as much higher than the Q1 average. So those premiums that they're reporting actually on a day-to-day basis is much higher than what the street is working with. So that's what could help MCX. BSE, because obviously it appears now that the fear with regard to the weekly options is gradually receding. So both those two exchanges continue to remain on the radar. And the big listing, LG list today, expected to be a blockbuster one. So I'll keep an eye out on this stock. You have a couple of initiating coverage reports on the day of its listing. So that one should have a blockbuster listing, later today.
Indeed. So Sensex weekly expiry today, the LG Electronics IPO opening, and on the earnings front, keep your eye on Tech Mahindra, Persistent, ICICI Lombard, ICICI Prudential, IREDA, Cyient, DLM, and Bank of Maharashtra. These will be the big earnings for the day. But let's get to Matt Orton, the Chief Market Strategist at Raymond James Investment. Matt, thank you very much for joining in. The Wall Street action yesterday, a solid rebound after Friday's rout. We managed to claw back 50-60% of Friday's losses. Was the Friday sell-off a weakness? Or, are you getting a sense that markets are now nervous? I mean, what's the call now on Wall Street after the kind of rally that we've seen with the tariff threat still looming?
Hey, good morning, Rima. It's always great to join. And I think the price action today, or I guess yesterday, was definitely encouraging. What we saw on Friday, I think, was an excuse for the market to sell off and consolidate a little bit. If you can believe it, it was the first day in 34 trading sessions where the S&P 500 had more than a 1% move in either direction. So we've been in a very, very low volatile environment. And there's been a lot of gains for the market in the absence of any sort of economic data or information that could disrupt the rally, and I'll call it the visibility into the strength of the AI trade. So I think Friday was just a reason for some profit taking, and the fact that we were able to see strength through that with respect that we're not going to be in a tit-for-tat trade war again with China is definitely encouraging. So I spent the past week in Europe meeting with clients. The mood, I think, is still fairly pessimistic, or I would say one of reticence, of hesitation with respect to the market being at all-time highs. And I always encourage our clients, like we've talked about in the past, come back to the fundamentals. The corporate earnings picture in the US in particular looks very, very strong. There's a lot of good developments for long-term, durable, secular growth themes, and that's what you want to lean into as an investor. So I think hopefully this market can continue to move higher.
Matt, you like a lot of these consumer tech companies back home in India. I remember in the past you talking about Swiggy, the quick commerce plays largely. You've got another one listing today, LG Electronics, not exactly a platform play, but in the consumer electronics, and valuations are attractive, 30 times forward multiple at issue price. So if we do get a gap up as expected, say 30-40% higher, would you look to buy it, or do you think then it would be a fair value? And tell us some of the recent trades, investments that you've made in India.
Yeah, absolutely. So I have a rule where if I don't get a piece of the IPO action, I do not trade it on the first day. I like to wait to see how things actually settle out. But to your point, Rima, the LG IPO is exciting, and it's exciting for really three key reasons. Number one is just the fact that we're bringing a company that operates in a higher quality consumer part of the market, and it's driven by a strong investor enthusiasm. And I think two is here's a company that's able to play into this premiumization trend. It's one of the key reasons why I've liked Mahindra and Mahindra for such a long time. It's playing into this concept of a burgeoning middle class and the ability to push premium products. And I think thirdly is by employing that type of strategy, you get better margins, and margins lead to better free cash flow and profitability. And so that's what I like across a number of companies. So Swiggy, I can't wait to see what earnings are going to play out. Eternal's been another quick commerce name that I've liked a lot. And so I'm looking forward to hopefully seeing a continued trend with respect to monetization stabilization of the investments that these companies have been making. And I think a lot of the data I see from, say, a Paytm is certainly encouraging of just where the Indian consumer is. So we're certainly starting on a good foot with respect to tech. It's not a disaster like it has been in the past. And so I'm hopeful that we can start to see stabilization to earnings in India, which I think will attract the attention of more foreign investors.
All right. Hi, Matt. Good morning. Good to see you, Ben. You've spoken about banking names, ICICI Bank. In the past, you've liked Affle as well, and a couple of other notable ones, I think Mahindra & Mahindra as well as Interglobe. How are you positioned on tech, though? You know, TCS's numbers weren't that bad. I mean, and HCL Tech is obviously a better set of numbers. On tech, how are you positioned right now? Would you gradually start turning constructive, or do you believe there's still too much uncertainty? You'd rather stay away from there?
Yeah, it's a great question, Nigel, and I ask myself that every day. I'd like to see more of the earnings come in. So I'd say what we've seen so far, one data point does not make a trend across the industry. And so I'd like to see more strength with respect to the ability of these companies to drive artificial intelligence revenues. I think that's going to be very, very important. I'd like to see stabilization with respect to their overseas businesses, in particular Infosys. I'd like to see stabilization with respect to their European business and their financial and asset management businesses. That's going to be important. So if we can see earnings not getting worse and better visibility and more upbeat commentary from management teams, I think that would be a signal to me as an investor to say, hey, maybe it makes sense to put a little bit more dollars to work in these companies, and then I can push that position over time if I continue to see momentum build in those names and other good sets of numbers, say at the start of next year in 2026 when we get Q4 data.
Okay. Any other investments, recent purchases in India?
So I haven't done anything else outside of last week when we had a conversation about, adding some more exposure into Swiggy and adding a position in Apple 3i. I think heading into earnings season, I want to be very conscious of the volatility that there could be, and I want to see results. Again, it's okay to be early, but I much prefer to see a strong story play out where I can add, and I have very high quality positions. I've added a little bit back to my position in ICICI Bank. That looks like it's gaining a little bit more momentum. So if we can see financials in particular start to strengthen, I think that'll also be a good signal for India as a whole that it makes sense to maybe rotate some of the dollars I tactically moved into China back into India to re-up my positions.
Matt, always a good conversation. Thank you very much for joining us here on CNBC TV 18.
Thank you.
Okay, well, let's just quickly run you through what's lined up here over the next 2 hours or so. So coming up at 8:35, we have the management of KEC International. So we talk about the new order wins at KEC. Vimal Kejriwal will be with us. 9 a.m., we'll have Sumit Gupta of Centrum to talk about expectations from the hospital space. Was the big outperformer last week. 9:20, Nimesh Chandan of Bajaj Finserv AMC will talk markets with us. 9:35, Raj Ratan Global Wire and Bellrise Industries join in to talk about demand trends in the auto component space post the GST cuts. Following that, K. Suresh of Association of National Exchanges members of India and Rajesh Baheti of Trustees Capital Services on our exclusive story from yesterday. Sources basically reporting, saying that SEBI, the bar for SEBI to touch weekly options is high. They're going to do a lot of other things before we get to that. Towards the end of the program, it's our special Diwali segment. Lata speaks with Devina Mehra, First Global, on how Dalal Street will navigate Samvat 2082. Okay, time for a quick commercial break. Our list of top stocks to watch with our research team lined up next. Stay with us. Welcome back. Our research team is standing by with CNBC TV 18's list of top stocks for the day. Well, I think we're going to start with HCL Tech, which came out with numbers yesterday, and numbers were a beat. Rima, tell us more.
Indeed. So HCL Tech beat on revenues, margins and deal wins. The company's top line has gone up by 2.4% quarter on quarter, ahead of estimates. And after 2 quarters of decline, in the current quarter, we are seeing very strong growth. Margins have also expanded by 110 basis points sequentially to 17.4%. Again, better than street expectations. And deal wins were up 42% to $2.5 billion. But here, remember in the prior quarter, the company said the 2 large deal wins got deferred. So that's showing up in Q2. But in the press conference, the encouraging sign was the company said that Q3 deal wins will be strong. So in a nutshell, revenue, margins, deal wins, all strong. The overall revenue guidance has remained unchanged at 3 to 5%. But in the services business, which is a majority of the company, business, the company has tightened the revenue band. So 3 to 5% has now become 4 to 5%. Margin guidance remains unchanged. What's also, a little encouraging is the company has now, quantified the AI revenue. Advanced AI revenue in the current quarter is at $100 million. And HCL Tech becomes the first Indian company to actually give out an AI revenue. So just the fact that AI revenue has now moved from pilots to projects, or it's mature enough to warrant a separate reporting line, will be read well by the street. And let's see whether it's the start of more disclosures from the rest of the IT companies.
Absolutely, Rima. That could be one of the stocks of the day. So good news with regard to HCL Tech. But let's hop across to Lodha. The CPI data was good. And what's the impact on banks as well as NBFCs? Lodha?
Well, the headline CPI for September has come in at 1.54%. And that makes it a 100-month low or something. It's an 8-year low. The important point is the month before was 2%, the month before was 1.6. So if you take the July, August, September average, it works to 1.7. Now, the Reserve Bank had just lowered its forecast to 1.8 from some 2.7. So even much below their aggressively lowered forecast, you are seeing an CPI undershoot. The good news or whatever, the news on CPI doesn't stop there. The October CPI now is expected to be 0.5%, 0.5 or 0.6%. That's the CNBC TV 18 poll indication. So you imagine a Reserve Bank MPC going into the conference on December 6th. They have with them 2 readings, which is below their mandate. The mandate is 4% plus or minus 2%, which is inflation has to be between 2 and 6. You're going with actually 3 out of the last 4 months below your mandated range. So chances are it is extremely tough for the Reserve Bank to avoid a rate cut. Even the forward-looking CPI numbers, which they normally allude to, have to be brought down considering the undershoot. And therefore, the market is penciling in a rate cut in December. What this will mean, of course, is more pressure on the margins of banks. That's what stock market would be interested in. And it would be good news for NBFCs. But, I don't know if this is really all that fresh bad news for banks. One rate cut was always there because the Reserve Bank governor in the press conference in October clearly said that this opens up space to support growth. It was only the timing of the rate cut, and now more and more people are penciling it in December. I don't know if it's a solid bad news. It is certainly good news for FMCG. There is more purchasing power in the hands of people because inflation is eating less out of their money.
Thank you very much for that. I'm looking at Just Dial also. And here the revenue growth continues to be very, very modest. Quarter-on-quarter revenue growth is less than 2%, year-on-year 6.5%. And this is a company which has been growing in single digits top line for the last 5 quarters. Margins for the company are very stable, so that's not a problem. But profits this time, if you pull up the chart, you would see it's fallen very sharply, down more than 20% quarter-on-quarter and more than 20% on a year-on-year basis. And that's on account of an increase in tax rates. Even the other metrics are a bit disappointing. So the traffic has declined by 0.2%. The paid campaign growth is also weak, just up 1% quarter-on-quarter. Citi has cut the target price to 1,060. Nuvama has cut the target price to 1,200. You know what always helps Just Dial at the lower levels is the cash in the books, which is at 5,570 crore versus their market cap of 7,300 crore rupees. The stock is down 15% year to date and 30% lower in the last 1 year. But there you have that. Cash in the books is always supports. But numbers and growth is still very, very weak.
Okay, all right. Thanks a lot for that, Rima. Well, going to Ria, she's tracking Anand Rathi. Morning, Ria.
Good morning, Nigel. Good set seen for Anand Rathi in Q2 of FY26. The net profit has gone up by around 6% sequentially at 99 crores. Even the revenue has seen a jump of around 9% sequentially, coming in at roughly 297 crores this time around. EBITDA also seeing growth of around 8% on a quarter-on-quarter basis. Net inflows, however, have gone down by 22% sequentially at 3,002 crores this time around. Now, overall, the company has seen continued growth in turbulent markets, although there has been a slowdown in AUM growth on a sequential basis, but the company is still in line to achieve its AUM growth target for the year. So stock expected to open in the green today on the back of this.
Thank you very much for that. And let's get to some more stocks. Lodha Developers, Oil India on Sonal's radar. Good morning, Sonal.
Good morning. Let me start with Lodha because they've made an acquisition. They have acquired 100% stake in Chaitanya Birla Private Limited. This is a company which does not have any commercial operations, but they have a land, and that is the reason why the company has gone ahead. The consideration is around 500 crore rupees, and the land that the company has is 8.37 acres in Bengaluru. For Oil India, there are two updates. One is their product pipeline, which is the Numaligarh-Siliguri pipeline. That has commenced operations, and that will expand the capacity from 1.72 million metric tons to 5.5. And this is the reason why Numaligarh refinery will also be able to increase their capacity from 3 million metric tons per annum to 9 million metric tons per annum. Secondly, they've entered into a long-term agreement with NIPCO to supply 1.42 MMSCMD of gas. This is for a period of 15 years, and that's the reason that stock will be on our radar.
Thank you very much for that. And now across to Sudarshan for more stocks in the news.
So it seems GST cut has not come only as a boon for entry-level segment, but for the luxury segment too. It's showing a huge growth, and Landmark Cars has reported a Q2 business update in which company is saying that Q2 revenue growth is likely at 31% year-on-year, and that's the highest in a quarter that company is expected to see since listing, and it's being aided by the increased number of outlets and the strong demand that company has seen during the Navratri season. In July, company had 2 Kia outlets operationalized in Hyderabad and had opened 1 store, Mercedes-Benz store in Patna, and all these 3 stores are showing a huge growth since the day that it was operationalized. Second stock that will be in focus is Uniparts India. It has announced special interim dividend of rupees 22.50 per share, and for that record date is October 23. Also, company is saying that it continues to evaluate inorganic opportunities if anything comes. Last one is KEC International. It has announced an order win of rupees 1174 crore, and with this total order intake, Y2D has crossed almost 14,000 crore. So all the 3 stocks, I'm going with green.
Okay, all right. Thanks a lot for that, Sud. Well, here's a quick recap of all the top stocks we just discussed on the top 10 segment. The ones with positive news flow: HCL Tech, Anand Rathi, NBFCs, Lodha Developers, Oil India, Landmark Cars, Uniparts India, and KEC International. Well, we have a couple of them that will be reacted to negative news flow, which include Just Style as well as banks. That's about the equity markets. But as always, Manisha Gupta joins us to give us a complete roundup of what's going on in the commodity markets overnight. Manisha, they're twinkling overnight, it looks like.
Well, yes, it's an all-time highs yet again for gold and silver as prices. If you look at gold, well, we've seen a 2.5% of gains in the overnight market. $41.50 is where it's trading right now. And the Indian markets, as they open, will be opening at an all-time highs. Take a look at silver, and we've seen a 4% of a jump overnight. Another record highs for the global markets. India would be opening the same way. We are at $53 an ounce right now. We started this year with 29, so it has been nearly 82% of gains for silver in this year. Platinum also not too far behind. We've seen 4% of gains coming for that. Copper prices gained up by 6% overnight. If you look at Baltic Dry Exchange Index, that was up nearly 10%. The global shipping costs increased higher as US and China roll out reciprocal port fees from 14th of October. And then you also have various other commodities like aluminum doing quite well. Palladium is trading at a 2-year highs. So everywhere that you look, the tangible commodities absolutely doing quite well.
Thank you very much for that. We will slip into a break on that note. On the other side, we'll connect with Parag Thakkar of Ford Capital for some fundamental stock talk. Welcome back. HCL Tech will be the stock to focus on after reporting a good set of numbers, especially after the disappointment in Q1. The company's beaten expectations on revenues, margins, deal wins were also very strong, exceeding $2.5 billion. At the press conference, we had a chat with the CEO of the company, C. Vijay Kumar, on the overall performance. Listen in to what he had to say.
Our revenue grew 2.4% sequentially, as well as 4.6% on a Y-on-Y basis in constant currency. Our advanced AI revenue this quarter exceeded $100 million mark, representing approximately 3% of our revenue. Our operating margin came in at 17.5%. Our margins grew 116 basis points sequentially and is the result of the recovery plan we had shared with you last quarter. This quarter, we clocked in a booking of $2.6 billion, which was well balanced across service lines, geographies, and verticals. This is the first time we've crossed the 2.5 billion mark without any mega deal. We also signed 2 large deals, which we mentioned were delayed last quarter.
Well, that is HCL Tech for you. Parag Thakur, Senior Fund Manager at Ford Capital, now joining in. Parag, interesting updates coming out of the Indian technology space. Everyone had written it off. There was no interest in technology names. But then you had TCS, announcing a play on the AI data center, making a $1 billion investment to begin with. Now HCL Tech quantifying the kind of AI revenue, $100 million as a quarterly run rate as it stands today. I mean, is it time to start looking at technology, and are these steps material by the Indian tech companies?
Yeah, I would definitely like to think so. See, first of all, my view is that these companies are free cash flow generating machines, right? So you cannot completely ignore this space. And that is why we were also underweight, but not to the extent the street is. We have around 9% weight, and we have TCS and HCL Tech both in our portfolios. And I would like to say that, see, HCL Tech delivered on all fronts, right? Be it revenue growth 2.5%, be it margin 17.5%, be it deal wins $2.5 billion, and plus the commentary that this kind of deal win run rate will continue, which is very, very important, right? So I would say that and the only thing people have against HCL Tech is now the valuation gap between HCL Tech, TCS, and Infosys is very narrow, while HCL Tech earlier used to get a discount, significant discount. But HCL Tech is delivering, right? So I would say that, yeah, you cannot completely ignore this space for sure, because of simply the fact that TCS, Infosys, and HCL Tech right now gives you 4.5% dividend yield. Plus it is not that this AI-led productivity gains are leading to some deflationary in revenues as of now, at least. That is a fear, the only fear which I have in future. But I would see the commentary of each IT companies to build a view around that. That is a key monitorable for me. And for HCL Tech, the key monitorable will be next year, whether they can be able to deliver margins between 18 to 19%. But given the current margin of 17.5%, which has recovered from Q1, as they had said in Q1, I think it is manageable. Unless this AI-led deflationary impact on revenues plays out next year.
Okay, all right. Hi, Parag. Good morning and good to see you in. Parag, I wanted to ask you about the exchanges. BSE, late last, towards the end of trade, my colleague Yash, he had reported with regard to this weekly options, restriction. That fear is gradually receding. And that's why you saw BSE did pop up in trade. I was speaking to Amit Jaswani as well as Stallion yesterday, and he was telling me that in case that doesn't come about, then capital market plays could be forming a near-term bottom. How would you approach this space, whether you're looking at the exchanges, whether you're looking at the, brokerages or the likes, and also if you're looking at MCX, because out there as well, the premiums actually have been spiking up. Quarter one, I think it was average of 4,500 crores. Second quarter, 6,500 crores. And on Friday, it was more than 8,000 crores.
My way of looking at it is that capital market plays and all these exchanges and all, most of them have gone up too much. Of course, capital markets plays have corrected, and if you are, as you're rightly saying, that this expiry related thing if it plays out, that might be a bottom of these companies. These companies are good quality companies, no doubt. All the exchanges and all the capital marketplace. But right now, my view is that I'm very bullish on economy, and I would like to play economy through financials. And that is why I'm very bullish on companies like Tata Capital, which has got a very muted listing yesterday. But I would like to say that, when the CEO of Tata Capital, Mr. Rajiv Sabharwal has said that if the economy growth continues at current rate and what is anticipated after the GST cut and income tax rate slab increase and of course, interest rate cuts, then they'll double the loan book of 2,30,000 crore in 3 years. And with ROA improvement coming from credit cost itself coming down from 1.4% to below 1%. So that's a 40 bips ROA kicker itself. So I think the EPS CAGR can be 34% in this case. So I would like to play it more through financials who are lenders rather than capital marketplace, which can be volatile because of various global news.
Parag, do you have a view specifically, good morning, on BSC? We reported yesterday, I don't know if you saw, you say, because you have the view on capital markets we got, but the exchange specifically, I don't know if you have a view, because SEBI's thinking on restricting weekly options seems to have been restricted. Stock reacted to our story, was up 4-5% at one point. It's off, I think it's from the lows, it's come up about 20%. But if this was the big overhang, if this goes away, could be meaningful. But you got to like the business, underlying business in the first place. Your thoughts, Parag?
No. So my point is that, these are great businesses, right? Infinite ROC businesses. So definitely I'll also have a look. But right now, as of now, I'm not having this stock in the portfolio. So I would refrain from commenting on it.
Okay, just a quick word on, if you will, and we'll put out the numbers, etc. as well. LG Electronics, right? Listing is today. And large IPO, larger listing, I guess. And perhaps enters the 1 lakh crore club, market cap club, right at the first tick. What's your sense, and what should investors do? Those are the lucky ones who got the IPO and allocation. What should they do, Parag?
Yeah, they should hold on. Definitely that they should hold on. Because I saw the numbers, it is even at 1 lakh crore, it will be just 40 times FY27 earnings. And with a ROIC of above 60%. Okay. And clear dominating market share in washing machines and inverter AC and various other things. So I would say it's a good white goods play, strong brand, MNC, fantastic parentage, and very high ROIC business. So I would like to say that this is a good, and you have to have one of those in your portfolios, right? And unfortunately, the listed ones are not doing that well, already listed ones. So I would say that this can be a must-have in the portfolio stock.
All right.
India's consumption story, especially after the GST cuts and whatever has happened after the government has shifted focus to consumption-led, demand-driven growth for the economy.
Okay, all right. Parag, I want to ask you about metals as well, because, ArcelorMittal has gone ahead and increased prices in Europe by around 20 euros approximately. So it could have some kind of rub-off on Tata Steel. But we'll come to you in just a bit. For the time being, let's bring into the discussion Mr. Vimal Kejriwal, the MD and CEO at KEC International, joins us on the show. And the top 3 talking points we're going to be focusing on: the latest orders wins, are they on track for the 30,000 crores of order inflow for FY26, and the order pipeline with the company is L1 as well. Mr. Kejriwal, good morning. It's always a pleasure to talk to you, sir. The last time around we had spoken, you had hinted, you're in L1 in a few positions and that could get closed out. Another big order win is what you've announced late last evening. So give us a few details. What kind of margins will you enjoy on this? What is the execution period? If you could give us some color, over how many months?
Good morning, Nigel.
Morning.
So these projects are, T&D projects. So typically the margins would be on around, 10% plus. And execution period for them on an average is around 18 months, because one of them is 21, one is less than 1. So I'll say average is 18 months.
Right. So we've got that out of the way then. Give us a few more details. I think a year-to-date inflow is around 15,000 crores order inflow. You could correct me on that number. And I think you'll be looking at around 30,000 crores. Normally, the second half of the year sees higher amount of ordering. So you remain reasonably confident that you get there?
So yeah, the numbers are right. We are at 14,000, roughly 13,900 and odd for this year. We have another L1 of almost 4,500 crores. So we are hoping that that gets converted in the next few weeks or so. And I think overall we seem to be quite okay on 30,000 crores, maybe 1,000 crores here and there, but I think we are still on 30,000.
Okay, and what about prospects, sir, in terms of the pipeline? If you have to split it up between India, the Middle East, and other parts of the world, how do you see tendering activity? How do you see the kind of pipeline? How are things panning out?
If you look at the overall numbers, the tender pipeline for us is around 1,50,000 crores. Okay, of which I'll break it up slightly differently. T&D is around 65,000 crores, and the rest is civil, renewables, etc. In international, right now we are more or less only on the T&D side. So that order tender pipeline is around 30,000 and odd crores. Rest is all India.
Okay, all right. Any movement with regard to collections? I remember when we spoke last, particularly on the water side of business, things were slow. Obviously, it's a short duration since the last time we spoke, but is there some kind of sense in terms of improvement out there?
So the states are now talking about giving money. So we did receive some money from Orissa, which was a problematic case for us. MP, so we are only in two states, MP and Orissa. MP has been paying. Even last month they did something. Orissa also did something. So I'll say that there's some movement has started.
Okay, and the total collections due on the water portfolio is how much?
I don't have the exact number, but it would be around 700 and odd crores, 600, 700 crores.
Okay, all right. Final question, sir. We're going to chat again post the numbers, but I think revenue growth you were talking about was around 15% and margins of around 8.5%. Any tinkering around out there?
No, I think for the year we are okay with the revenue growth. Margins, I think I'll say around 8% is what we are very clear. 8 to 8.5 is what we are targeting.
All right, Mr. Kejriwal, appreciate you joining in and filling us in with all those details. Congratulations on another big order win. As you're saying, the pipeline's looking good. Second half of the year is normally better. So we'll keep an eye out on that front.
Thank you so much.
Well, just a quick note for all our viewers. As you can see on the screen, there is a Moneycontrol stock score just above the line graph. This is a score assigned to each stock based on Moneycontrol's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each and every stock. Each of the individual parameters are considered for a calculation of the four factors, and they're assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and a T factor score. But remember, this is not a buy or a sell recommendation. Any investor or a viewer is advised to carry out their own necessary due diligence on their own or through a certified registered financial advisor for any investment decisions. We will get into a break. On the other side, we'll talk technicals and we'll invite Mitesh Thakkar and Sudarshan Sakhani on the show.
Welcome back. There's about, 11 minutes to go for the pre-open session to kick off. There is an important corporate development with regards to Tata Motors. The Tata Motors CV business demerger is effective today. So let's just revisit this with Sudarshan, who's joining us. So good morning.
Morning, Prashant. So Tata Motors will be in focus. So let me first tell you the news. If you remember, Tata Motors had announced that it would demerge commercial vehicle business and two companies will be formed. First one, Tata Motors passenger vehicle, and second one would be Tata Motors commercial vehicle. Now the demerger scheme gets effective today. So how will you know the value? There will be a special pre-opening session, and that will be from 9 a.m. to 10 a.m. on both the exchanges, BSE and NSE. So once after the pre-opening session, the price that you would see on the screen would be for Tata Motors passenger vehicle. Now, commercial vehicle business will be listed separately, and that will happen after 30 to 45 days. That date is not known yet. We'll get to know after the company after a few days. So now Tata Motors passenger vehicle business will have first India passenger vehicle business, second JLR, and third the company that holds stake in Tata Technologies. Commercial vehicle would be have India commercial vehicle businesses. So how do you know the value? So we have few brokerages who have first JP Morgan values total Tata Motors, it has valued at rupees 700 per share, for which JLR's value is rupees 236 per share. India business is at rupees 436 per share, and for the stake that company holds in Tata Technologies, for which the value is given of rupees 26 per share. For India business, passenger vehicle is valued at rupees 130 per share, and commercial vehicle business is valued at rupees 306 per share. As per Nuvama, overall passenger vehicle business, India PV plus JLR plus stake in Tata Technologies, total value is rupees 365 per share, and for commercial vehicle 367 per share. As per Nuvama, PV is valued at rupees 410 per share and commercial vehicle at rupees 280 per share. Apart from this, also company has got the corporate affairs ministry's approval to change the name of the company to Tata Motors passenger vehicle for India PV.
A very, very exhaustive explanation there. Thank you very much for that. Parag, you heard the Tata Motors, the demerger, and of course how it breaks up in terms of value. Your thoughts?
So my view is that, see, ultimately all Tata Group companies are great companies. Under Mr. Chandra, they have all done a fantastic capital allocation and value unlocking whenever required. So I would say that from long-term perspective, yes, but from short-term perspective, JLR's performance needs to be monitored before buying Tata Motors stock. So we don't have it in the portfolio, but of course it is in our radar. And whenever we see some uptick in JLR, we would jump to buy the stock. That is my clear view, because then that might be at a higher price, because you always have to pay price for certainty in the market. But JLR is a very important piece which we cannot ignore in Tata Motors.
Now got that. Parag, we'll take a quick break here. We'll come back and continue some of this discussion. 8 minutes to go for the pre-open session. That's coming up. More coming up. So we want to touch about RBL Bank as a stock as well, right? I mean, that deal perhaps getting closer and closer. So we'll ask Parag about RBL as well and put out a small piece. Stay with us. Coming back.
Co-powered by SBI. Best है सबको पता है. investing. Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by National Stock Exchange. Soch kar, samajh kar, invest kar.
Welcome back. RBL Bank is a stock we're going to focus on. Remember, in the last, I think, 2 months or so, it's definitely outperformed what the Nifty Bank has done. We have a Moneycontrol report that's suggesting that Emirates NBD is all set to pick up a majority stake in the bank. Gaurav joins us to help us out with a quick analysis on that. Gaurav?
Yes. Now, a news report suggests that Emirates NBD is looking for a majority stake in RBL Bank. In fact, they have also mentioned that both the companies have been talking for months, and Emirates NBD is actually interested in buying around 51% stake in RBL Bank. Now, remember, with this, IDBI Bank is also going to be in focus today because Emirates NBD was one of the names which was flashed in the reports where it was mentioned that it is one of the front runners for stake in IDBI Bank as well. But let's not forget about what is happening in RBL Bank. Fundamentally, if you look at RBL Bank, it is at a good stage right now. It is at a juncture of turnaround because they are saying that ROA is going to reach around 1% by the end of FY26. And at the same time, even if you look at valuation, that is attractive. It is trading at just 1 times price to book value versus the average of 0.7 times. So definitely, it looks like RBL Bank is at an attractive stage. But at the same time, let's not forget about the regulatory action. Now, regulators suggest that any single investor's voting right are capped at 26% for any listed private bank. Now, any changes which are required to be made will need legislative changes because these ceilings are prescribed by Banking Regulations Act, and experts believe that such legislative changes will take time because it is going to be a long process. When we look at the previous instances, we have already seen some of the instances happening in CSB where Fairfax picked almost 51% stake back in 2018, but that was a different case because the exception was made as capital availability was low and it was for the struggling bank which was CSB at that time. But for RBL Bank, if you look at capital adequacy ratio and CET1, both these ratios are well above the prescribed limits. When we look at other deals that have happened recently, we saw Warburg Pincus actually picking around 10% stake in IDFC First Bank. Sumitomo Mitsui, there also RBI gave 25% approval for 25% stake in Yes Bank. So definitely, when we look at RBL Bank and the 51% stake as reported by Moneycontrol, it will be really interesting to see how it is going to happen, and it is definitely going to be time consuming, months if not years. But for now, we will be focusing on RBL Bank and see what happens and how commentary is will come from the management in the results ahead.
Okay, all right. Thanks a lot for that. Gaurav, Parag, what's your view? RBL Bank, valuations still seem to be a little bit in favor. Stock has seen a massive run in this year. My director will just pull up, maybe a 3-month, 1-year chart of RBL Bank and the Nifty Bank. Your view on it?
So we hold it in our portfolios, very small weight, 2% weight. So I would say that, the appetite of foreign investors for financials of India is fantastic. And that is why we bought it actually. After seeing that, Sumitomo of Japan bought stake in Yes Bank, a 24% stake. Then IHC bought stake in Samman Capital. So all these small financial entities, they get a very good value, and they get I would say that they are up for grabs. Plus, the latest business update of RBL also indicated that they will see a lesser margin compression or even a 5 pips margin expansion QOQ. That also attracted us towards the stock. So I would say that fundamentally, as you rightly said, at one-time book value, there's nothing to lose much, apart from the fact that stock has rallied very well. So it might see some profit sometime. But I would say that Indian financials are completely in favor in terms of attraction from foreign investors, and that should be the case because it's a highest growth country, and definitely we see very good future for next 18 months after all the steps which government and RBI has taken in last 6 months.
By the way, Parag, do you own any of these silver ETFs, or are you allowed to, or any
No,
thoughts?
no.
5-6%. It's like a
Yeah, but I would like to say that this is actually parabolic move, which I would hate to participate in. I mean, I could have participated earlier, but as of now, I am not seeing any great. I'm happy to miss kind of situation for gold and silver right now. These prices I cannot buy.
No, absolutely. Understood. Parag, thank you very much. Good speaking with you here on CNBC TV 18. Appreciate your time. Rupees opened up about 10 paise weaker compared to yesterday's close. Sudarshan Sukhani and Mitesh Thakkar are with us with what they want you to do with regards to specific trades. Gentlemen, good morning. Great to have both of you here. Sudarshan, you go first. I mean, Bank Nifty, positive close. Nifty slightly negative off the lows by a lot. Direction of travel remains constructive. Sudarshan?
Yeah, good morning. Yes, it remains constructive. Sometimes markets do nothing. Today is also a weekly F&O expiry, and it is possible that the Nifty or the Bank Nifty, in any of them or both of them, could actually drift sideways today as they did yesterday. But that doesn't change the trend. The short-term trend is up. Till that is not cancelled out, we'll have to assume that we are buyers on dips, and that is the suggestion I take. How will it be cancelled out? If the Nifty closes below 25,100, that's a close. Then we'll say something has changed and we'll step out. But for the time being, look for an intraday dip and go long.
Even yesterday, same time when we were chatting, Sudarshan, and there was a gap up opening, which seemed very likely. Your call was to stay positive, and markets are headed higher. But Mitesh, you were looking at 24,350 as a potential resistance for our markets on the way up. Now, this morning looks like there will be some green start. What would be the trade on the Nifty and even the Nifty Bank, which has been doing well?
Good morning. So, I absolutely agree with what Sudarshan said. 25,100 is an important level, and any declines would be buying opportunities. And 25,350, 400 is the zone, which once the Nifty clears, there's a good chance of a strong momentum coming on the upside. So these are the two levels which I'm watching closely. For the time being, the bias of the indicators and averages is positive, so I'm more bullish, hoping that the breakout will eventually happen, if not today or tomorrow, in the coming few days. And therefore, we should possibly be preparing for some more upside. Having said that, the Bank Nifty has already, started slightly outperforming the Nifty, and it's met the first target of 56,500. The next target which I have is 57,000 to about 57,250. I think that's where the Bank Nifty could be heading.
Got that. Mitesh, morning. What are your trades?
Morning. I have 3 buys to a sell. On the buying side is Bajaj Auto with a stop at 9,000. I recommend long positions here for a short-term target of 9,200. Also, buy on IDFC First Bank. Now, yesterday the stock was down a bit, so it gives you a good fresh entry point. So buy here with a stop at 72 for targets of 77. Bajaj Finance made a fresh swing high, so that's a buy as well. Keep a stop at 1,022, look for targets of 1,065. And one sell call, that's HUL. Keep a stop at 25.12, look for targets of around 24.50.
Sudarshan, what would your stock calls be?
Yeah, I'll just discuss my stock calls. But to answer Prashant, I own some very small lots in silver ETFs. And that's not making me happy. No, it's not. Even though it was purchased last year. Because now I'm riding a tiger. How do I get out? I have no idea at all. All right. So now for the stock.
I think that riding the tiger is a phrase that, Sudarshan, you would well remember, right? Yes. Infamous line. But anyway, I guess you got to just get off at some point because. But last night I think silver was up again. It's taken out that $50 resistance. Twice it's got to about $50 odd dollars, and I think we're past that level now. So who knows? There seems to be a bit of a scramble for silver here. But your trade, Sudarshan.
Yes, that's right. And the spot is higher than futures. That's strange.
Yeah.
Bharat Forge is a buying opportunity. Bharat Forge is a buy with a stop under 1,210. Lupin is a buy with a stop under 1930. And I have one intraday short, ICICI General Insurance. It's an intraday short with a stop above 1870. And finally, Chola Finance is a buy with a stop under 1620. So 3 buys, Bharat Forge, Lupin, Chola, and one intraday short, ICICI GL.
Got that. We'll chat with you guys through the course of the day. For now, let's focus on hospitals and diagnostic space. Now, Centum expects the hospital revenue to grow by 17% on account of an increase in bed capacity. Rising share of the wellness segment will also help diagnostic companies. To discuss this and more, we're now joined by Sumit Gupta, AVP Research at Centrum. Thank you very much, Sumit, for joining in. Let's start with the broad call that you have on diagnostics and hospitals. What is the thesis that you're growing with for the next, say, 2 to 3 years?
Yeah, hi. Good morning. Thanks for having me. So for regarding the hospitals, so majority of the growth will likely be coming from bed additions on a YY basis. And apart from that, you can say 4 to 5% growth in the ARPOB. On the diagnostics front, it will be likely led by volume growth and a bit of mix change. And it will depend on company to company what kind of strategies that they are building in. Let's say for Dr. Lal, they are primarily focusing on volume growth and a slight improvement in mix. And some other companies are like Metropolis, they are also focusing on volume growth. Apart from that, price growth is also there. So it is very company specific.
In hospitals, which stock do you like the most right now and why?
So it is Aster DM and Max Healthcare, which we like on a continuous basis over the next 2 to 3 years. Max is likely because if you see the kind of expansion that it is going through, majority of it will be brownfield expansion, nearly 70-75%. So that will lead to lower margin dilution and higher ROCE. So in that case, we remain positive on Max Healthcare. And with respect to Aster, we see the care merger will be done completed by Q4 FY26, and in that sense, you will see basically it is becoming the top among the top 3 hospitals, biggest hospitals in terms of bed capacity in the nation. And if you see the overall geographic expansion and apart from that, the financial metrics are also expected to improve a lot.
Yeah, Aster is Sumit. Hi, morning, Prashant here. Aster is the one which took over. A quality care, right? I mean, that was the big merger which had happened. That Blackstone.
Yes.
Okay.
Quality care and Aster, yeah.
Yeah. I think 10,000 odd capacity now. But with hospitals, Sumit, are these quarterly numbers? Because I'm assuming it's a business where you go through a phase of expansion, adding capacity, and then a couple of years, you stabilize it. Then you go on another spree, of expansion. So these are the Max and Aster are kind of sort of tactical, or based off of your view of what second quarter will look like, or I mean slightly more sort of longer term opinion here.
It's a slightly longer term point of view. Max and Aster both in terms of the kind of alpha generation capability that these two have. So this is where I believe Aster is the number one, and followed by Max in terms of that the alpha generation capability. However, the point that you highlighted that hospitals, first of all, they do expansion, and for quite few years post that, there is a lull period in terms of no expansion. So that is the nature of the hospital industry. So let's say for 3 to 4 years, these hospitals expand, and then you will see a slight dip in profitability. And once the expansion stops, in that case, the ROCEs improve. So that's the quality of nature of basically you can say the industry fundamental.
No, absolutely. Do you have coverage on HCG,
No.
Sumit?
No.
Okay. What else do you cover in that space?
So Max, Vedanta, Aster, Rainbow, Yatharth, Artemis.
Okay. Okay. Is there there's a company called, I think, GPT Healthcare, Calcutta-based. Ever looked at it? Small company. But
it's
again,
a good company, but I won't be able to comment more on it. However, remains in a good state in that particular market. So that's a growing market as of now, and there's a lot of focus from other hospital players also in the east and northeast region, especially Raipur market also.
On diagnostics, what is the call? You were talking about how volumes will be the big driver for growth. I mean, what is the top line EPS growth that you expect for this sector? And which stock do you like the most here?
So within the diagnostics, I like Dr. Lal. And overall basis, I expect around 12 to 13% kind of growth on the revenue side, and similarly on 14 to 15% kind of growth on the earnings side. Dr. Lal, I like it is largely because the majority of the growth is coming from the volume, basically volume growth, and not deliberately taking a price hike. And if you see positive operating leverage also playing out in terms of the margin expansion for Dr. Lal.
What about on the competitive side? I mean, they've gone through a period of very high competitive intensity, pricing pressure. Is that now coming to an end, and are we looking at price increases now going forward?
Yes, the kind of competitive intensity that we have seen over the last 3 to 4 years, it has more or less now abated. It is more of the incumbents and the competition from the hospital-based labs, which is the predominant theme as of now. However, if you see the majority of the competition is between the routine and the semi-specialized test, and that too into the pathology segment largely. So the companies which are into specialized and super specialized testing, they will continue to do well.
This time, Sumit, for diagnostics, as CEO was, or maybe that was the last quarter, actually this quarter, right? The dengue season was, thankfully for you and me, it was not a bad dengue season. Right. But not great news for diagnostic companies. Yes, but that's a big variable, isn't it?
Yeah. So basically, we will see a slide down, basically lower revenue growth with respect to the diagnostic companies. So basically, it was a continued monsoon season. In that case, there was lower footfalls in the diagnostic labs, pan India. So we will see a lower volume growth.
Yeah, no, absolutely. Good speaking, Sumit, then hope to connect once we have the numbers with us, right? And the report will invite you back for a review in terms of what you like. But Aster and Max from a hospital's perspective is what Sumit is focused on from a longer term perspective. Sudarshan is back with us, so is Mitesh for their 9-10 call. Sudarshan, you go first. What do you have?
Chola Finance, buy with a stop under 1620.
Chola Finance. Mitesh, what about you?
I'll go with a buy on Bajaj Finance for targets of around 1,060.
Okay, 2 NBFCs, Bajaj Finance from Mitesh and Chola Finance from Sudarshan. Thanks very much, both of you, for that. Well, HCL Tech is what we want to revisit very quickly in terms of what the street made of the numbers. Rima, take it away.
Well, let's just, we spoke about the numbers and how they're a beat on revenues, margins, deal wins have been very strong. So now let's just quickly run through what the brokerage call is. Now, Jefferies, Nomura, CLSA are all bullish on the stock with an average target price ranging between 1660 to 1730. On the flip side, Citi and MS, as you can see, are neutral on the stock. Now, why the bullish call generally? One, Q2 was a strong performance. And secondly, as Jefferies points out, the company raised the services business guidance. Raised doesn't tweaked it. It was earlier 3 to 4%. Now it stands at 4 to 5%. But this would mean that it would be amongst the fastest growing large cap IT companies. And therefore, according to them, it deserves premium valuations. What next? The current margins for HCL Tech stand between 17 to 18%. But previously, it used to enjoy margins of 18, 19, 20% also. So the aspiration is to get back to that. So as CLSA points out, the margin recovery to 18 to 19% next year will be the key for re-rating from here on. And MS also says that because we do not have clarity on when margins get back to the historical levels, we are not upgrading the EPS for now. But a good set of numbers, and the bell has gone.
Absolutely, and I think we've got the market opening first rates coming up, 25,227. The Sensex at 82,400. And, just starting with basically a reflection of what we had overnight as well. Overnight, you had a nice rebound coming through. And I think it's showing up here as well. The Nifty Bank ended in the green. It's now slipped into the red a little bit, but just absolutely flat. We've got Midcap index, which is up about 0.4. By the way, the market breadth was 2:1 in favor of declines. Although, if you had to find volumes on stocks, it was all on stocks which were higher. So, lots of single stock action. And that's why I didn't feel like market breadth was negative or broader market was selling off or anything of that sort. We have a flattish kind of rate now in the Nifty Bank. The broader market, 1/3% higher, and the Nifty heat map up on your screen. HCL Tech, as Rima pointed out, on one end, it's responding to numbers, and on the other end, you've got Dr. Reddy's, Cipla, and actually a bunch of pharma names. But it's overwhelmingly in the green. And then you can see that blue stock, right? I mean, that's Tata Motors commercial vehicles. We'll have the rate up for you in a bit. Rima.
Well, the interesting mover today is LG Balakrishnan. It's not connected to LG Electronics. It just shares the first two, letters, LG. But that's a stock which I last checked and had opened with a gain of close to about 6%. But remember, it's unconnected to LG Electronics. LG Balakrishnan is an Indian company. It operates in the automotive space. But the street is clearly getting excited. But as Prashant pointed out, the top gainer right now is HCL Tech. The street likes the performance. The stock is at 1523, a gain of nearly about 2%. Other IT companies are also moving up. Tech Mahindra, which reports numbers later today post-market hours, has opened with a gain of 1%. Here the street is watching. The investors are tracking whether the margin improvement continues. The company had laid out a 3-year roadmap for a turnaround under Mohit Joshi that comes to an end in FY27, so 1.5 years to go. But by the end of it, Tech Mahindra wants to achieve margins of 15% and industry-leading growth. The progress to getting there will be tracked very closely. So Tech Mahindra, Wipro, Infosys all up in the green. Reliance Industries has opened up higher, up nearly about 0.5%. Metal names active. It's a fresh 52-week high on Tata Steel and Hindalco with a surge of close to about 1%. Geo Financial gaining ground. On the way down, some pharma names are a bit subdued. Cipla, Sun Pharma, Dr. Reddy's in the red, and Maruti Suzuki is down close to about 0.5%.
Well, that's right, Rima. A few stocks that deserve special mention. Hindustan Zinc, that one's up close to 3%. That's the only play that you have on silver. It's going to be tricky, but that has silver exposure, so that's why that stock continues to move up. It's up close to 3%. Float as well, reasonably limited on that one. The other two stocks that we pointed out earlier today was MCX. The premium on a daily basis is moving up. That's another way of playing this entire move with regard to commodities melt up. So that stock continues to move up 3.5%. BS is the other one. As we said, that weekly contract, risk to those contracts could be receding a little bit after our colleague Yash had broken that story yesterday. The stock is up close to around 3% on the back of that. So good move is what we are seeing. Another interesting name, which could be a bit of a positive rub-off, is overnight you had Bloom Energy, and data center. There was a deal that was linked between Brookfield as well as Bloom Energy. They have announced a tie-up worth around $5 billion. And because of that, a stock like MTAR could be in focus because it's a key supplier of hot boxes to Bloom Energy. So that explains why MTAR is up close to around 3%. Volume's not very, very high, but that stock's doing well. And KEC, management joined us earlier today. They were celebrating the order win. They said that the pipeline's looking good as well. So that's up another 2%. In RBL Bank, unconfirmed reports suggest that, in fact, there could be a deal in the works. We'll have to see what happens. Stock has been a relative outperformer. Today up close to around 2%. Prashant.
No, absolutely. So lots happening, right? I mean, in terms of individual names, individual stocks as well. So it's 70 points for now, 25,286 at this stage, at this point in time. We have Nimesh Chandan, who's now joining us. He's right here in our studios, Chief Investment Officer at Bajaj Finserv Asset Management Company. Nimesh, great to have you with us here. Thank you very much for joining us.
Pleasure to be here.
So you're basically back knocking at the upper end of the range on the market. You think enough in the tank for the market to head higher, or it's going to be, there is no burst higher which is waiting to happen. It's going to be slow grind up. What's your sense?
So there could be certain events that can just
open
the top.
Yeah, that should take us to the highs, which is the US-India thing, right? Whenever that happens, hopefully sooner. But that's like a one-time thing, whenever that happens.
So I've been working with the theory that markets are like a coiled spring right now, where you've seen economic cycle doing better, corporate cycle doing better, credit cycle now picking up. The only missing part is the sentiment cycle. And that should start hopefully changing with some of these news flow behind us of, say, tariffs and trade agreements and so on. Except for, say, IT sector, where we are underweight. Otherwise, from consumption, pharmaceuticals, real estate, capital goods, we are quite bullish across the space. You're not getting valuations at the very cheap, but they are not very expensive. So there is enough to actually select and build a good portfolio for. So very bullish on the markets. Second half, this half, we should see a new high for Nifty.
Yeah. In terms, when you look at markets and what to do, is the approach more, not so much sectoral, okay, we like this sector, we like that sector, we don't like this sector. Is it very very individual specific companies? Because I was just looking at a list of NSE 500 this year, and this is a year where, obviously the index has not done very much point to point, but lots of 30, 40, 50% kind of movers, right? All from a variety of areas.
Absolutely. I think market is still giving a premium for growth. And wherever there is visibility for growth in the future, market is giving a much higher premium there. You can take quick commerce companies or recently the move in CDMO companies, CRAMS players. You can see that valuations are high, but they're moving higher because the growth visibility is there. We were analyzing about the BSE 200 companies. So we took those 200 companies and we were looking at, let's forget price to earning ratio and price to book. Let's look at upside given by analysts. So we took the best estimates. Now this is Bloomberg data, where best estimates of all the analysts, what is the average target price that they're looking at. Out of 200, about 6 were not covered by anybody or the estimates were stale. Out of the 194, 19 had downside. The rest, 175, had an upside. And out of those 175, 110 had a double-digit upside. So which means there is enough to play to pick up. And as you said, you may not want to go just sector-wise or so. In some cases you might, like for example, banking and financial services, you may want to go on a top-down approach. But on a bottom-up approach, you can take a stars approach. You can pick the best from each category and create a good diversified portfolio, which is giving you enough play from both large caps, mid caps, and small caps.
Just briefly recount the statistics once again, BSE 200.
So these are for a few days back. So what we did was we took, now analysts can be bullish or bearish. So we took an average estimate of theirs. So for BSE 200 companies, let's take the average target price for 1 year, whatever the analysts are giving. From there, out of 200, 6, as I said, did not have fresh estimates. Let's say the estimates were stale. So you are left with 194. About 19 had a negative price target. It can be minus 0.5% also. It might be minus 10%. So 19 of them. That means 175 had something positive to look forward to. And out of that, say 110 had double-digit upside, so above 10%. Now, if we are like about 5-6% away from the highs, right, in terms of all-time highs. For the market to scale that, I think there are enough stocks to help scale it because they are trading below their intrinsic value. Here I'm not taking the most bullish estimates. If I take the most bullish estimates, then the numbers can be much higher. But just taking these average estimates, thinking that the crowd on an average will be right, we still have upside.
Nimish, I remember chatting with you same time last year. You had come down to the studio, and at that time you were giving us your Contra bets. And it was all about the capital goods, defense stocks, industrials, which were right on top of everyone's buy list. And you said it's time to move away from there and get into consumption. And that theme is played out. It was consumption, chemicals, and pharma. I was just going over my list. These were the 3 Contra calls that you made last year. Now, as you look ahead for the next 12, 18 months, tell us how would you construct your portfolio and what would be the Contra value bets now?
So some bets you will want to continue. So for example, consumption you will want to continue. Pharmaceuticals, I think, is coming out of a de-worrification, as I would call it. There were many worries. One by one, every worry got sorted, like generics will be allowed. Trump is not putting any new tariff on those innovative or branded drugs, unless, of course, you have some estimate of having a capacity in US. But the big contra bets will be real estate and metals from here. Moving into hard assets. Real estate in India is doing well. Prices have been compressed. Last year, it's one of the underperformers. And now there's value emerging there. With lower interest rates, with more income in the hands of people, real estate can definitely get a boost. On the other side, metals, I think after the move we've seen in gold and silver, I think the industrial metals are next to go. And here, if you see, on an average, if you see last 10 years, metal prices were more hovering around an average, where the costs of mining, sustainability costs were going up. And now emerging markets have started doing well. And we'll realize that as emerging markets urbanize, as they do counter-cyclical policies, the metal consumption demand starts moving up. On the other side, you will also find some kind of supply constraints in certain metals, say rare earth or so. So I think metals and real estate, these two are contra plays according to me, where you're getting companies that say replacement values or near the book values or NAVs, and you are able to see growth coming.
Nigel, I just want to highlight for our viewers that if you can pull up silver Bs. Silver Bs are up 8%. Yeah, I mean, it's just absolute bonkers of a move, right? And by the way, this week, Silver B's 15% higher, if you can pull that up. And it's basically 110% this year, 30% from the start of this month. So, and then we can have those up. Yeah, there you go, on your screen now. 9% on, that's UTI Silver ETF, 7%. Nippon, HDFC 6%. So this is some kind of, I don't want to use the word lightly, but a bit of a small parabolic kind of a move is what you have going. Nigel.
Well, Nimesh, good to have you on the show as well. So we've gone through some of those trends. I wanted to ask you about another trend that we haven't spoken about, the internet themes. You know, people were brushing it aside, but actually, you know, for those daredevils, so to call it at that point of time, you know, the big money has been made out there. Do you think this internet theme, these new age stocks, they have a longer runway, or do you think, you know, they've done their bit for now, you'd rather stay away?
So what we've seen is in technologies, there is always a hype curve that people get excited about something, project that growth rates will be, I mean, path will be very smooth and give it very high valuation and all the players will benefit. Then you have the disappointment where you have a chasm where everything falls together. And then selectively, these businesses which actually deserve high valuation start moving up. So that's what we've seen in the more of an internet space or the digital consumer companies or digital payment companies or so. So all these new age companies have earlier at the listing went through a hype curve. And now businesses that deserve are able to show that they can monetize these trends and grow consistently, have a business moat, those start doing well. So we look at customer ownership, we look at how much margins these companies are making. We also look at which are the investments which are for the present and which are for the future. Right. Many a times the companies actually spend a lot during the initial years to gain customer traction. And then they are able to charge better or reduce those expenses to turn them into profitability. So if you see in the recent past, those companies which have shown good numbers along with good profitability have actually shown better performance.
In consumption, what's the best play? I know we've asked you this before, but rates keep changing. The subs themes also keep evolving. So now at this juncture?
So as I had said earlier also, I'm bullish from everything from FMCG, quick commerce till real estate. But from now on, if you want to see more upside, because after the GST cuts announced, there have been certain moves in the market. I think in many cases, the auto stocks have moved up significantly. Consumer discretionary pack as a whole has many opportunities where valuations are attractive. So in white goods or in home improvement spaces, you have opportunities where valuations are attractive below their average and the growth is quite good. Some of the themes may continue. So for example, consumer services, whether it is quick commerce, QSRs, those guys can continue. Unfortunately, Rima, here the attention went toward GST winners or losers. Not many people are accounting the whole impact, the wealth effect because of gold, the income effect because of income tax rate cuts. We are going to have 8th pay commission, which will be coming and giving a stimulus in a way to the urban consumption. People are not looking at the whole picture. People just tried to put numbers on GST winners and losers and decided which ones to buy. That's why you've seen very different moves in these sub-segments of consumption. But I think overall, consumption space for India, I think for next 5 to 10 years, it's the best space to be.
So there were quite a few consumption IPOs, right? There's an urban company, or there is LG Electronics now. We'll await the listing. I don't see Bajaj Finserv's name in the anchor investors. Is it that you all participated and didn't get allocation, or you all just stayed away? And if yes, why?
So when a sector is doing well and IPOs come in, we approach it a bit cautiously. I'm not saying all the IPOs are like that, but we have participated in few of them.
Which ones did you all participate in?
I may not be able to name as such, but I would say that in one of the books, I think Benjamin Graham's book, Intelligent Investor, there was a foreword by Jason Zweig where he writes, IPOs in bull markets should be defined as it's probably overpriced. There are many good companies available in the secondary market which are available at good valuation. So we want to benefit from that rather than just chase IPOs.
There's a bit of a FOMO bit as well, right? I mean, you want to chase. I mean, there's a bit of a chase going on. But the chase for most things.
True.
What else? We were talking about data centers, etc. Right? I mean, TCS has announced a little bit. I'm not talking about IT services and TCS specifically, but have you looked at anything there? Any companies?
Yeah. So there are some mid-cap, small-cap plays where you have companies either providing equipment or some kind of a part of value chain of the data center. So some MNC listed companies are part of it. We actually benefited hugely from the power sector because of data centers. Because there's a huge run for, these are power guzzlers and people are looking to set up either pocket-sized nuclear plants or invest more in transmission and distribution. There were about 3 companies in our portfolio which are MNCs, which are into high-end T&D.
G Vernova is one.
So there are 3 of them which actually are the biggest in these HVDCs and all. So we have all 3 of them since last 2 years, and we've seen them multi-bagger returns on that.
Anything else?
Since you like real estate, what about these flexible co-working space? Lots of companies, 3 of them got listed recently, SmartWorks, IndiCube, and then WeWork, or even REITs, where you have a play on commercial real estate. There was Embassy. I mean, because the broader call on real estate is positive, where do you stand on these 2 segments?
Very positive on both. However, in REITs, I think after the run-up that we've seen, maybe your yields are lesser. So though they are equity, but their yields in terms of dividend yields or interest yields are lower. In terms of co-sharing spaces, office space sharing, we are very positive. So that's a business, if you crack it right, if you have the right real estate, the cash flows are fantastic in these businesses. Initial years of investment are there, but then you go through that J curve where the cash flows are fantastic. So quite positive on those spaces. And I think good that so many companies are getting listed. This can become a very interesting asset class that people will look at.
So with disclosure, can you tell us what you have in your holding? I'm sure people can find it, but if you could just tell us, it'll be easier.
So there are 2 listed, both are in the portfolio, and the 3rd one is coming, we are considering.
This is on co-working?
Yeah.
There are 4 listed, no? There's Office, there's WeWork, there's IndiCube and SmartWorks.
2 are with us, so I won't name them.
All right, Nimish, we'll leave it there. Thank you very much. Great chat as always. Appreciate you coming down to the studios. Thank you. Well, I think what we're going to do is, as we head and run into the LG listing, LG Electronics listing, get an Upasna. So we'll look at LG and we'll play out some sound bites of our interview interaction with the management as well. What are valuations looking like? And of course, what the price was offered at. But of course, it's not going to be at listing. It's going to be higher. But how are things stacking up now compared to peers? Upasna, take it away.
Good morning. Well, the most awaited IPO, that is the LG Electronics IPO, set to list on exchanges. Now, we are expecting a blockbuster listing, and the price band of the issue is around 1,080 to 1,140 per share. Now, company seeks an MCAP of nearly about 77,380 crores, looking at the higher end of the offer price. Now, mind you, this is entirely an OFS, and the promoter stake post-issue stands at 85% versus 100% now. Now, the company has raised nearly 3,475 crore from the anchor investor, and the subscription levels are at a bumper level. It is the first Indian IPO to cross bids over 4 lakh crore, and overall subscription of this IPO stands over 54 times, with QIBs leading the pack. Now, this signals a strong market sentiment in even a healthy listing. Now, coming to the valuation, the company's valuation stands at nearly 35 times, which is FY25 EPS. Now, if we look at the main listed peers in the large appliances, that is Voltas, Blue Star, Havells, they are currently valued at somewhere around 40 to 40 times 1-year forward PE. So certainly it is conservatively priced. Now looking at the brokerages, let's look at the brokerages stake. Now MOSL expects the stock to trade at a higher multiple given the strong fundamentals and the return ratio. They've initiated a coverage on this with a buy rating and a target price of nearly around 1,800 per share. Now Ambit also says that the growth tailwinds led by under-penetration will continue to play out for the stock with premiumization opportunities across categories. It has given a 12-month price target of 1,820, which implies a valuation of 43 times 1-year forward PE. Nomura has also given a target price of 1,800 and Antique has given a target price of nearly 1,725 per share.
Thank you very much for that. Comprehensive details there. In fact, we had a chat with the top management of LG Electronics earlier. They spoke about the reinvesting plan in India, their outlook. Listen in.
We are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh, where our $600 million US dollar investment we are doing. We are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in Tier 2, Tier 3 town. Introduction of many new products. We are also scaling up our B2B business. That's our focus area.
Okay, all right, and let's focus on the other number that came in overnight that is quite encouraging. Anand Rathi, the stock is holding strong. Ria joins us to help us out with the quick revision of those numbers. Ria?
Well, yes, Nigel, good set for Anand Rathi in this quarter. The net profit has gone up by around 6% sequentially, coming in at 99 crores. Revenue also seeing an uptick of 9% sequentially at roughly 297 crores. Even the EBITDA has gone up by around 8% on a quarter-on-quarter basis. Net inflows, however, have gone down by around 22% sequentially at roughly 3,002 crores in this quarter. Now, overall, the company has seen continued growth in turbulent markets. And however, there is a slowdown in the AUM growth of the company, but still do remain on track to achieve the AUM growth targets for the year. And on the back of this, the stock is up by around 6% at the moment.
Thank you very much for that. For the markets too, holding up with a gain of about 50 points in the Nifty, closer to 25,300. The Nifty Bank is flattish today. So yesterday it did a bit of an outperformance, but today it's on the flatter side, despite the benign CPI inflation raising hopes of a rate cut coming from the RBI, but that isn't getting reflected in the price. I think it's IT which is doing quite well today. HCL Tech continues to be the big winner. Along with that, some other names in the metal packs. Tata Steel, ONGC, Apollo Hospitals amongst the top Nifty gainers. But let's now turn our attention to India's auto component space and to try and take stock of a few things. For starters, has the recent GST cut translated into lower costs, improved margins for the suppliers, or has the benefit been absorbed into the value chain? Secondly, festivities are on in full swing. But how strong is the pickup in orders? What's the inventory movement looking like? And finally, the rare earth magnet squeeze. It's a key concern for EVs and electronic components makers as sourcing challenges persist and costs are likely to stay elevated. Put all this in perspective and take stock of things with Sunil Chodia, Chairman Managing Director at Rajratan Global Wire, and Swasthi Shrikant Badve, promoter of Bellrise Industries. Gentlemen, thank you very much for joining in. If I could get both your views, and let me start with you, Mr. Chodia. The recent GST cuts, what has been the tangible impact in terms of order inflows that you've seen? And what is the order book now looking like? Can you put a number to it?
For our company, because we are suppliers to tire industry and we are tier 3 suppliers, so the effect of all this boom in the auto industry and increased sales of auto, what we are seeing in this festive season, the impact of that will come little later on the tire industry, because 70% of the tires go in for replacement market and only 30% go in the original equipment. So, but definitely long-term perspective for tire industry is also looking positive, because there is a reduction of GST on tire itself. From 28%, government has reduced the tire GST on tires to 18%, and similarly on farm tires, it is reduced to 5%, which was previously 18%. So we are bullish, we are positive that our customers, which is tire industry, will make more and more tires and sell more tires in India.
Mr. Badve, same question to you. Have you seen increased orders from your OEM clients, or will the benefit translate with a lag?
So I think there's been good growth across all segments, I think led by two-wheelers and four-wheelers. That was our hypothesis going into this festive season, that two-wheelers and four-wheelers would be the large gainers out of this GST rate cut. And I think a couple of factors that have come together. One is, of course, the pent-up demand up to 22nd September, where a lot of stockpiling was happening and consumers were waiting for the GST rate cut to happen. Second was the festive season itself that is kind of coming through. And third is the GST rate cut. So kind of three factors that are coming together to give this upward swing in volumes in the past couple of weeks in the festive season. And fingers crossed that it goes on in the next couple of months.
All right. Hi, Mr. Chaudhary and Swasthid. Good to have both of you all on the show. Swasthid, I wanted to ask you about the rare earth shortage. Has it impacted your business at all? You know, one of your clients is Bajaj Auto. And I recall in August, they had mentioned that there was some kind of difficulty in terms of production. Has it impacted your business, or is it par for the course and things have moved on since then?
So while we can't comment on any particular OEMs in general, I think in general, the automotive two-wheel industry has been dealing with the rare earth magnet issue. We do feel that there's been a bit of innovation coming in from the OEMs with the development of new ferrite-assisted motors, which are magnetless motors. So I feel that could be one way in which OEMs can solve the issue in terms of scaling production while not being dependent on this rare earth magnet issue. I think apart from that, we're still bullish that the Indian government over time will, take the right steps in figuring out this issue and make sure that the Indian industry in that sense is Atmanirbhar.
Okay. All right. Mr. Chaudhary, coming across to you then. You're sounding quite optimistic with regard to prospects. I think when we spoke the last time around, you all were talking about volume growth of close to around 15%, mid-teens if I remember correctly, with margins in that vicinity of around 13 to around 15%. You hold on to that?
Yeah, we are in the silent period, so I would, avoid commenting on this. But we are looking at a growth of tire industry at 6 to 8% this year. Okay. And we'll have a major share of that pie.
Got it. Yeah, I mean, noted that you're in silent period, but what about exports? You know, because you have a fair bit of exposure to the international markets. Could you tell us, how are things shaping up on that front? Because a couple of quarters ago, there was some difficulty, but you were optimistic that things will gradually start settling itself. Has that taken place?
Yeah, so export is picking up well, and we are on track with our projections on export. Thanks to, there is no change in the reciprocal duty on our product. We fall under Section 232. So the export to US is still going strong, and we are keeping our fingers crossed that there's no new announcement affects us.
Okay, all right. Swasthid, your business, in fact, there's a lot of optimism with regard to the way ahead. And I think one shareholder wish list was that you have an unlisted business, which gradually will start getting folded into the listed business. I think that was supposed to take place at book value. Is there progress on that front? And should we expect something in this fiscal year itself?
Yes. So as we've spoken in the last two earnings calls, we do expect this merging or acquisition between the unlisted and listed entities should happen within this fiscal year. And we don't see any reason why that should not happen. So we are seeing internal progress, but nothing in particular that we can comment on publicly at this moment. But yes, we do feel that in this fiscal year itself, we'll be able to see this happening.
All right, got that. And also four-wheelers, it's a smaller percentage of your mix. Give us a quick guidance out there just to recap. What is the kit value, first of all? What is the contribution from four-wheelers? And how do you see both of them moving up? Contribution to the overall business and kit value as well.
Right. So right now, contribution to the manufacturing business is around 12%. As we had guided earlier, we expect this value in INR crores to double in the next 2 to 2.5 years. So we are still guiding for the same number, which is doubling in the next 2 to 2.5 years. Today, our kit value is close to 45,000 rupees in four-wheelers and commercial vehicles. We've just won a new order last quarter from a large commercial vehicle OEM for one of their larger chassis parts. With that, our content per vehicle is going up from around 45,000 to around 57,000. So it seems like we're doing the right things in terms of making sure that our content per vehicle is going up in commercial vehicles as well as passenger vehicles. And the good thing is that our growth today in four-wheelers and commercial vehicles is quite broad-based. So we have orders from 7 passenger vehicle OEMs and 5 commercial vehicle OEMs. So we are hedged across the industry. And irrespective of how OEMs do within themselves in terms of their rankings, we'll continue to grow given that we have exposure to more than 12, 13 OEMs in both spaces.
Okay, all right, Swasthit, as well as Mr. Chodia, we appreciate you joining in and giving us all those details. As you all mentioned, we're in a bit of a silent period, but both of you all are optimistic on prospects of your individual businesses as well. Post your results, we'll re-invite you all and in fact get a sense with regard to how things are panning out. By the way, LG Electronics, the listing out there at a premium of 50%. So that's even higher than the grey market premium that the street was talking about of around 35 to around 40% approximately. Big uptake. And today, at least 5 notes is what I saw, actually 6 to be precise. And all of them had the target price in the vicinity of around 1700 to around 1800 rupees per share. For the time being, it's starting bang in that zone itself at around 1710. And one more stock, Tata Motors, the passenger vehicle business. I think we should get the rate up for you. That's listed at around 400 rupees approximately. Yesterday was the last day to buy if you want to be eligible for both the shares. Today you have the PV business actually that's listing. So, that as well comes up for you on the screen.
Okay, so the way LG Electronics, the analysts have arrived at it, at 1140, it was trading at about 30 times forward multiple. It was 35 times trailing on FY25, but on FY27, it was about 30 times. But some of the peers were trading at about 40, 45 times. So analysts have arrived at, say, 40, 42 times forward multiple, and then you get a target price of close to about 1800, which is where majority of the target price. I think there's one by MK, which is in excess of 2000 rupees in terms of a target price, but a solid listing coming in on LG Electronics, 1700 plus versus the issue price of 1140. And on Tata Motors, the passenger vehicle has settled at a price of 400 rupees on NSE. I think it's seen a Nomura valuation, and I think that was about 365 for the passenger vehicles. All right, get into a break. As we do that, a quick note for all our viewers. As you can see on your screen, the Moneycontrol stock score just above the line graph. This is a score assigned to each and every stock based on Moneycontrol's multi-factor algorithm. It's calculated by analyzing over 40 parameters, including both the current and historical financial statements, price charts, technical indicator, and each individual parameter is considered for calculation of the 4 factors, which are and those 4 factors are then aggregated to arrive at an overall Q score, Q factor score, a G factor score, a V factor score, and a T factor score. But remember, this is not a buy or a sell recommendation. So anyone who wants to make an investment, please do carry out your own necessary due diligence or go through a certified registered financial advisor. Get into a break. On the other side, K. Suresh of Association of National Exchanges Members of India and Rajesh Baheti of Cross-Seas Capital Services will be chatting with us. The sources tell us that SEBI won't change the weekly options expiry unless data shows heightened and unusual retail activity.
Co-presented by Bank of Maharashtra, Ek Parivar, Ek Bank. Co-powered by National Stock Exchange, Soch Kar, Samajh Kar, Invest Kar. Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI, best है सबको पता है.
Welcome back. We've got the market, which is absolutely flatlined. And we're sort of course, coming up in 10 minutes is going to be the LG listing, the LG Electronics listing. But of course, indicative open is 40, 50 odd point premium on top of the issue price. We reported yesterday in the last hour of trade is that the SEBI's thinking with regards to what they want to do on the derivative side, especially weekly options expiry, which has been such an area of focus for all market participants, has undergone a bit of a change. Or not. Basically, what we reported is this, and this is all source-based information, that changes to weekly options expiry will only be looked at if data that is specifically data from July to September, which SEBI will study, shows significant, heightened, unusual retail participation. SEBI will look at many other measures, things like deepening cash markets, taking away disincentives on longer tenure derivatives, or rather incentivizing longer tenure some of the derivatives contracts, etc., etc. And then basically the bar to act on weekly options is going to be not low, it's going to be high in that sense. The BSE stock, of course, reacted. It's up it was up to 3% this morning. It's come off a little bit from the highs now. We have K. Suresh, National President of the Association of National Exchanges Members of India, Rajesh Baheti, Managing Director, Cross Seas Capital Services as well. Gentlemen, good morning. Great to have both of you here. Mr. Suresh, I'm assuming you've also, and your members, everybody's written to SEBI with your sort of feedback on this, like so many others we understand have. Rajesh, I don't know if you have as well. Thanks for joining us. Your thoughts, Rajesh, to begin this with you.
It's interesting that we're discussing whether we should be having weekly option contracts here or not, while at the same time the GIFT Nifty NSE IFSC has launched daily expiry contracts, and while they've done that, they've extolled the virtues of having a short-term risk management product. So that product can be participated by every retail investor in the world, barring resident Indians. And so I think the debate on whether the product itself has merit or not should be put to rest. Now the question is, how much freedom does the Indian investor get to do with his money versus, the kind of moral arguments that you put forth that overtrading is not good. So the merit question should be put to rest now.
It's interesting the way you put it. Every retail investor in the world except resident Indians, or the product in GIFT Nifty daily expiries. So, what we reported, Rajesh, does it look like the thinking is evolving, and in a way they can sort of are coming around to the industry's point of view, that maybe we need to do other things before we take a hammer to this product?
Absolutely, because when you allow zero DTE options on the international market on the same index, you're telling the world that it's okay to have such short-term trading products. So per se, I think that there is a thinking or rethinking within SEBI that we can't pull the strings too hard on the domestic market. You can't really suffocate the market here beyond a point. And liquidity is one of the main virtues of the capital market versus every other asset class. And you take that away. You take away the one good thing the capital market offers you over and above every other asset class. So I think that thinking is gone now. A realization has dawned upon SEBI and the powers that be. And I think they will find it very hard now to justify that while you have the zero DT products available on the Nifty for every other retail investor in the world, that the Indian investor should not even trade the weeklies.
Mr. Suresh, just wanted to get your thoughts in. So SEBI has indicated that there will be no change unless they see unusual retail activity. Now, what defines an unusual retail activity going forward? What could be the potential metrics? What could be the potential triggers?
Actually, SEBI is not also clear on that point. It's going on shifting its goal. Sometimes it says that fortnight expiry, sometimes weekly expiry per exchange, sometimes only one expiry. Like that, a lot of rumors, being floated. It has affected the stability of the market. As Mr. Bharati said, we are very particular about the stability of the market, and there must be an in-depth study or going down to the root of the cause and fix the issue instead of going on, scouting this may be the reason, that may be the reason, So all are subjective only, or not? There's no objectivity in our studies also. So with the short-term data, how can we fix for the entire thing? This is the best thing what we can do. So in our opinion, going on shifting the goals, or giving rumors to market that this is what going to happen or this is what going to happen may affect the sentiment of the market, may affect the liquidity of the market, may affect the brokers' business model also. That's what we have to understand. Already, brokers' business affected to a great extent.
Mr. Suresh, you and your members have written to SEBI with feedback?
Yes, we have given our feedback to a great extent about what should be done at this
What have you said
No, actually, finally, the tagline of SEBI is what? Protecting the investors. That is the tagline. So instead of compressing the products, instead of compressing the other aspects, they have to focus on how to bridge the gap. So that gap is there always between informed investors and the uninformed investors in the market. I think already SEBI chairman himself said that 36% of the investors are well aware of the market, etc. That means the balance is left out without any knowledge. So here that very important role is nothing but educating the investors is very important. That is the only best solution as far as the market is concerned. Otherwise, we are going on disturbing the what's called the rhythm of the market by bringing in new, fresh ideas, etc., shifting the goalpost, which is not correct. So we have to think aloud on the part of plugging the educational gap, which is very, very important in our view.
Rajesh,
you can bring even entry barriers, you can bring in all those things. I mean, that will help us to have an informed investor as far as the F&O is concerned.
Yeah. Rajesh, we've discussed this earlier as well, and Yash put out in his story, all source pays that they will look at other things to do if they find, at the end of the day, idea is to protect retail, but they will do it through other measures. And what could those be, Rajesh? What would you suggest?
So, if the government really wants to do that, then, the STT on delivery is a very small component of the overall STT collection. Maybe the government should do away with the STT on delivery trading and to encourage more and more trading activity in the cash market. So encouraging another segment is perfectly okay. But you don't encourage another segment by shutting down one segment. I have very strong opinion on that. I've always had. And so we welcome any step. If you want to incentivize the longer duration contracts, if you want to incentivize cash market trading, we're all for it. But not by really putting brakes on another segment of it.
Longer tenure contracts, are there any disincentives right now compared to shorter?
No, so there are no disincentives. SEBI wants to incentivize it. I think one of the things that they put forward is that we don't have correlation margin set-offs yet. We have that extreme loss margin, which is applicable to all positions. So when you do trade options or trade futures, which have a very strong established negative correlation and you're long one and you have very strong positive correlation, and you're long one and you're short the other, there should be correlation set off, which is not available. So these are longer duration positions that can be incentivized by having lower margins based on the correlation and the net delta of your position.
This thing about what you mentioned, right? GIFT Nifty and the one-day option expiries, Rajesh. It's set up as a completely separate market, different regulator, right? Everything is different.
Yeah,
so it's not
theoretical merit and demerit. The theory of finance applies to both, right? So you can't say it's a great product for that segment, but as a product, it's not good for here. So you can argue that we don't want to encourage excessive trading and we want to educate our investors, but you can't per se say that this product is not needed in the country.
Okay, Rajesh, we leave it there. Suresh, thank you very much, both of you, for joining us here with that discussion pointed on, of course, focused on what the market perception now is with regards to these derivatives, weekly options contracts. You heard that loud and clear from Rajesh specifically. LG Electronics listing on your screen, 50% bump up, 1,700. If you can flip that around and look at the market capitalization as well, I think that should be LG now in the 1 lakh crore market cap club, along with a bunch of other companies as well. So that is the NSE CEO and MD, Ashish Kumar Chauhan. There's the Chief Operating Officer, and of course there's the LG team, for sort of ringing the bell along with the NSE officials there as well. So one more global company, global MNC, and of course close on the heels of the other South Korean giant, Hyundai, which listed late last year. LG Electronics is now part of the markets here, secondary markets here. Of course, big volumes as you'd expect. And what we'll do is in a bit from now, look at now this, what does 1710 mean in terms of valuations relative to some of the other players with this 50% bump. So we'll do that in just a bit from now.
There is 1.5 crore pending buy orders on LG, and the sellers are at around 13 lakh shares approximately. So the number of buyers outweighing the sellers by a large margin. And those that got in the IPO, I think 13 shares is what they got. They'll be very, very happy.
Of course, 50% up. What a bumper listing on day one, largely on expected lines. And LG Electronics is a play on India's consumer appliance market, which analysts point out is underpenetrated. But not just that, it's a play on premiumization. If you want to play the consumer discretionary space and you want a premium offering in terms of, the TVs, the inverters, the washing machines that LG Electronics sells, it's on the premium side. So it's a play on premiumization, and analysts also point out because of the localization efforts of the company, margins are also likely to improve. So that's the big one. LG Electronics opens with a gain of 50%, 1700 on LG Electronics versus the issue price of 1140. Get back to the markets, and by the way, markets have come off. The Nifty is now below 25,200. It slipped about 100 points from the day's high, and the problem is the banking stocks. The Nifty banking index has slipped, and in individual names, it's Axis Bank with a cut of more than 1%. IndusInd Bank is weak in trade. SBI has a red tick. HDFC Bank is flat now, but come off from the highs. So banks are struggling a bit. Chandan Taparia, head of derivatives and technicals wealth management, Motilal Oswal Financial Services, is now joining in. Chandan, are you disappointed to see that markets have come off in the first 1 hour, and what would the trade be?
Yeah, good morning. Thanks for having me. So I believe market is rewarding selective stock-specific theme rather than the broader indices. In fact, the Nifty got stuck in a range of 1,000 points from almost last 4 months in between 24,400 to 25,500. And the good part is that we witnessed some recovery in last 2 weeks by more than 700 points, and the base of the market is clearly shifting higher. However, momentum is missing, but I think at lower weeks, this kind of scenario could continue. As of now, we believe that 25,000 to 25,450 is going to be the broader trading range. We have seen some put writing at 25,000, but at the same time, the call writing is also visible. So that is not going to allow the market to move at much higher side. So we have to play the trading band between 25,000 to 25,450. So in that, one can go with buy on decline stance. Now talking about Bank Nifty index, I believe BFSI segment can do better, and Bank Nifty has really outperformed in last couple of weeks. Here the supports are intact, and now till it holds above 56,000, buy on decline could continue for the next leg of rally towards 57,000 marks. So yes, both the indices are likely to be positive to range bound, or buy on decline could be seen after the recent small profit booking from current zone.
Okay, all right, Chandan, what about individual stocks?
Yeah, so I believe selective themes and stocks are doing well. As mentioned that we have positive view on the BFSI segment, and selective financial stocks are doing well. So here I want to mention the name like Chola Finance or Shriram Finance. So Chola Finance is likely to be our first preferred pick, which is given a consolidation breakout of last almost 15-20 days. Major trend of the counter is positive, and the stock is heading towards its new lifetime high territory after a long consolidation of last couple of months. In fact, we have seen built up of long position, and the stock has given a decisive hold above 1650 zone. So fresh leg of rally cannot be ruled out here. One can buy with support of 1625, and this time this counter can head to us 1730, 1750 kind of level. Apart from that, positive on the selective IT name, and I believe Nifty IT has bottomed out, and LTI Mindtree is one of the strongest counter, which has given a consolidation breakout of last almost 8 months. We have seen higher tops, higher bottom on the daily chart. In fact, the put writing is also visible in the counter, so one can buy with support of 5500 for an upside target towards 5800. And last trading idea that is from your metal counters, gold and silver both are roaring high. Gold is glittering, silver is shining, and I believe that will continue to see the positive momentum as per the trend. And I believe Hindustan Zinc, Hindustan Copper, and selective metal counter could see such kind of positive attraction. So Hindustan Zinc would be our preferred pick. The stock has recently given a rounding formation on the weekly chart, making higher tops, higher bottom on the daily scale. In fact, consolidation breakout of last 3 days is adding momentum, so one can buy with support of 510 and expecting 540 in the counter, apart from momentum in gold and silver as well.
Chandan, thanks so much for joining in. But let's put the spotlight on the stock of the day, LG Electronics. How do the valuations stack up versus peers after a 50% opening? Upasana now joins in with the numbers.
Well, it's certainly a blockbuster listing as we all were expecting. Now, the company has listed at premium of 50% at a price of 1,710 versus the issue price of 1,140 per share. Now, mind you, this is entirely an OFS and the promoter has sold nearly about 15% of the stake. Now, if we look at the valuations, the company's valuation stack at 53 times the FY25 EPS as compared to the peers. If we look at their one-year forward PE, which Havells is trading at around 46 times, Voltas at around 41 times, and Blue Star around 46 times. Now, Motilal Oswal expects the stock to trade at a higher multiple given the strong fundamentals and the return ratios of the company. It has initiated a buy with a target price of 1,800 per share, and we believe that this target price is certainly going to be outpaced today itself. Let's see, looking at the momentum. Now, Ambit has also given a buy rating with a target price of 1,820. It says that in terms of preference of the large appliances, it prefers LG, then followed by Blue Star, followed by Whirlpool, and lastly, Voltas in the large appliances category. Nomura has also given a target price of 1,800 per share, and Antique has given a target price of nearly 1,725 per share. So overall, certainly a bumper listing for LG Electronics.
All right, thanks very much for that. It's a strong one, 1,700 plus, holding on, by the way, and of course 30 million from 3 crore shares have been traded at this point in time. We'll take a quick commercial break here. We're going to come back in just a bit from now. And, on the other side, we'll have Manisha with the commodities picture. Silver, I suspect, perhaps will be part of what she wants to talk about. We'll look at other things as well. Stay tuned.
Welcome back. Let's talk commodities. Now Manisha is joining in, and once again she's telling us about the rise seen in gold and silver. Manisha.
Yes, thank you for that. It's not just a rise, it's a record high that we're talking about yet again. And a string of that we've seen in the month of September, and October continues the same way. For gold prices, we've seen 2.5% of gains overnight. 4160 has been taken. We are trading above that level right now. And when you look at the last 1 month, well, gold has seen 13% of gains. If you look at this year till time, we have seen a gain of 59% come in for the gold prices. So this has been the best year that gold is looking at since 1979 in sense of price gains there. Well, what the traders are working with is a 100% probability of a rate cut in December and a 97% probability of a rate cut coming in for the month of October. This seems to be, as of now, getting baked into the prices, and that's what we are dealing with. It also has to do with escalating US and China trade war. It also has to do with the prolonged US government shutdown. All of those factors supporting markets, and the central bank buying also is expected to be very, very strong. Some of the factors that are keeping gold in good favor and at an all-time high as well. Where is gold headed? Well, that's a question that everybody seems to be asking. And in the last couple of days, we've seen reports come in from Bank of America, Societe Generale. They are talking about $5,000 per ounce of a level in 2026, while ETO markets, we spoke to them yesterday, are talking about 4,500 as a possibility in the next year. So strong gains, higher highs is what the markets are anticipating in this year and the next as well. Take a look at silver prices then, and we are trading at an all-time highs onto that one as well at $53 an ounce. 4% of gains in the overnight markets, 25% up in last 1 month, 60% up in last 6 months, and we are trading 85% higher in this year until now. For silver, on one side, it is safe haven and everything that seems to be supporting gold. But for silver specifically, it also is about the rising demand, historic short squeeze that we are dealing with in New York and London's as market. And if you look at the silver lease rates in London, that is at 36% on a month basis, on an annualized basis, if you wanted to borrow money for buying silver right now. So these numbers really seem to be exploding. There also are some reports suggesting that 200 million ounces of short squeeze is what the US banks perhaps could be dealing with. I mean, these are not unsubstantiated reports. There are numbers much higher than this as well. So this short squeeze, low liquidity, low silver available for trading in London and US markets really seems to be bothering. Remember, London for last 4 decades has been the exchange where the world takes silver prices from, but that really seems to be breaking at this point in time. And then it also is about private investment demand. You also are looking at Indian demand for festivals also staying quite strong in the markets there. Bank of America is talking about 65 for silver. We're trading at 53 at this point in time. We started this year with 29, by the way. So these are historic highs that we are dealing with. The US administration also has put silver as a critical mineral in 232 probe. And if it is actually a critical mineral, and if there are some taxes or duties that come in for silver, could be yet another factor that could be keeping silver prices on the higher side. So various reasons to keep buying into silver there. And then you have platinum, which is trading at 12.5-year highs, has gained 4% overnight and is up 89% in this year. Copper as well has gained 6% in the overnight markets. It's up 28% right now. Take a look at palladium prices, and we have seen stronger gains come in for that one, 2-year highs for that, and 78% of gains in this year for this one as well. So everywhere that you look at in sense of precious metals, catalyst metals, all of that is trading at multi-year highs or all-time highs.
Manisha, thank you very much for that. So that is silver in focus. Well, here's a glimpse of India's top market masters, Vijay Kedia, Sridhar Sivaram and N. Jaikumar, joining Mangalam Malu and my colleague Nimesh Shah for a Diwali musical mehfil. Take a look.
So IPO, I will put it again in one of my lyrics, one of my songs I have written on this IPO that I'm going to sing.
Can you spell the lyrics out before you sing the song?
So ऐसा यार कि जहाँ जहाँ आज कल मैं हाथ रखता हूँ वहीं वहीं डबल ट्रिपल मैं कर लेता हूँ रोज रोज सोचता हूँ क्या नया मैं लूँ कोई भी बता दे कुछ भी जाने नहीं दूँ संभल संभल के यहाँ पे पाँव रख तू सालों की कमाई मिनटों में हो जाती छू.
That is very important that you've said, because you know a lot of times people listen to the song and they forget the words that you've said.
Clap for the song and move on.
And then move on.
And they buy more IPOs.
नहीं बाद में फिर मेरे को पूछते हैं सर कौन सा IPO में अप्लाई किया कहीं मिल गया मेरे को ही पूछेंगे. जहाँ जहाँ आजकल मैं हाथ रखता हूँ वही वही डबल ट्रिपल मैं कर लेता हूँ रोज रोज सोचता हूँ क्या नया मैं लूँ कोई भी बता दे कुछ भी जाने नहीं दूं, संभल संभल के यहाँ पे पाँव रख दूं, सालों की कमाई मिनटों में हो जाती चूक, आईपीओ और वाईपीओ से बच के रहना तू, पेनी स्टॉक से आ रही है बड़ी बड़ी बू, इतनी सी समझ के बात आसमां को छू, फिर कभी न कहना विजय टोका नहीं क्यों।
Wow, फिर ना कहना कि विजय टोका नहीं क्यों। Alright, so the message is clear. Hold for the long term. ये है long term, ये है long term, ये है long term मेरी जान. And for you, it is avoid all the noise. Just focus on what you have to. कुछ तो लोग कहेंगे, लोगों का काम है कहना. But the third part, believe in the power of India.
ये जो देश है तेरा.
ये जो देश है तेरा. Oh wow. Let's end on that note.
Let's do. ये जो देश है तेरा, स्वदेश है तेरा, तुझे है पुकारा, ये जो बंधन है वो कभी टूट नहीं सकता, ये जो देश है तेरा, स्वदेश है तेरा, तुझे है पुकारा, ये जो बंधन है जो कभी टूट नहीं सकता.
Well, that is a musical sort of show, and it's a melodious start to Summer 2082. We'll play out excerpts of this through the course of the day, and catch this musical trio all day here only on CNBC TV 18. We'll take a break. On the other side, it's our special Diwali segment. Lata in conversation with Devina Mehra, First Global, and how she thinks Summer 2082 may pan out. Stay tuned.
Well, we continue with our Diwali theme. Welcome to our Diwali special market master. I have an unquestionable market master today with me, Devina Mehra, founder of First Global and author of the bestseller Money, Myths and Mantras. In fact, Devina has just returned from the Kushwant Singh Literature Festival in Kasauli, where she was interviewed, of course, on her book. Devina, thank you very much for joining us and for flagging off my Diwali show. Well, for starters, actually this Diwali we're all entering with a bit of a FOMO. Oh, I wish I had put more money in gold. Oh, I wish I had got the LG IPO. There is a lot of FOMO in the market because secondary market has not made money. Why don't you start by telling us how should we address the gold FOMO?
Okay, first of all, the worst thing you can do in the markets is to have FOMO. So that's the part that always misleads you because we've actually seen the data. If you systematically chase whatever has done well of late, whether it is global markets versus India, gold, or if we go back further, it might have been PSU stocks or small cap. If you have FOMO and therefore you, for example, invest in the next thematic fund that comes along, you will systematically underperform. So if you chase the heroes of yesterday, you will systematically underperform. That's the data. So, and as Richard Branson said, opportunities are like buses. There's always another one coming along. So you don't have to chase yesterday's opportunity.
Fair point, fair point.
Just before this program started, I heard somebody on the channel say that gold has seen the biggest rise since 1979. So let us go forward and see what happened after 1979. So gold made a high in 1980, true enough. But thereafter, it was 27 years before it reached that high again.
Oh.
So that's the story of gold, at least in dollar terms. And in between, so from 1980, if I go fast forward 19 years to 1999, it was still down 60% from the high, 62% to be exact. That's the story of gold. Gold is actually no safe haven. It's been more volatile than equities in dollar terms. But on the other hand, our grandmothers were not wrong to buy the gold for Dhanteras and otherwise. Because at that time, you could not invest overseas. So gold was the only hard currency asset that you could actually buy. So it was very sensible. That was, in real terms, the only global diversification you could get. But now that is not the case. Now you can get through global diversification. So gold should be part of your asset allocation, but it should not be 25, 30% of your asset allocation. I mean, to my mind, for most people, gold and silver should be in single-digit kind of allocation.
Fair enough. Actually, in India, because of the continuous rupee depreciation, we never lose 60%. Even in that period which you refer to, we actually rose 230%.
Yeah, exactly. Exactly. That's the point. So because at that time, you didn't have any other dollar asset that you could invest in, dollar or hard currency asset.
Okay. Now, let me come to the next FOMO, or rather the next fascination of the market now, IPO. And, every now and then there comes an LG IPO, which lists at 50% premium. And then once again, you feel, is this a bubble? Was I wrong not to have, thrown my hat in? Of course, even if you had thrown your hat in, you may not have got it. So can you advise people on how they should approach this ongoing frenzy of IPOs?
My advice would be that when there is an IPO frenzy, when markets are like in the IPO side at an abnormal kind of interest and money coming in, it almost never makes sense to invest in the IPO. The reason for that is that usually when there is the frenzy, first of all, most IPOs will be overpriced.
Yep.
But the second part is that suppose it is a sensible business at a sensible valuation, you're not likely to get much allotment.
Yes.
So this 50% is on whatever you got allotted, but on the money you put in, what did you get?
Yep.
And also it becomes like everybody is just playing the lottery. SEBI data, even this is old data, even 1.5 years ago, showed that if an IPO lists at a premium, 60 to 70% of the individual investors get out within a week. So you are not even looking at whether that company is valued correctly. Also, now this has become, even in a sense, a little more risky because a lot of IPOs have a considerable portion or sometimes even 100%, which is an offer for sale. Yes. Which means that the promoter and the so-called sophisticated investors are getting out at the price at which you are getting in. Okay. And most important of all, there are many new investors in the market who may not know this, that the demand for an IPO at the time of the IPO has absolutely no correlation with how the stock does in the long term. So we all know those stories of Reliance Power IPO where there was this frenzy and then the stock went practically to zero. But even if you leave out those extreme examples, DLF is a good example. The company continued. But after the first few months, that IPO price did not come back for decades.
Yes.
On the other hand, I mean, recently somebody on a podcast said that maybe someone's parents or grandparents were lucky enough to get an allotment in the Infosys IPO.
That's right.
And then I actually messaged that journalist and I said, do you know that the Infosys IPO undersubscribed?
Yes.
It devolved on the underwriters and the money was made by the underwriters. So it can be as extreme as that Infosys, which has been a big wealth creator, its issue was undersubscribed. And a whole lot of issues which do very well, the stocks never go anywhere. And also remember that about 2/3 of the companies that have ever listed on the Indian market no longer trade. They have, as I said, disappeared into the blue yonder. So,
And more so in times of frenzy. The percentage can be, much higher in times of frenzy. Well, point taken. You have to do your homework and do the same math in terms of valuation. Incidentally, I think the LG IPO is only about 35 times. Its comparable companies, Havells and Voltas and all are trading above 40x. So perhaps in this one case, the feeling
only.
Yeah, only 35. You're right. Depending on which year, it can even be, more. Okay, Devina, it is customary to ask where will the market go next year. I know that it's a fool's game to ask, but then, people are disappointed. Over the past year, they've not made money in secondary markets. In fact, at an index level, we are down about 5%. So what's the sense? Are you feeling confident about earnings growth in the next 4-5 quarters?
Okay, first of all, Lata, in 30 years of being in the markets, I have never given a Sensex or Nifty target, either at the start of the new Samvat or in January, because it is a fool's game, as you said, and the term that Daniel Kahneman uses for it is objective ignorance. These are things not only that you don't know about, but you cannot know about. So, I mean, it's crazy to be confident about something you cannot know about. And Bloomberg actually did a study in the US because there the data is available for decades, that what did all the so-called Wall Street stalwarts predict in January and what happened for the S&P 500. So this is like all the Morgan Merrill, Goldman and Citicorp and HSBC, all the people
storied people
know the market. Yeah. So on the average, the projections are off by 15% points. So if they say it will be up 5%, it can be -10 or it can be +20. And no one is anywhere, significantly less than that number. Everybody has a similar track record. Everyone every year projects that S&P will go up between 0 to 10% mostly, because that's a safe place to be in. But in 100 years, the S&P has been in that range only 14 years. So it's crazy. I mean, all the people who are saying whatever they're saying this Samvad, go and see what they said in the last 10 years and what happened.
Fair enough. No, but regardless, do you see, the big problem for us being 5 quarters of single-digit or low single-digit earnings growth? Is it looking like changing because we have put in lower interest rates, lower taxes, lower indirect and direct taxes? So is there a theme now in consumption? Is there a reason to hope for earnings growth here on?
It has been my view for the last few months that you will see an uptick in consumption. See, as it is the consumption trough, the bottom was 23, 24. It was not before 25. But at that time, I was the only one talking about a consumption slowdown because the market was still going up.
Yes, it was 4.4% personal final consumption in 23, 24. You're right.
21-year low. And it was only, people started talking about it when the market started to go down, by which time it had already started to accelerate.
Yes.
And now my view had been, one, inflation has come down. which is a big thing, especially food inflation. Not only the inflation down, in certain cases, the food prices themselves are down, which means that in the household budget, there is more room to consume. Because earlier food was crowding out even daily use items. And the other thing is that inflation coming down, crude coming down, and therefore petrochemical prices coming down also helps the margin level. So for the companies, there is a positive move on the revenue, positive on the margin. My earlier guess was that you would see that uptick in Q2 earnings, the July to September quarter. Now, GST, while it's a positive move, because of the confusion due to the GST in that quarter, and people sorting out what happens to pipeline inventory with distributors, with dealers, and consumers postponing purchases, it may not show up so much in Q2, but definitely in the third quarter, you will see the improvement, I think, pretty much across the board.
Okay. Well, that's good news. That's a good news to welcome the new Samvat. Finally, in your book, one of the big messages you give is don't be wrapped in a single market, single currency investment. I mean, you spoke about globalization. I mean, you're first global for a reason. I think since the Asian crisis, I've heard you speak about, going global. And also that going global doesn't mean going to the US. How just advise our viewers, how do you go global and not just US? Just get into one of the mutual funds which promise you these global investments?
Right now, actually, the mutual fund investment route is kind of closed because the cap has been reached and there is no point buying anything at a premium to the NAV, because the day the cap is moved a bit, you would lose that whatever 10-20% premium. And in any case, if you just want to buy one ETF, you don't need to add a layer of India cost. You can open a broking account and buy it yourself.
Okay.
But there are very few offering true global investments, and even fewer who have expertise in global investments, because we've been doing it since 1999. We've been members of LSE and NASD 99 and 2000. So they're very complex companies, and across the globe, there's a lot of companies. So because it is a cause for me that Indians do not invest overseas at First Global, we actually have a product that starts and gives you all assets, all geographies at $10,000. So that's my kind of contribution to the Indian cause, because private banks don't give that kind of product for less than $1 million.
Fair enough. Okay, that's very useful advice, actually, that such products are available. If it's available with First Global, I'm sure it's available elsewhere, but we need to look at those places. Just a final word, one sector that is exciting you now.
I'm not very skewed towards any sector, but from the last year, we've been overweight auto components and pharma healthcare. We've added a bit more in autos. Over 2025, we've added in FMCG, so we are significantly overweight there also now. Banks we've added, but we are not overweight.
Okay. Well, that's useful advice for those who are planning their own investments. Thank you very much, Devina Mehra, for ushering our Diwali show with so much color and so much useful advice. Have a great summer 2082 yourself.
Thank you, and same to you and the viewers as well. Have a great summer, and respect Lakshmi Ma, don't just worship her. That would be my message.
Oh, great advice. Thank you so much, Devina. That's it on this Diwali special of Market Masters. We wrap up on Bazaar. Chart Masters coming up.
Presented by Punjab National Bank, the name you can bank upon. Co-powered by SBI. Best है सबको पता है. Powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Shares of HCL Tech are higher after reporting its September quarter numbers. The company maintains growth outlook at 3 to 5%, while its advanced AI revenue exceeds $100 million.
And Anand Rathi well trades with solid gains after reporting a good set of numbers. The company's profit rises by 6%. The revenue sees a 9% uptick to nearly 300 crore rupees. We'll be speaking to the management very shortly. Stay tuned for that.
Landmark Cars zooms in trade after a strong second quarter business update. The company's revenue grows 31%, aided by outlet additions and strong Navratri demand.
And shares of Just Style trade under pressure as the company's slow growth continues in the September quarter. The revenue grows in single digits for the fifth quarter, while the profit falls by 22%.
A stellar listing on the bourses for LG Electronics. The shares list at a 50% premium at 1710 rupees against an issue price of 1140. The stock continues to hold higher by about 46%.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel, and with me is Mangalam. Well, Mangalam, the markets opened up in the green. We saw some kind of profit taking. Now it's more or less sideways, but I think the stocks that are deserving special mention is the new listing, LG. Yeah. Blockbuster listing out there. I don't know whether or not, you're going to be getting memories back of Tata Technologies with the stock. We never saw those levels again. There's a lot of euphoria that's playing out there. Obviously, business is very, very different. And the other stock is Tata Motors. Yeah. Actually, the business that's listed has listed at a bit of a premium in comparison to what the street was working with. 380, 390 was the number. I think the last time I checked, it was at around 415 rupees. So, X of the CV business, that's the PV business. A good listing, one would say.
A good listing for Tata Motors as well as LG Electronics. Let's see how that comes about. But the other stock which has been doing well today is Anand Rathi. It's reported a decent set of numbers where the revenues grew. We had a net profit growth of almost 6% as well. But more importantly, the AUM for the company has closed in on that 1 lakh crore mark in the second quarter itself, and the 1 lakh crore target was the end of FY26. What we'll discuss, though, is what explains the slowdown in inflows quarter on quarter, opportunities coming in from subsidiaries, and more importantly, other growth opportunities for FY26 as well. We do have Feroz Aziz joining in. Feroz, thank you so much for joining in. And as always, good numbers. You've been believing in, under-promising and over-delivering. But we have to keep asking you the questions on what the realistic numbers are. First 6 months of this year, you've already done close to 92,000 crores in AUM, or closer to 1 lakh crores. Your this year target was 1 lakh crores. And this at a time when the markets haven't done, a big move. From last summer to now, the Nifty is up just around 4%. So do you believe that you can do about 1.2, 1.3 lakh crore AUM by the end of this year?
Good morning, Mangalam. Yes, like you said, undercommit, over-deliver has been something which has been taught to us by our professional gurus, be the CEO, Mr. Raval or Mr. Rathi. Don't overcommit. That's always been the case. In that backdrop, upping the AUM number, I think, is not something which we will do in this quarter for sure. 1 lakh crore was an aspirational number when we began because we were at 75,000 crores the same time last year. And like you rightly pointed out, markets have not been at the greatest shape, but that's when you need to enter. So what makes us very, very happy is that this quarter we got 100% jump in equity collection vis-a-vis the same quarter last year. When everything was hunky-dory, we were collecting less. When the markets were averaging at 24,500 this quarter, or 24,700 to be more precise, we collected twice more of the money. So if you actually get rid of your emotions and buy low and sell high is when you make money, especially in the long term. So to answer your question, we'll stick to 1 lakh crore as of now and pray to the Lord, because AUM is a mark-to-market number as of 31st March, and that can sway here or there depending on where the market swings. But I think AUM is the last number anybody should look at a wealth management output, because that's at least in Anand Rathi, we measure it very meticulously. Not inflating it. Quite a few people in the industry go to my client who has a couple of 100 crores with me, get an advisory mandate signed for 5 lakh rupees and count that in their assets. That's how AUMs are flouted. I would say revenues and profits are a great barometer because those are bank account credits. And AUM is a number which is very difficult to measure, but Anand Rathi has a specific international measure.
All right, Feroz, hi, congratulations. Over deliver, I think that's been the theme, and we have been observing that as well. So good on you. And by the way, I think I saw you at one of the offsites, getting onto the stage with some rocking music playing out, all set to deliver. So it looks like the team as well is in a good mood, and everyone seems to be happy. But since you said we should be focusing on the revenues as well as the profitability, give us a broad guidance in terms of the revenue growth, the margins we're looking at, what kind of client addition are you looking at?
Yes, Nigel, now that you've brought the lighter note of the offside, I think we were all in a good mood because we were playing TV18 just before we started.
That's the way, Feroz. That's the way.
I love you, Nigel. It's always been a pleasure interacting with both of you. Coming back, I think when it comes to, Nigel, you will have to get your question again.
Yeah, because the revenue growth, the profitability, you said, that's something that you should be looking at. By AUM, the number will take a bit of a back burner. So tell us, in terms of revenue growth, client addition, as well as profitability, what are the targets on those fronts?
Nigel, we have given a 375 crore PAT guidance. We're sticking to that because it's just half year. We have done 194, which is, of course, a margin of 52% penetration in 50% of the time. Revenue also, we have said 1175. We're sticking to it because we believe in consistent growth. So I think the probability of that happening has gone up dramatically after this quarter's result. And the mood and momentum is great. That's point 2. Point 3, we are also expanding our horizons globally. The lucrativeness of India in the minds of an NRI has shot up. That's one thing which we want to capitalize on over the next decade. Then coming to revenue growth, we personally think the revenue growth, and if anyone of our shareholder is listening, which I'm sure quite a few are, I think we look at how do we grow in the highest probability, 20 to 25%. We actually plan 5 years ahead. If you look at our revenues, if I need to grow at 20%, I need 236 crores of revenue per month in 2031 FY. And we plan at least 80% of that. And there is a method to plan in a business like wealth management. Nothing specific to Anand Rathi, but this business is about compounding because 10 to 15% growth is already in the pocket if you deliver good returns for the client.
So it's taken, we take that on board. You have given us the guidance. You always, like you said, under-promise, over-deliver out here. A couple of parameters I'd like your thoughts on. One, the last time you joined us, you said you're looking at least 200 clients per month in terms of an addition. If I look at the second quarter, that 200 per month run rate hasn't, played out. That's one. And secondly, RMs as well. RMs have grown by just 1%. I believe you're now consolidating and looking to grow the existing RM base and grow the revenue per RM as against adding more RMs now. Is that going to be your strategy? So on active client family addition and RM addition, if you could give us some guidance.
Your memory is very sharp, and thanks for that. You're right. I had said 200 new clients per month is what we were gunning for. And first time last month, if I'm not wrong, we achieved 208. So we've not got there at the run rate level. At once at least we have touched that. So will that become our run rate 6 months from now? Very high probability. Whatever we achieve now, within a year, that becomes the run rate. So have we achieved that for the full quarter? The answer is no. I was also guiding it for the subsequent year, but yes, we got to it once at least. Then the second part of your question is how we could probably look at, what was the second part, Mangalam?
The RMs, the RM addition and the revenue per RM.
Yes, absolutely. You're so right. We've actually moved up very small number. We were 374 last year. We are 386. Last quarter, we were 382. What we have tried to do is we have 100 people waiting to become RMs. So we don't believe that 90% of our RMs to have to be bought from the market. Like quite a few people get private equity money, they throw money, get people in, and then when they don't perform, they sack them. That's the one model which people are following. to build valuations in our business, but we believe in training them. So 100 of them are waiting in the queue. We want to have, Rakesh sir has given us a mandate that there cannot be a X number, which is about 80 of the RMs who are still building their book and they've not become private bankers in the Anand Rathi definition. So once that number becomes smaller, then we have more headroom for more seats which are empty. So we want to make sure that we're not biting more than we're chewing, point one. Does it mean that we are slowing down the RMs? The answer is no. What do we aspire to have? In terms of AUM per RM is 223. We want to see that number 5 years from now at 1,000, 7 years from now at 1,000 crores per RM.
All right, we take that point. 1,000 crores per RM is your target from here on. So that's the number that we will take away. Thank you, Feroz, as always, for breaking these numbers down. And when you're not talking quarterly numbers, giving us your help on personal finance on our channel as well. Thank you. We wish you good luck. But as you could see on your screen when Feroz was speaking, there was a Moneycontrol stock score just above the line graph. Now, this is a score assigned to each stock based on Moneycontrol's multi-factor algorithm. It's calculated by analyzing over 40 parameters, which include both the current and historical financial statements of a company, price charts, technical indicators, and some fundamental indicators for each stock as well. Each of these parameters, considered for calculation of the 4 factors, are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. So just note that this score is, which is carried out basis a lot of analysis, is the one that is on the screen, and investors or traders are expected to speak to their advisors and do the due diligence through their own certified registered financial advisor for investment decisions.
Welcome back. You're tuned into Chartbusters. You're on CNBC TV 18. Well, let's welcome Religare Broking's Ajit Mishra for a technical check on the market. Hi, Ajit. Good morning. Good to see you win. Markets seeing some kind of profit taking from the top. What would you do, both on the Nifty and the Nifty Bank? And fill us in with your picks as well.
Yeah, good morning, Nigel. So, yes, we are seeing a bit of a consolidation. So, after last week of rebound, we are seeing more of kind of a consolidation similar to what we were seeing earlier also. Means every time we reach closer to around 25, 450, 600 zone, we see markets start seeing some bit of consolidation. But the good part is now the two key sectors, banking and IT, which was sitting on the sidelines earlier, they have started performing, they have started contributing. So we believe it's a healthy pause, and as long as we are maintaining this higher low structure, one should continue with buy on dips approach. Now 25,050, where the 20 EMA is placed for the Nifty. That's the zone basically where one should maintain a stop loss. And the moment we cross 25,300, because today being the weekly expiry also, we are seeing the call writers are aggressive at that level. The moment we cross, then probably 25,450 to 600 is something that the market is going to attempt. Banking, on the other hand, is looking slightly stronger. Means the private banking majors, we have results also scheduled in a day or two. So we expect that 57,000 is going to be the hurdle in the immediate future. So in case if we get any dip, intraday dip around 56,200, 56,000 zone, that's the zone basically where one can look for fresh long positions. Now coming to the stock specific ideas, we believe that sectors or themes which are holding strong, and from the capital good basket, L&T is one pick wherein we are seeing consistency in the trend. It's gradually inching higher, but after this consolidation range breakout, it's okay as long as we are maintaining the positive tone. So with the 3,700 as a stop loss for the target of around 3,900, one can go long in L&T at current levels. And at the same time, since we are seeing a shorting opportunity also in the market, Indian Hotel after this recent rebound is offering a shorting opportunity while it failed to cross this first hurdle of 20 EMA. And 705 is what we are eyeing as an immediate target. With stop at 739, one can go short in Indian Hotel at current levels.
All right, short in Indian hotels and buy in L&T. Thanks a lot, Ajit, for joining in. With that, we're out of time on this edition of Chartbusters. Thank you so much for watching. Trading Hour comes up next.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal.
Hello and welcome to Trading Hour live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Hormuz Patakia. Hey Hormuz, good morning. Yesterday we ended above the 25,200 mark, but we have failed to maintain that for today. We've come up from the highs, almost a 100-point cut from the highs of the day as well. Right now we are at that 25,186 mark. Even from those levels, after turning into the green for a bit, we are seeing some further fall come by. We are seeing some pressure which has come by from the PSU banking names. Even the pharma pack is not doing so well. What is doing well today? The oil and gas space, we do have some gains coming in from IT as well. The CPSE basket in general is also contributing to the gains. However, all these indices have also come off from the highs of the day. In terms of major movers, ONGC is higher by 1.5%. Although in a conversation yesterday with the media, they did indicate that volatile crude prices are something which could be a problem for these oil producers going forward. But we do have Wipro, which is surging, Tech Mahindra, HCL Tech, all of them are doing well in trade. But the mid-caps, they are underperforming the benchmark. So let's go across to Hormuz. He's going to tell us all the top movers in trade today. Hormuz.
The index may be underperforming the benchmarks, but the stocks are in a league of their own as of now. You take a look at MCX to start off with. And today's move, it's slightly off the highs of the day, though. It's just 5% higher. It gained in 8 out of the last 11 trading sessions now has MCX. We had more than 10 lakh shares that have changed hands compared to a 20-day average of just 1.5 lakh. It's the second straight day of gains as well for MCX, and the stock trading at record high levels and is also nearing that 10,000 rupee price target that UBS has on the stock. And it's been a good performer over the last 3 years, up 51% this year, had almost doubled in 2024 and had more than doubled in 2023 as well. Now the other one that's on the back of news flow is MTAR Tech, and it snapped a 3-day losing streak on Monday. It's building onto those gains, now 12% higher on the stock, and it is the biggest single day gain that the stock has seen in 8 months. The last time it had such a gain was back in February. We have had 6.5 lakh shares that have changed hands, 20-day average of just over 1 lakh, and the stock was up 32% in the month of September and has continued to build on to those gains in this month as well. And as a result of these last 2 months, the stock has turned positive on a year-to-date basis. On the downside today, a stock that comes to mind is AGI Infra, down almost 14% now, and it's down. That was down around 4% in yesterday's session as well, so extending those losses. And take a look at the volume activity here. That trading volumes have been more than 10 lakh shares in each of the last 5 trading sessions. Today too, we have had 10 lakh shares traded. 20-day average is around 7 lakh, and the stock now is below its 50-day moving average of 237.90. That is an important level to watch out for. But it's done well so far in 2025 with 33% higher despite this 2-day down move, and it has had positive returns since 2020. And the last one on the list, an earnings reaction, Anand Rathi Wealth, the biggest single day gain in 2 months. Volumes are the highest in 3 months. We have had 14 lakh shares that have changed hands already. 20-day average here is just 48,000 shares. So take a look at the volumes here on Anand Rathi Wealth. The stock has gained every single month this year since the start of April, and as a result of which its year-to-date returns have now crossed 60%, has delivered positive annual returns every single year since its listing.
Okay, some interesting names there. Thank you so much, Hormuz, for bringing us all those names. By the way, some other movers in the markets. We have Anand Rathi Wealth, which is surging up 11%, and the management just spoke to CNBC TV 18 a while back. They've maintained their 375 crore PAT guidance and 1175 crore rupees in terms of revenues as well. And of course, the other big name that we are tracking closely is LG. It is the big story of the day, the stellar debut of LG Electronics India. Upasna is here with more details on the listing gains and a lot more. Upasna.
Well, certainly it was a bumper listing. The company listed at 50% premium at a price of 1710 per share versus the issue price of 1140 per share. Now, currently the stock is down about 3.5%, trading somewhere around the levels of 1600 per share. Now, let us look at some of the IPO details. Now, mind you, this was not a fresh issue. It was entirely an OFS, wherein promoters sold nearly 50% stake. The company has raised nearly around 3,475 crores from the anchor investors, and even the subscription levels are at a bumper level, becoming the first Indian IPO to cross bids worth 4 lakh crores. Now, if you look at the overall subscription, it was over 54 times. QIBs led the pack. So overall, summing up, it was a bumper listing.
The bumper listing indeed, but Upasana, if you could give us a brief overview of what LG exactly does, how it is compared in terms of its peers. So give us an overview of that.
Certainly. Now, the company's primary business is manufacturing and selling of major home appliances and consumer electronics products in India, and the company has two business segments. That is home appliances and air solutions, which comprises nearly 75% of the company's FY25 revenue mix, and home entertainment division, which is the remaining 25%. If we look at the key categories in terms of total sales, refrigerator leads the pack with 35% share, followed by washing machine at 19%, AC at 21%, and television at 17%. Now, company commands market share in across all these major categories, leading by market share in washing machine at 33%, refrigerator at 30%, television around 27.5%, and air conditioner enjoys a market share of 18%. Now, demand recovery will be led by GST cut. That is one of the important growth trigger for the company going forward, is what the brokerage is also highlighting, with the 43% of LG's portfolio coming under this slab. Now, this will certainly lead to various launches in the mass premium segment, with giving a strong push to the company in terms of its export segment led by the premium products. Now, key risk highlighted by the brokerages include any increase in the royalty by the parent company, any fluctuations in the raw material prices, and even the summing up of intense competition. Now, if we look at the company's key metrics in the terms of financial performance, company's revenue growth is lower as compared to its peer, which stands at 14% versus to the peer average of 19%. But it outperforms in terms of the EBITDA margin, PAT margin, and ROC as compared to the peers. Now, let us look at the valuation. The stock is currently trading at 51 times FY25 EPS. Now, market cap is over 1 crore, but Havells is trading at somewhere 45 times, Blue Star around 40, and Whirlpool over 27 times. So summing up overall, the valuation is in line with the peers is what we are understanding after the listing.
All right, we take that point. Thank you so much, Upasana, for joining us with all those details. In fact, we spoke with the top management of LG Electronics. They spoke about their reinvesting plans in India. Listen into what they had to say.
We are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh, where our $600 million US dollar investment we are doing. We are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in Tier 2, Tier 3 town. Introduction of many new products. We are also scaling up our B2B business. That's our focus area.
The listing of the day, LG Electronics India. We'll take a short break, put the spotlight on the crypto markets. On the other side, Manisha Gupta joins in with Sumit Gupta, the co-founder of CoinDCX.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Welcome back, and joining us now is on Crypto Corner is Sumit Gupta. He is co-founder at CoinDCX. Sumit, hi, thank you so much for joining in. First of all, the kind of volatility that we seem to be coming back with over the weekend and this week now, how are you reading into it? Because the year 2025 has been amazing, and then you see a huge sell-off to the tune of $18 billion. How should one look at it?
Manisha, yes, indeed, the markets have been, crypto markets experienced a turbulent and volatile weekend. And the markets are cyclical and volatile, as we all know. But when we talk about some of this sell-off, it was mostly triggered by a lot of traders where, because of the Trump putting a tariff on China and because of cascaded liquidations, people sort of, we saw the market coming down, but who did not get impacted is long-term investors. And I think such periods of volatility will come and go. But what is important is that to invest and trade depending upon the profile of the customers. For investors, it didn't matter, like myself, for people who want to do intraday trading, for this was an opportunity as well as a moment where some of the investors essentially had to book a losses.
Sumit, how would you look at investors' discipline, especially when something like this happens in crypto market, which is more volatile than various other asset classes? Would you look at near-term and a long-term as two separate portfolios?
Oh, yeah, absolutely, Manisha. I think near-term investing is basically where people are taking a view on 1 day, 1 week, 1 month. I think this is more of, short-term view, which is what is more related to trader profiles, people who want to do trading either in spot or in derivatives. On the other side, people who have a longer-term view, which is 1 year, 3 year, 5 year, or 10 years, they need to look at like long-term horizon, and a lot of these volatilities actually doesn't affect their portfolios as well. So most of the customers, even on CoinDCX, are long-term investors who are not impacted by any of such market volatility or market moves. And they can just allocate some bit in Bitcoin and just wait for like 3 to 5 years to play out and see how the portfolio is doing. And I think long-term investing is of course better for anyone who doesn't understand the nuances of the markets well.
Oh, absolutely. Going forward now, when we look at 2026, Sumit, what is it that you would want to look at? Because much of the scenario that has played out in 25 seems to be spilling over in 26 as well. So whether it is about macros, tariffs, dollar declining, other some asset classes like gold and precious metals doing well, how are you reading into the new year?
Yeah, Manisha, I think we've seen gold, silver, Bitcoin all pretty much close to all-time highs. I think this is triggered by a lot of geopolitical uncertainty that we see all around the world, tariffs getting imposed every week, and as the uncertainty increases, I think store of value assets like Bitcoin, gold, and silver will continue to cross and breach all-time highs. I do expect a positive momentum in at least next 3 to 6 months, while all of this uncertainty is around us globally, geopolitically, and a lot of things are unstable. And when things are unstable, a lot of these asset classes, which does not have to do with any specific region or a country, they tend to do generally better.
Sumit, we are nearing Muhurat and Diwali and Dhanteras, and this is the time that you see a whole host of things being bought and invested into, whether it is about currencies and commodities and equities, and cryptos have found a place within as well.
Oh, yeah, absolutely. I think Bitcoin was largely ignored asset class, I think, until 4 years back. But now, it seems to be picking up momentum. I've seen good activity, good Bitcoin buying activity, just like how people used to buy gold. During Dhanteras, you've seen a lot of that happening on CoinDCX last Dhanteras. This time, we're expecting even more. Looking forward to that. And this time, interestingly, like I buy Bitcoin every Dhanteras. My dad does it. He's a big believer and, very, very bullish on Bitcoin. But this time, interestingly, my mom has decided to take a good chunk in Bitcoin as well. So I'm looking forward to going to Indore and help her out with that.
All right. Well, you are changing generations there, aren't you? Not just the younger ones, but the older ones as well. Sumit, coming on, how much of a portfolio should really have crypto or Bitcoin within it? Because a lot of people are just waking up to the fact that, well, yes, there can be other things in your portfolio as well, especially when you want it more reasonable and more profitable.
Yeah, absolutely. I think, look, if someone is new and does not understand the nuances of the crypto markets better, it's always better and safer for someone to start their journey with Bitcoin only and take a very small chunk of Bitcoin as part of your overall portfolio, understand it, spend time reading about it. And when you get comfortable with the broader, thesis of why Bitcoin is valuable, why limited supply asset is the right store of value, then you can gradually increase your exposure depending upon your risk appetite. But I do strongly believe that it's a good opportunity for people to also understand and invest in digital gold, which is the Bitcoin of the for the young generation, this is a very popular asset class. So, yeah.
Oh, absolutely. And we've seen those numbers talk for themselves as well. Thank you so much, Sumit, as always, for joining in and making sense of what's happening in the space and, of course, on how the new traders should really be looking at the space. But with that, that's all the time that we have on this segment. Take a break, come back and talk about more markets and stock specifics on the other side.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Well, Nifty is down 100 10 points as we speak. 25,120, that's the mark that we are looking at. And that fall has been quite smooth from the highs of the day. So we have JSW Steel, one of the major movers there. And Nifty is at the day's low as well. So in last couple of minutes itself, we've seen Hindalco seeing a cut from the highs. Geo Financials, NTPC, Bajaj Finserv, Sun Pharma, ITC, Kotak Mahindra Bank. Most of these stocks are at the day's low, pushing the Nifty lower as well. So we'll keep tracking that for you. The market breadth not looking very strong, not in favor of advances at all. But let's talk about happy things, because Diwali is just around, and here's a glimpse of India's top market masters, Vijay Kedia, Sridhar Shivram and N. Jay Kumar joining Mangalam Malu for a Diwali musical mehfil. Take a look.
The other asset class that I have been speaking about is gold.
Yes.
And there are a lot of skeptics in the market about gold. In fact, in the last 1 week, I've seen more skepticism on gold than anything else.
Are you really talking about skepticism in the gold? Because we here, on the other hand, a lot of people actually saying, oh my God,
I buy
gold,
ETF?
should I buy
silver
gold?
So the people, I'm guessing that the people who missed out on the gold rally, they come out with, random data that, how gold has underperformed between 1980 and 2000, how gold is a very volatile asset class. And in most cases, they sort of give out a dollar return number, whereas it is for the Indian investor, it is the rupee dollar, rupee gold that matters. And as I've said many times, that gold actually is a store of value and also is a hedge against currency. People miss the hedge against currency. So if you go back to 1980, the rupee was 9 rupees. Today it is 85 rupees. So you've got a compounded return of 4 to 5% just on currency. So if I want to put it in a song, I would put it in this way. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल। महफिल ये नहीं तेरी, दीवाने कहीं चल। कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल।
Last 1 year, the Nifty has actually gained just about 4%. Gold is 60%.
Plus, 60%.
Silver is, I think, even
also, yes.
Much higher than that. So you had a nice repartee to that. What was that?
श्रीधर भाई को ये बोलना चाहता हूँ भाई कि ठीक है, ये तो गोल्ड मैन है, अपने बोल्ड मैन है। तो मैं इनका बात का जवाब दूंगा कि ना चाहूँ सोना चांदी, ना चाहूँ हीरा मोती, ये मेरे किस काम के। ना मांगू बंगला बाड़ी, ना मांगू घोड़ा गाड़ी, ये तो है बस नाम के। लेता है शेयर ले बदले में सबके, लेता है शेयर ले बदले में सबके। ओरे साहिबा शेयर से सौदा नहीं।
क्या बात।
It's a nice contra to what
So the next 1 year, how do you foresee the next 1 year when it comes to earnings, when it comes to the macros, when it comes to micros? If I had to ask you to bet on a few themes and a few ideas, what would they be for, say, summer 2083 when we hopefully gather once again for a mehfil?
So I'd like to talk about 2 or 3 sectors. My number one sort of bullish case is for banking. I believe that when any economy reopens up or opens up for foreign capital, banking is the first space that will attract money. So I think NBFC consolidation, money coming into private sector banks, more and more deals like the Yes Bank kind of deals, I think we'll get to see and hear over the course of the next few quarters.
The ones that have fallen so far? Or?
I think it's not a question of follow. I think these are platforms that can't be replicated. Like NBFCs, there are infinite number of NBFCs in a manner of speaking. But there are a finite number of banking licenses, no new licenses to be given. So I think banking sector could attract disproportionate amounts of capital as people, especially foreign banks, come in to take stakes in the Indian context. I think that's going to be a big theme going forward.
And you can catch India's top market experts share their insights as we enter Samvat 2082 all day today on CNBC TV 18. Welcome back. 100 points lower now on the index, taking the market conversation forward with Jyotivardhan Jaipuria from Valentis Advisors. Jyoti, good morning. Thank you for joining in. Festive greetings to you, your family and your team as well. I'm sure you would be very impressed with what you just heard from our market experts. But going into the next Samvat, what is your advice for investors, especially because of the fact that the last Samvat has been a forgettable one, if you could call it that, considering the lack of returns?
Yeah, so like a year ago, we said that the market is like going to have a largely time correction and some price correction. We've seen a classic time correction. So I guess the index is more or less flat in the last 1 year. The small and mid caps have given a negative return. So going forward, I think, we'll still have a more flattish sort of market, but with a positive bias. So I think, probably if you look a year down the road, we'll probably be up, maybe low double digit from here or high single digits. So when the 8 to 12% mark, we'll get a positive return coming through. So I think, that's the good news, that a lot of the time correction has happened. We've not got a return. And next year, the return will be good. At the same time, it won't be a spectacular return, which we saw, post-COVID, which people got used to a bit.
I think that's become the problem, right? That everyone's so used to those post-COVID returns that they expect it to happen every year, but that's not the reality, right? Jyotivardhan, in that case, you said time correction has already happened. Any specific sectors or stocks that you think are back to the reasonable valuations and we could see an uptick from here on?
Yes, one would be the banking sector, because, if you see the banks, even the September quarter won't be good. You have, NIMs under pressure. A lot of this has to do with the lead lag effect that, whenever rates start to get cut, then you see, your deposit rates taking a long time to get cut, but real lending rates cut easily. So, the first quarter for most banks will be a negative quarter, a negative first half, but the second half should start seeing a recovery, and next year, we should see earnings go back to normal. Valuations here are reasonable. In fact, it's one of the few sectors which trades less than a 10-year average valuation. So most sectors, if you see today, if you take a 10-year average valuation and look at where they are today, most of them are at a premium to 10-year averages. The market's also at a premium to 10-year averages. But banks are one sector where they're trading at a discount to the 10-year averages.
Jyoti, what do you make of the rise in gold prices? The way the prices have moved, both gold and silver, to zero it down, your gold financiers in that case, do you believe that this quarter or the upcoming quarter as well could be a fairly decent one for these companies?
Yeah, it will be a decent one for these companies simply because, their collateral value has gone up. So the key now is whether, gold continues to do very well next year. Because, after any asset class which goes up 60, 70% in a year, then there's a period where it tends to cool off and consolidate. And so that is probably where one is looking at. But otherwise, the gold finances will have a good quarter or two going forward also. They've done well in the last, 2 quarters, as we know.
Okay. Just important flashes at the bottom of your screen. While we are talking about gold and silver doing really well, gold and silver futures have fallen from the highs of the day. So, of course, that is something which is expected as well. But the biggest question still remains whether these dips are to be bought or, this is a pause on the rally that we are seeing. But that we'll keep tracking. For now, if you look at the ETFs, the gold ETFs, they are still higher. And at a point in time, we did see silver ETFs. They were trading at a premium to physical price of silver as well, and that's the reason a lot of mutual funds, they stopped subscription to their ETFs. Kotak Mahindra, Kotak AMC, we had ICICI, all of them doing that as well. For now, again, these are doing really well, all these ETFs, 7.5% higher on Grow Silver ETF. Nippon India is also seeing gains of around 5.5%. But Jyotivardhan, you spoke about banking is the one which could see an uptick, and that is one sector that will benefit. Anything else that comes to your mind? For instance, new listings that we have, LG, already a 50% premium there. In that entire space, do you think there is something which stands out in general?
So, in general, the consumer sector looks good, especially the discretionary part. We don't like the consumer staples even now, but just given the GST cut which has come in and the fact that, this year there's a big income tax debate which people have got. So there's like roughly a 1 lakh crore debate which you got. So, that whole consumer durable space is one space which will benefit in terms of, demand picking up. So it would be probably consumers, it could be the autos, but it's a combination of these where people will spend some of the income. My view is like, people will, so there are two ways people always think of is the entry car which will benefit. But probably what I am sensing is a lot of people may straight away want to go a little higher than the entry car into a more premium segment. And same way, in the consumer durables also, because now prices have become cheaper, you may find that some of the premium brands are doing better than, some of the just entry level brands. I think, that's what we are seeing across the board where people are wanting to get into premium stuff very, very quickly.
Jyoti, pleasure having you as always. Thank you so much for sparing time and joining us, and festive greetings to you once again. Take a short break. More on the markets on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour on CNBC TV 18 with a lot of action happening in the F&O space as well. So let's get in Mangalam to get us all the trends. Mangalam.
Well, so it is a Tuesday today, which means it is weekly options expiry for the Nifty, and a lot of volatility cannot be ruled out. But for now, we've seen the first hour itself see a sharp fall from the highs for the frontline indices. So the Nifty Bank, the Midcap index, all of them not in a very good mood if you're a bull. So that's why we're seeing a fair amount of selling, and that's reflected in a couple of other parameters as well, the mood of the market. The first one is the India VIX. Remember, the start of the week, the India VIX was sub 10, and now it's gone towards 12. It's 11.5 right now. So after a 10% rise, we've seen that higher by about 4.5% in today's trading session as well. So closer to 11.5. The second part that we're looking at is the market breadth. For the second, third day running, the market breadth is firmly in favor of declines as against advances. So now nearly 2,000 stocks in the red for about 800 stocks which are in the green. So those lines far and wide apart after having crisped and crossed. So that is an important part. It wasn't like just a trend day where the red lines were above the green line right from the start, but now it is crisped and crossed. So that makes it a little more difficult for the bulls to make a comeback. But who's to say they won't? Because if you look at the day's high on the Nifty, what's interesting is what would happen with the 25,200 mark last week and the week before that is now happening with the 25,300 mark. So structurally the market is moving higher, but only consolidating at higher levels. So October 10th, the high was 25,331, thereafter 25,270, and today is 25,310. And that's where the option writers for today are positioned themselves at as well. 25,300 call, the premium all but eroded. So the bulls believe that this is a mark that they can't achieve. Bears believe this is a mark that they will hold. 25,200 call writers also fairly active for a premium of almost 35-40 rupees, telling you that they believe that 25,250 may perhaps also not come by. But at the lower levels, bulls are holding their horses for the 25,150 level. So the 25,150 put fairly active in today's trading session so far, telling you that 25,100 could be an important support, at least on the way down. So what is it that the option writers are expecting? The Nifty expiry range between 25,100 to 25,250 thereabouts. That's the broad range for the frontline index. And be that as it may for the frontline index, a lot of individual stocks are also seeing some long positions being added. So IREDA, MCX, ICICI Pru, all of them have added a fair amount of long positions. They're well bid in today's trading session. And among the stocks on the downside, you don't see as much shorting as you are seeing long unwinding. So KFIN, for instance, has seen a lot of long positions being unwound. In terms of short or shorting individual stocks, there isn't a case of one or two stocks which has seen a big amount of shorting. So that's a good part. That tells you that we're consolidating at high levels, and right now we're testing the lower levels of that consolidation at high levels.
Take that point. Thank you so much, Mangalam, for joining in. While we're talking of markets coming off from the highs of the day, that is something which is happening with precious metals as well. Silver, for instance, you're seeing those flashes. Silver has fallen nearly 5% from the day's high. Gold continues to be higher, but silver prices, which crossed that $50 an ounce mark last week itself, that is seeing some profit booking right now. And we are seeing that because of lack of availability of silver, physical silver, it is trading at premium as well in terms of the mutual fund numbers and physical silver as well in some places in the country as well. Hinzing, of course, is in focus. It is one of the biggest producers of silver in the country. So that stock will be on your radar. But of course, we'll keep getting Manisha as well to get you an update on silver prices. For now, we'll slip into a short break. When we come back, we'll talk more about markets on the other side. Stay tuned for that.
Welcome back. 80 points lower on the index, but the bigger highlight of the last 10 minutes has been the sharp fall in the prices of gold and silver. Silver now is below the $50 mark, and gold is also below the $4,100 an ounce mark, and that has shown an impact on all of these gold and silver plays. You take a look at Manappuram, take a look at Muthoot, take a look at Hindustan Zinc. All of them have come off the highs of the day. Then you can see the correction that you've seen in silver, now almost 7% off the highs of the day. Take your leave on this edition of Trading Hour. From Sonal and me, thank you for watching. Halftime report on the other side.
Co-powered by SBI. Best है सबको पता है. In association with Think Equity, Think Motilal Oswal. Co-powered by SBI. Best है सबको पता है.
Stocks see a further dip ahead of F&O expiry today, with mid-caps bearing the brunt of the selling. Consumer durables, realty and healthcare are the big drags.
And LG Electronics India lists at a thumping 50% premium to its offer price of rupees 1,140 rupees, making it the latest member of the 1 lakh crore rupees market cap club. Attractive valuations, dominant market positions and a healthy growth runway see analysts give it a thumbs up.
HCL Technologies pips revenue and margin estimates and posts a robust over 40% quarter-on-quarter growth in orders. It also guides for continued strong order inflow and services growth. The IT major also becomes the first to report AI revenues.
Tata Motors passenger vehicles business, including JLR, kicks off trading in its demerger avatar today, commanding a market capitalization of rupees 1.5 lakh crores. The pure play commercial vehicle arm will list on a later date.
Hello and welcome to a half-time report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it's turning out to be a session where we are definitely seeing some amount of pressure in the market. So we have the Nifty, which is just about lower by around 73 odd points at this point in time. And we have the mid-cap index, which is down around 0.6% as well. But we do have the WPI September data which has come through. So it's coming at around 0.13% versus 0.5% on a month-on-month basis. So that's basically the preliminary number that has come through at this point in time. We will wait by for the internal details, but in the meantime, we do have Sakshi Gupta, who's the Vice President and Senior Economist at HDFC Bank, who's joined in to discuss this. Sakshi, hi, welcome to the show. If you could just take us through, the decline that we've seen. It's a little bit of softness that we've seen in terms of the WPI. How does it stack up versus what your estimates were for the month of September?
Hi, good afternoon. Thank you for having me on the show. So you're absolutely right. This number on WPI at 0.13 is actually lower than what we were estimating for the month. Our forecast was close to 0.7%. So clearly, it's a downward surprise. Look, over the last couple of months, we have seen that WPI inflation has been moderating, and the moderation has been very, very broad-based. Right, so you've seen, metals, basic metals, crude oil prices, natural gas prices, all these items cool off. Moreover, even food inflation, which is, part of the primary articles within WPI, month on month, they've been coming down. That is reflected even in the CPI data. So broadly, from a wholesale perspective, I think this inflation number, again, is a downward surprise, and we expect that over the coming months, given the global commodity prices trajectory, plus, how, food inflation domestically has been progressing, I think both these, suggest that wholesale inflation will remain in, sub 1%, also for the remaining part of this year.
Okay, sub 1% for the remaining part of the year is what we could watch out for. But Sakshi, also right now, like you're mentioning, food inflation, actually this time we're seeing a deflation, 1.99 downtick. That's a negative number there versus 0.21% on a month-on-month basis.
Yeah.
What should we watch out for here? Do you think that this deflation will continue here on the food side as well?
Well, I would expect, this, there are base effects, etc., that tend to influence the, monthly numbers. So in certain months, you could get, deflation for food inflation. But, broadly, my sense on food inflation is if you even look at mandi prices, you look at how, food production in general has been in this, summer cropping season and the last two seasons. There is sufficient supply in the market, which is causing food prices to remain very, very low. And the momentum on the food side is both reflected in the WPI as well as the CPI numbers that are coming out. Moreover, even on the global side, If you look at, food prices globally, you look at commodity prices locally, or you look at globally, or you look at metal prices. I mean, there is a general, moderation and certain sections, a deflationary trend that is being, observed.
Okay. How did gold prices tie into this number, according to you, Sakshi, and what might be the impact going forward?
Well, look, for gold prices, yes. I mean, in the month of September, we did see gold prices actually inch up. This has been a story on the gold front for a number of months now, right? So it is, to a certain extent playing a role. But I think gold prices tend to have a bigger influence on the CPI series that we track. And on the wholesale front, basic metals, etc., have the largest weight when we are looking at, manufacturing wholesale inflation. So I think that bit has been very, very soft and has outweighed any sort of upside pressure that you might see from gold. I think gold is a story more dominant when we are looking at the retail inflation basket, where consistently we have seen that core inflation has been, sticky, has been actually moving up. And we saw the recent numbers that came out for September that, gold prices were pushing up core inflation, over the last couple of months.
Sakshi, just now with the CPI number that's come in yesterday as well as today's WPI number, now what could we start seeing coming in from the Central Bank of India, the RBI side? What should we see from that front?
Look, undoubtedly in the last policy, the central bank has, talked about the fact that, inflation trends do suggest that now there is policy space that is opening up for further rate cuts. I think that we closely watch out for the October inflation print, which I think can be sub 1%, and depending on the GST impact, it could be a very, very low number that could come in. So that would further kind of strengthen the argument for the Reserve Bank to look at perhaps a little bit more of policy easing, through the repo rate, through the policy rate. And I think that the December policy is a live policy now. Clearly, moderating inflation does provide space for the central bank to act and provide some amount of, further support for, domestic growth.
So I'm just going to quickly ask you about your rate cut estimate for, say, the next two meetings, or what you're envisaging in the next 3 to 4 months. But just before that, wanted your thoughts on the GST rate pass on. You said that the CPI number could be much lower than expectations because of the GST cut pass on. But is that going to be sustainable, according to you, Sakshi?
Look, so, of course, this will be a one-time impact, right? That will, where there is a change in price, and then it will be in the system for the next 12 months, right? So depending on the pass-through of GST rate cuts, your overall inflation trajectory for the coming 12 months, till October 2026 could actually come down. Right. So you're right that this is a one-time thing, that will pull down the inflation numbers. But from a monetary policy perspective, look, ultimately, it implies that your average inflation for Q3, Q4, and then Q1 next year is, of course, going to be, much lower. So, for instance, I am expecting inflation to average at 1.8, 1.7, 1.8% for Q3. With a downside risk to my forecast. And Q4, I'm estimating below 4%, so 3.9%. While this is temporary, but it's still going to be there for the next 1 year at least.
Okay, and quickly, if you could just pencil in what you are estimating from the RBI in the December policy, and maybe in the meeting after that as well.
Right. So I think that my forecast for the policy rate in both the December and February policy is really contingent on some of the growth data that comes out, high frequency indicators for October, November. I think if we continue to see some amount of disappointment, in terms of domestic recovery and the push to consumption from GST rate cuts, Plus, if there are no positive news on the tariff front, then I think December is a live policy, and we could see the RBI cut the policy rate by 25 basis points. In the December policy. I think February right now is a little, still a lot of unknowns for us to make an educated, forecast on what happens in the February policy. As things stand today, my sense is that the RBI has space to bring down the repo rate down to 5% if required and if growth, severely disappoints over the coming months.
Okay, all right, Sakshi, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us your perspective in terms of the CPI data, which has come in for the month of September at 0.13%. We have the core CPI, which has also come in at around 1.3%. So that's the data which is coming in 1.3% versus 1.7%. So there's a softening which has really taken place in terms of core CPI. We'll take a short break. On the other side, we'll focus on the healthcare sector and connect with Kevan Moovdawala of EY, Parthenian India, and Varun Khanna, who is the Group MD, Quality Care India. Stay tuned for that conversation. Welcome back. Well, you're still tuned into Halftime Report this afternoon, and it is turning out to be a session where there is definitely pressure for the frontline indices as compared to the as compared to at least the mid-caps at this point in time. So the mid-caps are under pressure as well, so down around 0.8% currently for the mid-cap index. The advanced decline ratio has been extremely negative from the get-go, so we have around 680 stocks advancing to around 2,170 stocks declining at this point in time. And as you can see, there's a huge gap between the red and the green line, indicating that the breadth of the market is definitely on the negative side. Some news coming in from KEC International. They bagged orders worth around 1,064 crores in the international TND business in Saudi Arabia. So positive news coming in for KEC International. That stock is holding up with a gain of around 0.3%. But let's shift focus to the entire healthcare space, the hospital space. A recent EY report says India's healthcare sector has made major progress when it comes to access, capacity and affordability over the past 2 decades. But what is the way forward, and how exactly do the PE funds stack up in the entire hospital space? We have with us Kevan Movdawala, who's the National Healthcare Leader, EY Parthenon India, and Varun Khanna, who's the Group MD, Quality Care India, Care, Kims and Evercare. Basically, he's the MD of that particular consortium. Gentlemen, thank you very much for joining in. Kevan, well, I'm going to start with you. Your report is very comprehensive in terms of outlining the growth of the Indian hospital space. But if you look at it in the past 5 years odd, it wouldn't have probably been as rapid and as fast if it wasn't for the private equity money that came in. Do you think that was the key catalyst?
Oh, absolutely. I think we are a large population with a high disease burden, right? And scale is a key imperative for the healthcare system. And pricing services for enabling mass consumption, like we've seen in other sectors like telecom, retail, is really going to be important. This needs deep pockets, Ekta, or long-term players with a future commitment in healthcare. That will take time. And we all know that healthcare is a high capex investment area with a high gestation period. The private sector, enabled and fueled by private equity, has made these rapid strides, right? So on one side of the equation, driving ARPOBs of 35 to 40,000, which is really value healthcare at the core. And also on the other side, innovating the business model. The median return on capital employed of the top few players was 5% 5 years back. It is 13% now. These are dignified returns, Ekta, despite serving the affordable agenda for the country. And cost innovation is in our DNA. And what private equity brings in access to capital to set up beds in underserved areas, in tier 2 markets. And that's the juggernaut which has really been fueled by this capital.
All right. Varun, I just wanted to get your thoughts on this particular private equity piece in the hospital space, because if you look at it, a large amount of the conglomerates or hospital companies in India now either have some private equity investment, or many of them are even controlled by private equities, and the control seems to be switching from one PE fund to another PE fund. So just before we get talking about the report a little more, just wanted your thoughts in terms of what the way forward would be when it comes to the holding structures of a lot of these hospitals in India. Will it be PE run? Do you think that that's only going to incrementally rise from here on?
So first of all, thank you, Ekta, for having me on the show. I think the way I see healthcare is not PE run, it's management run, but PE invested. I think that's the way first I see it. See, I think carrying on what Kevan said, Ekta, a lot's happened in India. I think we should understand what's really fueled this access. So, and access has been enabled in this country, and I still don't call it completely because it's not equitable enough. But the way I see it is that we've doubled our bed capacity over the last decade and a half. And we're still not there. We're still about a bed to 1,000 people, whereas the need is significantly higher. We are almost half of what our bed capacity should be compared to the global averages. And when I say the global averages, I'm not taking the Western world or the highest averages. So to develop that kind of access, we need a lot of capital to come in. I think private equity has been able to bring that capital, and we need to enable sustainability as well, because no one's going to bring in capital if sustainability doesn't come in. But the good side is that now India, with that money, is being able to develop access in tier 2, tier 3 cities. As I said, when essentially we saw private healthcare coming in over the last 2 odd decades, it actually went to tier 1 first. Let me ask you this question. If you look at healthcare 3 decades back, and I was on the other side, on the receiving side of healthcare, when I went for my dad's transplant, India would do transplant in 3 to 4 cities. Today, the same procedure and more complex stuff is also available in significantly more cities in this country, and I think India needs that. I'd see, and again, when you look at the frugality that India has been able to show to the world, I mean, we still deliver very high quality healthcare at $300 to $400 per day. Those are the kind of ARPOBs that we run in India, it cannot be compared. I mean, there's no other place in the world, and I'm talking about again the developing world. I was in Indonesia, a year ago. I used to run hospitals there, and same GDP per capita. When I see the cost of healthcare in Indonesia, it's actually 3 to 5 times of what we have in India. So I think in India, we've been able to show the world frugality. It's now time to show a mix of frugality and quality. And I think that is being enabled by a lot of people who are looking at efficiency and quality work.
Absolutely, Varun. Important points made there. I'm just going to pick up a point from here, what you were making, is that there is still some more growth that is still left, a lot of room for growth versus other peers globally. Kevin, coming to you, then does that mean we'll see more funding that will come in? And tier 2, tier 3 city side of hospitals or healthcare, will that see the key focus now in terms of investments?
No, very much. Even today, while Varun spoke about the fact that we are 1 bed per 1,000 on an average, what we really measure is quality bed density per 1,000. The metros today are probably 0.5, 0.6 per 1,000. The tier 1 cities are sub 0.2 per 1,000. So there is this huge demand-supply gap which is there. And, we've covered this in the report. I think the India of the next 25 years is going to be very different from the India today. 49% of our population is going to be above 40, right? Versus 23% at the beginning of the decade. That's 82 crore Indians. And of that, more than 30 crore are going to be above 60 years. Right, we're seeing the whole onset, and I would say we need a crusade in a way against the non-communicable diseases. Right, today 60-65% of our disease burden is in the non-communicable disease space, and what we are also seeing, unfortunately, comorbidities, right? 5% of our population today has more than 2 conditions, right? And that's going to go up to 20-25%. So that's a huge change that we are seeing. The advantage that we had is very soon going to become, a crisis situation over the next few years. So until we focus on longitudinal care, prevention, preserve our cost advantage, our healthcare spend as a percentage of GDP is going to double, 7% of GDP, which a country like ours can't really sustain. If we focus on these themes, right, we can still limit it to 5%, closer to something where China is at, and we'll probably need another 1 million beds. We'll be below 2 beds per 1,000, and that's the right mantra for a country like ours to really drive mass healthcare at the last mile.
Right. Well, Varun, before we let you go, this report also highlights the challenges that Indian hospitals face. And if you talk about challenges in the recent times, there has been some amount of friction with insurance companies and hospitals, possibly because of the lack of revision of rates and receivables piling up. Where does that situation stand with hospitals and insurers at this point in time? And just an additional part of it is that the CGHS rates were revised very recently. How beneficial is that?
I think, again, the macro picture is slightly different from what you currently read. I think I won't go much into the last quarter. But macro, if you look at it, the out-of-pocket, which used to be 80-odd%, out-of-pocket expense in healthcare used to be 80-odd% a decade and a half ago. And that's now gone down to 39-38%, which is incredible. For a country like India, can you imagine 60-62% of the people are getting healthcare, which is not funded by them? And I think kudos to 3 things that have enabled that. One is the insurance schemes that the government has run. Universal healthcare programs today are making it affordable for the common man or accessible to the common man to get into a hospital. Second, I think the insurance penetration, which is the private insurance penetration, is getting better. I think it's moved into low double digit now from single digit, which is pretty good. So about 200 odd million people have private insurance outside of what their companies would insure them for. And then, of course, there are these state schemes which are again enabling that access. Now, again, sustainability is key to growth. We've all been talking about developing the 1 million odd beds that the country needs in the next 7 to 10 years. That has to be enabled, and that can be enabled only by three things. One, the talent being there. So our industry is nothing but talent, technology, and infrastructure. And when I look at talent, I think we should thank the education system that we are today enabled by that talent. We'll be producing 1 million odd doctors over the next 7 to 10 years, which would mean that we can enable 1 million beds because each bed needs a single doctor to come in. Outside of that, the other two that I spoke about, which is technology and infrastructure. See, the cost of technology and infrastructure in India is the same as now anywhere else in the world. We still import the technology, and infrastructure in India is no longer cheap. Today, buying land and building, it doesn't. So I think all of that is a business cycle. And yes, we've had challenges in the past where rates have not evolved. They haven't gone up. Even medical inflation has not got covered. So I think that's something which is now happening. There is rationalization that's happening. On CGHS, it's a very important step. I think we've been talking to the government about it, and we are very happy that government has really enabled that.
Absolutely important points made there, Varun, as well. Sorry, in short of time right now, but thank you so much, Varun, as well as Kevin, for joining in with us. An interesting chat there, a longer chat later on at some point of time. Thank you so much for joining us. On that note, we're going to sip into a very short break, and here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV 18 app now from the Apple Store, Google Play Store, or you can scan the QR code on your screens. Welcome back to Halftime Report on CNBC TV 18. As of now, the markets have shifted to the day's lowest point, 25,090. So yes, that's where the market and Nifty is trading at, down almost 0.5% in today's trading session. We're seeing a fall coming in for a Natco Pharma, especially in the last 30 minutes. Electra Green Tech, that's another one that's come down. Also, and furthermore, decline is what Electra Green Tech is seeing as well. So keep an eye out on that one. And obviously, in terms of top losers today, we do have Gaza after its numbers. That's sulking in trades. Agility, Dixon Tech, all these stocks are under pressure. But yes, markets at the day's lowest point as of now. On that note, we're going to slip into a very short break. On the other side, we'll be joined by Manisha Gupta, who will be speaking with Krishna B. Goya of a Gem and Jewelry Export Promotion Council. Stay tuned in for that conversation.
Welcome back, and joining us on the show now is Krishna B. Goyal from Gem & Jewelry Export Promotion Council, and also Dwarka, a company that they own. Mr. Goyal, hi, thank you so much for joining in. And first of all, what is your sense on the silver prices itself? All-time highs, a bit of a correction is what we are working with in the European markets right now. But how do you look at the price moves from here?
You see, basically, if you look at the silver, Manisha, the overall production, and there is gap in production and demand. We have lower production and higher demand. The industrial consumption has grown a lot. So I see that it will strategically always keep on moving upwards. There are certain course corrections which you may see, because right now what the jumps that we are looking at, they are unprecedented, because every day there is so much of fluctuation in the prices that has never been witnessed in past. But logically, silver is bound to grow.
All right. Mr. Goyal, when we look at the price trends, it's trading in a backwardation, meaning that the spot is more expensive than the futures market right now. Do you see this trend sorting itself in weeks or months to come?
You see, right now, future is, because as I've told you, if you look at just last 1 month, there has been a rise of about 25%. I mean, it was trading at 41.25 per ounce a month back, and we are seeing it as $51 per ounce today.
Right.
So this much of rise will see some course correction. So for a long-term investor or long-term buyer, silver will be a good asset base. So I see that prices are bound to go higher, even if they are showing the futures lower than the spot.
All right. Mr. Goyal, also the important thing is on how the demand really has been, because we understand that the physical silver in India is trading at a premium. What is that premium right now? Is it difficult to get physical silver on hand?
Yes, actually, there is difficulties in market. There are the supply is actually disturbed because of this sudden increments in the prices. I mean, yesterday the premium was at a particular point of about 40,000 rupees per kg, which has been never there, you know. Today, if anyone goes to buy even 10 kg of silver, they are finding a hard time to buy. There are certain reasons for it, you know. Earlier, the imports were not in restricted category. So recently, government has put silver and gold both in restricted category for import. So one need the import license. So earlier, the exporters who were freely importing the gold and silver, they need to have the advanced license for their imports. So that has added, along with the prices, that has added the disruption in market.
Clearly. Mr. Goyal, what is the demand that is seen right now? Is retail buying silver at this point in time? Are they buying bars, coins? And how are you then preparing for Dhanteras or Diwali buying that people do in sense of silver?
You see, basically, the demand is there, and when the prices are in such fast increasing trend, even the consumer wants to protect themselves for their Diwali gifting or for investment purpose. We as jewelers, we already foresee what kind of market or demand we expect during the festival season, and we prepare ourselves months back. You know, all this crunch of supply is recent. I mean, this we are witnessing from last 10 days. So all the jewelers, for that matter, they are covered. But yes, even for a jeweler, it is a challenging time, because say if we have sold something in the morning and in the evening when we want to replace it, We don't know at what price we are going to buy it and whether we'll have supply or not. So they are really very challenging times today.
Well, as you said, Mr. Goyal, this is something that you haven't seen in perhaps a lifetime career. That's what we are looking at in the Indian markets when it comes to silver.
Well, yes, definitely, Manisha. Unprecedented times when we've seen this take place with gold and silver. Thanks very much for joining in and taking us through that conversation. Well, we need to take a short break on that note. But before we do that, just a quick word on the markets, because the Nifty has now breached 25,100. So 25,080 is currently where the Nifty is at. It's down around 0.6%. So definitely turning out to be a day which is much more volatile than anticipated. So the Midcap index currently is down around 0.8%, and the advanced decline ratio, like we've been pointing out, has been on the weaker side. A lot of stocks in focus. So we are seeing financials which are under pressure at this point, with the Bank Nifty, which is down around 0.6%. Only around 8 stocks gaining within the Nifty at this point. Take a break. Be back with more. Stay tuned.
Welcome back to Halftime Report on CNBC TV 18. While markets are seeing a bit of a downtick, but Diwali is just around the corner, and here's a glimpse of India's top market masters. Vijay Kedia, Sridhar Sivaram, as well as N. Jayakumar take part in Diwali musical महफिल with Mangalam. Take a look.
मेरे को ऐसे लगता है कि I'm bullish on tourism. I think now government is awakening that and bent upon giving all this promoting domestic tourism. So मेरे को लगता है tourism से related जो भी shares हैं, चाहे उसमें airlines आ गया या ticketing वाले आ गए या hotels वगैरह आ गए,
even airport business, airport business,
हाँ वो भी आ गया और लेकिन सब expensive है, कोई भी सस्ता नहीं है, लूट का माल नहीं है यहाँ पे, सब ये सब पसीने का पैसा है यहाँ पे, तो लेकिन जब भी मौका मिले तो मेरे को इसमें tourism में ठीक लगता है और मेरे को hospital industry मेरे को ठीक लगता है.
Hospital and hospitality.
हाँ, hospital and hospitality.
Alright, and Sridhar, you've said gold hedge against currency, hedge against inflation, store of value.
I think I'll put it slightly differently because I followed the emerging markets for many years now, almost 25 years now. And I've seen the ups and downs of India right from 92 when I started. For about 8 to 9 years, India gave no returns. But over the years, if you see on a longer term period, India has been one of the best performing emerging markets. So I think a lot of people are worried that we haven't given returns this year. But I think it's a very short term view. If you look at 5 years, 10 years, 15 years, 20 years, India has done phenomenally well and possibly in the top 2 in terms of dollar returns. So I would say that just bet on the country, bet on India.
Just bet on the country, just bet on India.
And in fact, if there's something that I could describe in the way things are changing, which is the only constant.
Yeah.
And of course, as I said, musically, since that's the theme for the evening, Har Ghadi.
All right, let's do this.
हर घड़ी बदल रही है रूप जिंदगी छाँव है कभी कभी है धूप जिंदगी हर पल यहाँ जी भर जियो जो है समा कल हो न हो. So the time invested in the markets is important.
Yes. Rather than timing the market.
Rather than timing the markets.
Yes.
Perfect. And
तो अच्छा समा कल क्यों न हो?
We are at 2,500 per capita. So whatever, 2,800. I mean, in the next 10 years, this can only go up. Our GDP will easily double, triple over the next, say, 10 years. So just that will take the markets up. Just the fact that we have such a growing economy.
But we have to be clear that we need to separate the signal from the noise.
Of course.
Yeah.
Any number of people will say a lot of things, and I know that that's important. My guests here have talked about to be careful about India, but one of the things I would like to say is this participation has resulted in a massive amount of hearsay and people saying, I heard this, ye ho jayega, wo ho jayega.
so I'll ask you to hold on to that thought. So he's speaking about India, you're speaking about a lot of noise, so noise to signal ratio has to be improved, and he often speaks about the long term. He's been speaking about the long term, saying ye hai long term, ye hai long term, ye hai long term, meri jaan. So let's end with all of y'all giving your investment philosophies through a song. Let's start with you, sir.
कभी मैक्रो कभी माइक्रो कभी स्लो डाउन कभी स्केल कभी यूएस कभी चाइना कभी झगड़ा कभी मेल टेंशन के हैं कई नाम यहाँ जरा हट के जरा बच के शॉर्ट टर्म में मेरी जान है दिल है सिंपल कमाना यहाँ यदि लॉन्ग टर्म बस लॉन्ग टर्म ओनली लॉन्ग टर्म मेरी जान.
And you were saying signal to noise ratio. What is that?
On a somber note, कुछ तो लोग कहेंगे लोगों का काम है कहना छोड़ो बेकार की बातों में कहीं बीत न जाए रहना कुछ तो लोग कहेंगे लोगों का काम है कहना.
All right, so the message is clear. Hold for the long term. ये है long term, ये है long term, ये है long term, मेरी जान. And for you, it is avoid all the noise. Just focus on what you have to. कुछ तो लोग कहेंगे, लोगों का काम है कहना. But the third part, believe in the power of India.
ये जो देश है तेरा.
ये जो देश है तेरा. Oh wow. Let's end on that note.
Let's do. ये जो देश है तेरा, स्वदेश है तेरा, तुझे है पुकारा. ये जो बंधन है वो कभी टूट नहीं सकता.
Welcome back. Well, for the markets, the advance decline ratio, there's no sort of improvement which has taken place there. It's at 1:3 at this point in time on the National Stock Exchange and 1:2 on the Bombay Stock Exchange. In terms of key indices, Nifty has recovered back to 25,100. So that's a positive sign, but it's still down around 124 odd points. Let's see whether that sustains or not. And there's a tad bit of a recovery which has taken place for the mid-caps. So maybe there is some amount of buying which is taking place at lower levels for the mid-cap index at this point as well. Well, on that note, it's a wrap from the entire team. Thanks very much for watching. Business Lunch will come up next. Stay tuned.
Co-powered by SBI. बेस्ट है सबको पता है. Co-powered by SBI. बेस्ट है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes and Hindware Italian Collection designed for Sukoon.
Stocks see a further dip ahead of the F&O weekly expiry today, with Midcaps bearing the brunt of the selling. Consumer durables, realty and healthcare are the big drags. LG Electronics India lists at a thumping 50% premium to its offer price of 1140 rupees, making it the latest member of the 1 lakh crore rupee market cap club. Attractive valuations, dominant market position and a healthy growth runway sees analysts give it a thumbs up as well. HCL Tech pips revenue and margin estimates and posts a robust quarter-over-quarter growth of around 40% in total deal wins. It also guides for continued strong order inflow and services growth. The IT major also becomes the first to report AI revenues. Tata Motors' passenger vehicles business, including JLR, kicks off trading in its demerged avatar today, commanding a market cap of around 1.5 lakh crore. The pure play commercial vehicle arm will list on a later date. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I am Hormus Patakia. If you are a bull, it's not a pretty looking screen as of now, not for the index, not for the broader markets as well. The Nifty has seen some extended selling pressure over the last 60 minutes. It's now broken below that mark of 25,100. Over the last two sessions, the index had comfortably defended that 25,150 mark on both occasions, be it on Monday, be it on last Friday as well. But it's not to be in today's trading session. As of now, the index trading 140 points lower, nearing the lows of the day at around 25,080. The Nifty Bank was the principal culprit of the start of the fall on the Nifty somewhere around 11:30 in the afternoon, and that too continues to remain around about the lows of the day, 350 points lower on that as well. The selling pressure though is visible in the broader markets, be it the mid-cap index or the small cap index. They are the ones that underperformed yesterday. They are the ones that are underperforming today as well. 460 points lower on the mid-cap index, 1% down on the small cap index as well, both on the lowest point of the day. But on the earnings reactions front as well, we continue to see reactions. IREDA has done well in terms of results. Anand Rathi Wealth has also done well in terms of a result reaction, 10% higher on that stock as well. But the listing of the day, possibly the stock of the day as well, LG Electronics, a stellar debut, 50% premium to its issue price. Upasna is here with more on this. Upasna.
Well, certainly it is a stellar debut. Now the company is listed at 50% premium at 1710 versus the issue price of 1140 per share. It has raised 3,475 crores from its anchor investors, and in terms of subscription also, it is at a bumper level. It is the first Indian IPO to cross bids over 4 lakh crore rupees. Now, stock is currently down here about 3.54% at nearly 1650 levels, and which is trading currently at around 51 times the FY25 EPS. Now, when we compare it to the peers, 1 year forward PE, which trades nearly around 40 to 45 times. Now, in terms of financial matrices versus the peer, the revenue growth for the company is lower versus the listed peers at an average rate of 19%. But the company certainly outperforms in terms of its EBITDA margin, PAT margins, and even ROCE, which is seen highest among the peers. Now, let us look what the brokerages are saying. Now, Motilal Oswal expects the stock to trade higher given the higher multiples, stronger fundamentals, and even return ratios. Nomura expects a 10% revenue CAGR from FY25 to FY28, driven by multiple products, exports, and even service initiatives taken by the company. Now, Ambit has also given its line of preference in terms of large appliances. It prefers LG, followed by Blue Star, Voltas, and Whirlpool in the large appliances category. Now, coming to the target price, Ambit has given a target price of 1820, but MK has given the highest target price, that is 2050. So overall, it's a good listing and it's a all consensus buy.
All consensus buy indeed. Upasna, thank you for that. In fact, we did speak to the management and they spoke about their reinvesting plans in the country. Listen in.
We are reinvesting here in India. We are coming up with our third plant. It's in Sri City, Andhra Pradesh. Where our $600 million US dollar investment we are doing. We are doubling up our capacities. We are investing in new products, new technologies. We are also investing to improve the retail infrastructure in tier 2, tier 3 town. Introduction of many new products. We are also scaling up our B2B business. That's our focus area.
The other stock that is managing to hold on to some gains as a result reaction is HCL Tech, and that is after its results and multiple brokers coming out with notes, of course, off the highs of the day for HCL Tech as well. Rima is here with more on this. Rima.
So HCL Tech has reported a good Q2 after a disappointing Q1. Revenue growth 2.4%. EBIT margins expanding 110 basis points to 17.4%. Both revenue and margins coming in ahead of street expectations. The deal wins robust, expanding 42% quarter on quarter to $2.5 billion. And brokerages are either bullish or neutral. So some of the calls that we have, Jefferies, Nomura, CLSA, all bullish. They've pegged the target price at 1660 to 1730. And some of the reasons that have been highlighted for the bullishness is the services guidance for HCL Tech stands at 4 to 5%. And Jeffrey says that with this, although it's just 4 to 5%, it will still be the fastest growing large cap Indian IT companies. And they've raised the EPS estimates by nearly 1%. But, going ahead, what, CLSA and Morgan Stanley point out is that margins need to expand. So current margin guidance is 17 to 18%. But in the past, the company used to operate at higher margins. So when, the roadmap or what the company says about getting back to those 18, 19% kind of margins will be the trigger for further re-rating from here on.
Rima, thank you for that update. And while addressing the media after its results, HCL Tech's MD and CEO spoke about their overall performance in the quarter and their strategies with regards to artificial intelligence. Listen.
Our revenue grew 2.4% sequentially, as well as 4.6% on a Y-on-Y basis in constant currency. Our advanced AI revenue this quarter exceeded $100 million mark, representing approximately 3% of our revenue. Our operating margin came in at 17.5%. Our margins grew 116 basis points sequentially and is the result of the recovery plan we had shared with you last quarter. This quarter, we clocked in a booking of $2.6 billion, which was well balanced across service lines, geographies, and verticals. This is the first time we've crossed the 2.5 billion mark without any mega deal. We also signed 2 large deals, which we mentioned were delayed last quarter.
And the other one that has been on the radar all through the morning has been Tata Motors. And this is, of course, after the demerger of its commercial vehicles business that is now taken place. And Sudarshan is here with more details on this. Sudarshan.
So Tata Motors demerger scheme has got effective today, and now on the screen the price you are seeing is of Tata Motors passenger vehicles. So for commercial vehicles, it will be listed only after a month or say a month and a half, that is 30 to 45 days. Now, what would be consisting of Tata Motors passenger vehicles? So JLR business, India passenger vehicle business, and the stake that company holds in Tata Technologies, that will be part of Tata Motors passenger vehicle business. In commercial vehicle business, both truck and bus business would be part of Tata Motors commercial vehicle. So what's the value that brokerages have put out? As per JP Morgan, passenger vehicle business total, JLR, India passenger vehicle business, and the company's stake in Tata Technologies, value as per JP Morgan is rupees 392 per share, and for CV business is 306 per share. As per Nomura, PV's value is rupees 365, and for CV, it's rupees 367. And as per Nuvama, PV value is rupees 410 and CV it's rupees 280. So today Tata Motors passenger vehicle business lists at rupees 400 per share. Now if you derive the price for commercial vehicle business, it comes around rupees 260 per share.
Sudarshan, thank you for that update. And now on to some macros. India's CPI and WPI inflation have surprised to the downside. Now, the September CPI figure came in at 1.54%, which is at an 8-year low, while the wholesale price index has come in at 0.13. Now, both are well below the RBI's mandate. Lata is here with more on this. Lata.
Well, there has been a persisting downtrend in practically all inflation indexes. The number that has just come out, the wholesale price index at 0.13%. Food inflation is like minus 1.99, minus 2%. Fuel is minus 2.58. And manufacturing index, which you may think perhaps will not be as bad as food, is just 2.3%. The important point to note is that the WPI, the wholesale price index, has not gone above the 4% mark since October of 2022. That is the last time we saw a 4.4% index. In fact, for a better part of these 4 years or 3.5 years, the WPI inflation has been below 2% actually. The September CPI, consumer price inflation, which is the one that's more important because policy, the Reserve Bank's interest rate policy depends on the CPI, that came in at an 8-year low of 1.54%. That number came yesterday. The core CPI, which is, taking out the volatile food and fuel elements, that came in at 4.5. But even that's not a scary number because this 4.5 includes gold. If you take off gold again, even the core CPI comes in below 4%. Now, after looking at the September CPI, most people are forecasting the October, the current month CPI at 0.5%. I mean, as low as that, and maybe November will also be below the 2% mark. So the point is, the way inflation is undershooting, even after Reserve Bank pulled down its forecasts. For July, August, September, now the average stands at 1.7. The Reserve Bank's forecast after being pulled down from 2.7 was brought to 1.8, and we have undershot even that. So it's a persistent undershooting of inflation below forecasts. Now the Reserve Bank's full year FY26 number, which was brought down from 3.7 to 2.6, may have to be brought down to 2.3 or 2.4. The 1 year forward inflation, which RBI normally refers to while setting rates, was brought down from 4.9 to 4.5 for the June quarter. Now they have to bring it down to 4%. So much of an undershoot. All this is leading economists and market participants to believe that the December RBI policy just has to announce a rate cut because of the persistent fall in inflation below the Reserve Bank's own forecasts, and even the 1 year forward looking much more reasonable than it looked before. So that's the big takeaway, and a rate cut in December.
A rate cut in December. Latha, thank you. Expectations of a rate cut, of course. Latha, thank you for that update there. We'll take a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Onto the big international story that we are tracking today. All living Israeli hostages in Gaza have been released by Hamas and are back in Israel after 2 years of war. A group of 13 hostages were escorted across the border by the Israeli military after a group of 7 hostages were released earlier. US President Donald Trump declared that the war in West Asia was over before his trip to the region to finalize a peace deal for Gaza. CNBC's Dan Murphy gets us a wrap of all the updates on the Gaza Peace Summit.
President Donald Trump returns to Washington after brokering a ceasefire that has really set off emotional reunions and also fresh hope for peace, not just inside Gaza, but also inside Israel as well. And under this US broker deal, Hamas has released those final 20 living Israeli hostages held in Gaza. In exchange, we've seen Israel also beginning to free nearly 2,000 Palestinian prisoners as well. Of course, we also saw President Trump going on to Egypt in the aftermath of his address to the Knesset inside Israel as well, where he declared that the war in Gaza is over and also urged a turn towards peace for the region. He framed this moment, and I quote here, as an historic dawn of a new Middle East. Of course, inside Egypt as well, he was met by other world leaders. He signed a vision statement on Gaza's post-war future, basically focused on rebuilding, humanitarian access and regional guarantees as well. But of course, as you say, there are plenty of questions that remain. Here's the president speaking on the ground in Egypt.
That Gaza's reconstruction requires that it be demilitarized and that a new, honest civilian police force must be allowed to create a safe condition for the people in Gaza. As I said earlier, I intend to be a partner in securing a better future. We're going to be working, you're going to be working with the United States, and we're going to make sure that the Middle East is going to be a safe and secure place. It's a very important place in the world.
Take a short break. More news and updates follow on the other side. Stay tuned. Welcome back. Now, this year's Nobel Prize for Economics has been announced. Joël Mokyar, Philippe Aghion and Peter Howitt won the 2025 Nobel Prize for Economics for their work on how innovation and creative destruction can drive economic growth. Now, the trio will share the $1.2 million prize for explaining how technology gives rise to new products and production methods which replace old ones, leading to better standards of living for people. With that, we call time on this edition of Business Lunch. We still leave you with the Nifty down 130 points in the final 2 hours of the weekly options expiry. Midcap radar on the other side. Thank you so much for watching.
Co-powered by SBI. Best है सबको पता है. In association with Prakash Surya Steel Tubes and Pipes. And Hindware Italian collection designed for Sukoon. Co-powered by SBI. Best है सबको पता है. In association with Aditya Birla Capital.
afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Vinny Motiwala. Vinny, good afternoon. Well, we started on the back foot and that has continued as well. Nifty around that day's low mark. We've recovered from the lows of the day, but still it's a 113-point cut. The mid-caps are underperforming and we have a lot to track on the show today.
Absolutely, a lot to track on the show. On that note, let's get started with the top headlines then. And starting with the markets, the stocks like we're seeing see a further dip ahead of the F&O expiry today. PSU Bank, metals and consumer durables are the big tracks.
Broader markets bear the brunt of selling. Both mid-caps and small-caps indices are lower by more than 1%.
Anand Rathi Wealth trades with gains after reporting a steady set of Q2 FY26 numbers. The company profit rises 6% while revenue sees a 9% uptick to nearly 300 crore rupees. Net inflows down 22% on a quarter-on-quarter basis. Management tells cnbc TV 18 that they are maintaining revenue guidance for FY26.
IREDA gains on strong Q2 earnings. Profit after tax surges over 40%, while net interest income is up by nearly 50% on a YOY basis. Okay, all right, those are the top headlines for the markets. As we pointed out, it's a 100-point cut on the Nifty. It is at the 25,120 mark. The mid-caps are underperforming, 0.8% cut there. And the advanced decline ratio, just look at that graph because that is indicating way more declines worsening the advancing stocks. Around 660 stocks which are advancing versus around 2,200 stocks which are declining. So there was a crisscross around that 10 a.m. mark, and that has continued to widen by the hour as well. Nifty IT is dragging the index lower. We do have all the sectoral indices in the red as we speak. PSU banks, metals, media, realty, all of them being the top losers today.
Absolutely. Like you're saying, top losers over there, most of the sectors, all of the sectors trading in the red as well. So keep an eye out on that. But on the positive side, we have CE Infosystems. Let's just pull that up because that's gaining again for the second consecutive day. We had those tweets that came in from the Ministry of Railway in terms of MOUs. That is something that we're keeping an eye out on. Anand Rathi Wealth in terms of numbers, IREDA, Foss Motors, some of these are basically trade. So a lot of moves that is coming in over there as well. But in our segment, mid-cap movers, we now have Ria joining with us to take us more of these stocks that are buzzing in the mid-cap space and what is happening and the reason behind that. Ria, over to you.
Well, yes, when you're first starting off with the gainers, we have MTAR Tech holding on to gains of around 10% after that 13% move that we saw early in the session. And this is after Brookfield has backed Bloom Energy, which is MTAR Tech's key client, with $5 billion for fuel cells to power AI data centers. There's also Anand Rathi Wealth up around 7.5% after gaining around 11 to 12% early in trade. They've seen a good set of numbers in Q2, and they are also on track to achieve their AUM growth guidance for the year, despite a 22% sequential decline in their net inflows this time around. MCX India also going up by around 4%, extending its gains on active bullion trade. Landmark Cars also seeing a gain of around 9 to 11% after the total revenue of the company jumped by nearly 31% on a year-on-year basis. IREDA also seeing a gain of 3.5% after the net interest income of the company went up by nearly 50% on a year-on-year basis. Moving on to the losers then, Dixon Tech is down around 4% after Phillip Capital has issued a sell rating on the stock with a target price of rupees 9,085, which is a 47% discount downside from yesterday's closing price. And they have said this on the back of declining volumes in the company's key product Motorola. Natco Pharma is also down around 3.5 to 4% after the Supreme Court has agreed to urgently list Roche's plea on the Risdiplam launch. Other losers in trade today include Sagility, Bandhan Bank, as well as Reddington, which is extending its fall after yesterday's 3% fall, down around 3.5% today as well.
Take that point. Thank you so much for bringing us those names. So those are some massive movers in the broader market. Thank you, Ria, for joining in. Let's slip into a short break now. When we come back, management of Puravankara will join in next to discuss the FY26 outlook. They just released their Q2 business update as well. So that and a lot more after this short break. Welcome back. You're still tuned into Midcap Radar. Puravankara, that is the stock on our radar, released its Q2 business update. The pre-sales during the period were up 4%. Ashish Puravankara, who's the managing director at the company, is joining us now to discuss more. We'll understand their FY26 sales outlook going forward. Will they now expand via joint development, redevelopment, or more organic land buys? And the debt position of the company, considering that they are also on an expansion spree. Ashish, good afternoon. Thank you so much for joining in. The uptick that we saw this time in pre-sales, 4% higher, was it pricing-led or did you see similar increase in volumes as well? Can you give us a breakup of that? And what was the volume growth this quarter?
Yeah, so in terms of pre-sales for Q2, we've achieved about 1,322 crores of pre-sales, which translates to about 1.5 million square foot, which is again about 4% higher year on year. In terms of customer collections also, I think we were up. We had a customer collection of almost 1,047 crores. For the half year, we have achieved about 2,445 crores worth of pre-sales, which translates to about 2.75 million square foot and customer collections of about 1,906 crores. Very important to note that all these pre-sales numbers have actually come in from ongoing sustenance projects. We still have to see the benefit that in terms of sales contribution from our new launches, which are all slated for Q3 and Q4 of the year. From Bombay, from Pune, from Bangalore and Cochin markets.
Okay, so pre-sales right now is not factoring these new launches that you've planned. Ashish, afternoon, Q3, Q4 then, what is the anticipation in terms of pre-sales numbers that we could expect? Could it go to the double-digit mark? And overall also, have you already started seeing the pre-sales coming in from the redevelopment projects as well? If you could just give us an indication there.
Sure. So in terms of the new launches that we've planned, it's about 15 million square foot over the next 12 to 15 months. I would assume about 65% of that we should be able to achieve, I think, by March itself. So if you take that number and if you see our past history in terms of pre-sales of newly launched projects, we've been able to get almost a 70 to 80% of the phase that's been launched in the first 2 quarters. So that contribution should be quite healthy. Let me put it that way. In terms of redevelopment projects, as of now, we have not launched any, but we should see a launch in the next 2 months. All approvals, which is Lokhandwala, Pali Hill, which is Bridge Candy, as well as I think Malabar Hill, etc. I think we should start seeing the launches starting from 2 months from now. But all approvals are in place.
Ashish, how does it differ for a developer when you're going to launch, say, a redevelopment projects? What's the impact on the balance sheet in terms of cash flows? Do you need more capital for doing this? If you can explain that to investor, because now that will start showing in your books as well.
Sure. So pre-sales mimic what we traditionally do as joint development. So there is no huge upfront capital investment in terms of buying a land outright, but it is essentially your approval costs. And then once you get your approvals, the corpus fund that we contribute to the society, as well as their annual rentals as per our each transaction. So it's typically about 10 to 15% of the land value. As opposed to buying a land outright. So very low on capital upfront investment for society redevelopments.
Okay. So how much will redevelopment be as a percentage of your overall portfolio, say 2 years down the line?
So currently what we've secured is about 4.25 million square foot in Mumbai for redevelopments. The GDV of that is about 10,500 crores. But we are actively growing and quite aggressive. We are in fact now pitching for at least 6 more projects as we speak. But I think the brand has been received extremely well in the West region. So in spite of healthy competition, we're able to secure these marquee locations. So we should see this number only grow.
Okay, you'll see this number only grow. But Ashish, from here on, so in terms of expansion plans that one could watch out for, would it be more JDAs? Would it be buying land, redevelopment side? What would the focus area be? And how much cash would you require for expansion? How much do you have in your books? What is it that we're watching out for now?
So I think if the half year gone by is any indication, I think we have done aggressive business development where we have secured projects, 2 in Bangalore and 2 in Mumbai. with I think a square footage of about 6.25 million square foot, with a GDV of about 9,100 crores. In terms of strategy, I think the combination between outright society redev or a joint development, I think the micro market in the city defines it. So, for example, if you have to grow within the Mumbai city limits, I think the biggest opportunity here is the society development. But now, if you go to the outskirts, like for example, Thane, etc., there you're able to secure vacant pieces of land, industrial land, etc. So that typically will be an outright. An outright is always, while there is an upfront investment to buy the land, but is always a cheaper option in terms of costs than a joint development.
Okay, we take that point. Ashish, then what's the kitty set aside to take up the expansion plans? What is the updated debt number? What would it look like by the end of this year?
The net debt, I think, at the end of Q1 was about 2,845 crores. In fact, there was a net debt reduction of about 128 crores. I don't see that number on the residential front going up significantly. It would all depend on the commercial portfolio. So currently, we're building about 3 million square foot of commercial office space in Bangalore. So the construction finance required to complete those projects, would lead to some expansion in terms of the debt number. But as they get completed, which is slated for anywhere between I think March and April of this year, and you start leasing, you convert that debt into lease rental discounting at a much cheaper cost, which is generally the format for commercial development. But on the resi front, I don't see that number going up too significantly.
Okay. Ashish, just one thing, pre-sales FY26 target, what would that be? If you could just quickly give us that number.
So we don't give any guidances per se, but I think now, so currently we're building about 36 million square foot is what we have under development, of which we have opened up about 17,500 crores for sale in terms of phases. We have already pre-sold about 9,700 crores out of that. So if you take that number into account and add the 15 million and look at our track record in terms of sales, you should see a good jump.
All right, take that point, Ashish. Thank you so much for joining in with your thoughts and insights on the business going ahead. But a quick note for our viewers now. As you can see on the screen, there is a Moneycontrol stock score just above the line graph. This is a score assigned to each stock based on Moneycontrol's multi-factor algorithm. It is calculated by analyzing over 40 parameters, which include both current and historical financial statements, price charts, and technical indicators for each stock as well. Each of the individual parameters considered for calculation of the 4 factors are assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor or viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions.
Welcome back to Midcap Radar on CNBC TV 18. Nifty 25,100 is what it's managing to hold on to. But LG Electronics, that's the one we're keeping an eye out on after they made a stellar debut on the exchanges, listing at a 50% premium against its issue price. My colleague Shilpa Ranipeta spoke with Sanjay Chitkara, who is the Chief Financial Officer at LG Electronics India. Listen to what they have to say.
See, it's a very proud and humbling moment. I mean, you're on the first day, 50% premium opening. I mean, that's something very amazing and very encouraging. I mean, I think it's a reflection of the trust which our consumers, partners, and investors they have kept in LG Electronics.
Correct.
And I mean, it's also a reminder for the responsibility which they have given to us, that we keep on doing good job, keep on giving more innovative products to our customers, and give a sustainable growth and margins.
Right. So, now it's a company with strong fundamentals. You're profitable, you're a market leader in all the segments. So, for investors, what do they now look at as to where the next leg of growth really will come from for LG?
See, it's a mix of LG fundamentals and India's fundamental. And India fundamentals are very strong. If you see, our IPO success is actually a vote for confidence of India's growth story and consumption growth story. And the penetration of our products is very less. If you see the product like air conditioner, just 12% penetration, or washing machine, just 22%. So, I mean, these products are just basic and just to make daily life easy. These are no more luxury. So a tremendous growth is expected to come in time to come as the economy will grow. Apart from this, to accelerate this growth, we are taking a number of steps, like we are introducing a new lineup of products which will be targeted for the volume zone customers.
Right.
And we want to give them an experience for our premium products.
Right.
And on the other hand, we will also scale up our new businesses like B2B, information display panel, HVAC system, service business, and our third plant will also fuel the next level of growth in our business.
Right. So this new range lineup that you're announcing today, just help us understand, this is for the value consumer. So the price points will be slightly lower, more entry level than your current range of products. And also, how are we supposed to look at the margin profile of this lineup as well?
So right now I cannot give you the more detail about this, and very soon you will hear from us. So it's a very good option for budget conscious customer who are seeking a premium brand. And it's a very good combination of reasonable price and Indian Insight features and functions.
Right.
And just to give you some color, maybe 8 to 10% lower than the current level of this product, we will offer a fully automatic washing machine and a double door refrigerator at a very reasonable price. So our idea is that our premium product leadership, we want to share with everyone.
Got it.
And we want to give access of premium product to everyone. Regarding our margins, this project we started roughly 1 year ago, and we did a lot of value engineering so that our margins should be maintained.
That's the big listing of the day. But with that, we'll take your leave on this edition of Midcap Radar. Do stay tuned. Our special, Diwali special Mutual Fund Corner is up next.
Co-powered by SBI. Best है सबको पता है. In association with Aditya Birla Capital. Co-powered by SBI. Best है सबको पता है.
Gold and silver are glittering again, not just as ornaments, but as serious investment opportunities, with prices surging and global uncertainties adding shine to these metals. But the big question is this rally just getting started? And how can investors participate smartly in this rally via the mutual fund way? Welcome to the special edition of Mutual Fund Corner. And on that note, let's welcome Nilesh Shah, Managing Director at Kotak Mahindra AMC, to understand everything about this gold rally, the precious metals rally that we are seeing, and his insights on that as well. Nilesh, always a pleasure speaking with you. Thank you so much for joining us today on this special occasion. And you know, all we can talk about apart from equity markets now is the rally that we are seeing in gold and silver prices. There are a lot of things that are happening. What can you pin down in terms of reasons why we are seeing this rally in gold and silver prices that investors should be aware of, because there is increasing interest that's coming by in this asset class?
So there's only one thing which is happening in gold market apart from what was happening before: the central bank buying. Global central banks, post their experience of Russia-Ukraine, where Russian $500 billion FX reserves were seized by Western world, and that prompted every central bank about safekeeping of their reserves. The gold which was lying with Russian central bank remained in their custody. This prompted everyone to shift part of their allocation from securities into gold. If we see Western world central banks, 60 to 70% of their FX reserves in US Fed, in Germany, in Switzerland, is in gold. The Eastern world, Japan, India, China, their allocation is about 10%. Now, Eastern world central banks have to increase their allocation to gold, and some have even started dabbling in silver. So it is the central bank buying over last couple of years, from 2022 especially, which has resulted into this kind of price movement.
Okay, so usually when people talk about gold, it is not the main portfolio when they look at it, because it's usually the satellite side of things. When we look at gold, they say, okay, if some amount is left, we should look at investing in gold. What do you suggest the allocation to gold or silver be in someone's portfolio? And while we talk about other asset classes like Bitcoin, people say there's no underlying. If people are buying it, that's why it is surging or going down. What explains the move apart from central bank buying? I'm talking about a novice investor who doesn't know what is the underlying for gold.
So even we don't know what is the underlying for gold or silver. There's no dividend, there's no bonus, there's no cash flow, there's no fundamental things to value gold or silver. They are store of value because of thousands of years of history. They are internationally tradable because everyone believes in that history and storage of value. This creates unique characteristics for gold and silver. And the reserves of Russian central bank, which were seized by Western world, that has acted as a catalyst for gold and silver price up move. Gold moved first because central banks were buying gold. Silver has now started moving, partly backed on industrial demand and partly backed on central bank buying. So please be aware that both these assets, despite their sharp run-up, despite their long history, should be a limited percentage of your portfolio. These are assets where there is no fundamental value, or there is no way to determine fundamental value. It's always in the belief that someone else will buy it from you at a higher price. So do invest in gold and silver, but being aware that these are the assets which are difficult to value fundamentally, and hence should be a limited part of your portfolio. Is it 5, 10, 15? That depends upon your risk appetite, that depends upon your time horizon.
Totally take that point. So now that you're saying people buy it because they think they'll sell it at a higher price going forward, but it has already run up so much. Now there is a fear as well, what if I buy and the price goes down? So do you think we are in the early stages of a multi-year uptrend in gold prices? How sustainable is this up move that we are looking at right now?
So I 100% believe that commodity prices fluctuate. If they have gone up, they will come down also. And when there is a sharp run-up like this, the correction also will be there. You have to observe two things. One, the central bank intervention. As long as global central banks behave like Indian housewife, buying gold and not selling, you can be sure that gold prices will remain in uptrend. Does it mean that every day it will go up? Answer is absolutely no. We became bullish gold somewhere in 2020, post-COVID. At that point of time, the mining cost of gold was reasonably close to the market price of gold. And hence we thought that the jewelry demand will ensure that gold prices move further up. 2022, we became super bullish on gold once Russian central bank's reserves were seized. Today, do we have similar confidence? Answer is no. We have to wait and watch at what level, up to what level central bank will keep on buying. In the past, central banks have become net seller of gold also. There was a time when gold prices, if I remember correctly, touched $800, and then it corrected 75% to about $200.
Wow.
This was all driven by frenzy getting cancelled and central bank turning sellers because they thought this appreciation was too much. So do remember that gold prices have corrected in dollar terms by large percentage.
That's a big cut, actually. That's the news for me as well. Since the time I've started tracking, it's always been in that $1,000 mark, and that's a very important point as well. So this is about gold. We are seeing a lot of interest coming in from central banks. Silver, you said, of course, there's industrial use, and that is the theory that we saw during COVID as well, right? There'll be increased industrial use, new energy that we are looking at in terms of transition. For now, is it a catch-up that we are seeing in silver prices, or do you think this is also a rally which could continue? Of course, there'll be fluctuations, but it is start of a structural up move for silver.
So in silver, at least in Indian context and in ETF context, I'll break it up. Undoubtedly, there is industrial demand from electric vehicle, from solar cells. There are also some central bank buying in silver. Gossip is that there is more inquiries about central bank buying. And then there is momentum which is built because gold-silver ratio moved too far in favor of silver. The frenzy has now reached Indian shore, where silver is in short supply, and it started trading at 10 to 12% premium to their international parity price. This is reflected even in silver ETF. When you buy silver ETF today, you are paying 10 to 12% premium to enter silver ETF. In many periods, 10 to 12% was a return of silver over 1 to 2 years.
True.
So you are, in some sense, paying that kind of premium to just enter into silver trade.
Say somebody who's starting right now, somebody who's very young, wants to start investing gold. What is the best way to go about investing in gold and silver? What do you suggest?
So one, be aware of the risk. Central bank buying, industrial demand supply. Second, please don't expect the last year's return to come in next 1 year. There will be ups and downs, and the returns will not be comparable to last year. So if you are investing in precious metal, ensure that it is a reasonable percentage of your portfolio, not significant overweight, looking at the past performance. Whether it's 5, 10 or 15% depends upon your risk appetite. If you can do SIP in gold and silver, that is even better. You will buy something at higher price, you will buy something at a lower price, and you can continue to invest. The one thing which people should monitor, when lab-grown diamond came, natural diamond prices crashed. Could there be manufactured gold? Well, there are two possibilities. One experiment was in CERN where they converted lead into gold, few nanograms, few nanoseconds unstable. So that's not a serious concern. It will take years before we hear on them. But the second experimentation, as claimed by a startup in US, where they converted mercury to gold through nuclear fusion. Now that technology is probably going to happen faster. So keep a watch on that. Like lab-grown diamond crashed natural diamond prices, manufactured gold could natural gold prices.
Okay, yes. And you know, you spoke about nuclear fusion and that entire science being used. And India is looking at investing a lot there as well. So let's see if that is used domestically as well to do what the scientists are preferring to do with gold. It's a very interesting conversation. We have a lot more to catch up on as well, Nilesh, but we have to get into a quick commercial break. We'll come back and we'll now delve into how to take exposure into gold. Is it via ETFs? Is it via gold funds? Or physical buying is the best way to take exposure? But stay tuned for that conversation on the other side of the short break. Welcome back. You're still tuned into this special edition of MF Corner, where we are discussing everything in terms of moves that we are seeing on precious metals, gold and silver, stellar rally, and what is a better way to discuss this during the festive season on this special edition. Nilesh, we have discussed what are the reasons why gold and silver have gone up. But do you think between the two there is one of the precious metal which has more advantage? Do you think one will move better than the other?
So undoubtedly there has been ups and downs in silver-gold ratio. When central banks are buying gold aggressively, gold does well. When industrial demand is pushing the prices, silver does well. And both of them have fluctuated over the years. Directionally, they move in the same direction mostly, but there are fair amount of divergence.
Okay, so there's no real number that we can put to that as well, of course. That point is taken. For somebody taking exposure to gold, what is the better way? Is it gold ETF? Do you stick to our traditional way of looking at physical gold, or is it gold funds?
So when you're buying physical gold, you are taking the risk of higher transaction cost if you are buying in smaller denomination. We all buy gold on Akshay Tritiya, Dhanteras, Lakshmi Pujan, but the transaction costs are higher. Second, quality of gold. Now with hallmarking, those worries are behind. But if you're buying it in ornament form, there is making charges and there is some worry on quality. Third, if you buy physical gold or silver, you have to store. Silver is bulky, so storage will become a challenge. Many people put gold in their bank lockers. If there's some mishap over there, it's your responsibility and your cost. When you buy ETF, it's an online purchase. Second, the custodian keeps this gold and silver. They keep it in earthquake-proof structure. There are CCTV cameras, there's insurance on it. So protection and storage doesn't become your headache. It is managed by the fund. And most importantly, the transaction cost of trading in gold and silver ETF or fund of fund is far, far lower compared to buying physical gold or silver. So I will recommend, do consider gold, silver, ETF and fund of fund as part of your portfolio. There are many female who do SIP or Vishy with roadside jeweler. They give money for 11 months and then 12 months they get the ornament. Now, this has worked well for women over a period of time. But then there are also mishaps in this. Recently, Taurus, a jeweler, disappeared in Mira Road and a lot of people lost money. Some time back, Goodwin Jewelers had disappeared. When you are investing in ETF, fund of fund, you don't have to worry about such kind of mishaps. So if you want to consider SIP in gold and silver, this option also can be considered apart from your jeweler.
So, you know, we of course are talking about the benefits of getting into ETF, but investing is a lot about behavior, and Indians are emotionally attached to the idea of buying physical gold. In fact, if I have a conversation with any elderly person in my family as well, they'll be like, you do not hold that asset. This is an asset which should be held. So just being a devil's advocate here, you're saying not entire exposure should be through physical. There could be a split between the two.
Absolutely. See, you won't be able to wear a statement of account of gold and silver ETF and go to the wedding. You will require ornament. But you can always have space for both in your portfolio.
Yes, so it's not entire no for physical gold. Of course, it is something that you can hold for your daily purposes or for festive purposes as well. But for investment, look at ETFs and fund of funds as well. Now, Kotak AMC also has both gold funds and silver funds. How do they work in terms of strategy? How are they different from the other ETFs or sovereign gold bonds? I know now the sovereign gold bond issuances are not coming in, but you know, people are not warming so much to the idea of ETFs as well. How do you think we can tell them, or you can tell them, in terms of the benefits that ETFs have or the passive markets have when it comes to even investing in commodities?
So one, it's a convenient way. For buying physical gold, you have to go personally. There's digital gold available, but that's again not as popular as ETF. ETF is online. Storage and protection, you don't have to worry. And the transaction cost is lower. The only negative for ETF is that you can't wear like an ornament. But then we are not talking about making charges either. Many times people have bought gold saying that jeweler will do the buyback. Now, please remember the amount of jewelry sold by him versus what liquidity he has. So there will be challenges on the liquidity also. Compared to that, in mutual fund, liquidity is reasonably better. So overall, it's lower cost, better convenience product. But certainly both physical gold, silver and ETFs will have part in your portfolio.
So, you know, with such funds where ETFs or gold funds which are tracking a commodity, the tracking error part becomes a thing that investors often ask about. So, if one is looking at a lot of ETFs, all gold ETFs, but provided by different AMCs, what is the best way to, you know, look at tracking error or take some investment in one of them?
So, what is tracking error? It's basically difference between the price movement and net asset value of ETF. That's primarily driven by transaction cost, expense ratio, and execution cost. Now, wherever tracking error is less, you could be reasonably sure that we are as close to the price as possible. So, lower tracking error as a thumb rule can be interpreted as a better managed ETF, which gives you exposure to underlying asset class. So, while evaluating fund, do consider size as well as tracking error.
So, you know, you have both silver and gold ETFs. You said you were first bullish in 2020, then all the more bullish in 2022. We've seen a massive rally already. What is the realistic return, internal returns that you have, you know, come across or thought of for these funds in the next 3 to 5 years? Again, I know it is not a number that you can put, but I think the main question is, do you think this asset class will continue to outperform going forward?
So their outperformance will be dependent upon two things: central bank activity. Are they buyer? Up to what price? At what price they become seller? I have no doubt in my mind that if they become seller, prices will correct. If they stop buying, prices will correct. Prices will rise only up to that price at which central bank buying will be supporting. On silver, obviously, apart from industrial demand, we have to see what is this central bank activity. So central bank activity becomes a fulcrum around which gold and silver prices will move. The second thing is technology. The day manufactured gold appears, there will be adverse impact on gold prices.
Technology can be a bane or a boon for at least this asset class. Now that we are talking about so many factors that could happen or not happen, and that will impact commodity pricing. But if someone is looking at gold today, do you think they can play their investment thesis via gold or silver versus equity markets? Because markets are always subjective, so are investments.
So my recommendation is that please follow dharma of your asset allocation. Equity, there is fundamental value attached to it. Hence, it could be larger part of your portfolio. Gold, silver, crypto, there is no fundamental way to evaluate their worth. Hence, they should be smaller part of your portfolio. You could have everything in your portfolio: equity, debt, real estate, precious metal, crypto, but it should be according to your risk appetite. Whenever price is correct, you should have ability to average. If you're only playing the momentum game, it may work in the short term, but over a period of time, it will create pain.
Okay, so, you know, I'm talking from a perspective of a long-term investor, not somebody who is playing just the momentum, as you said, or playing short-term gains. So in the long term, somebody who's looking at investing today, keeping it for 20 years, do you think gold could be, say, 25-30% of their portfolio?
So in order to be alive in long term, you have to survive the short term. When there are ups and downs, the long-term investor also ends up losing their patience. We had seen in COVID-20 where people who didn't need money also redeemed because markets were correcting. Yeah. That was the worst mistake of their life. They converted their notional loss to real loss. So to me, asset allocation is the dharma which you have to follow every day. Just because I'm 20-year forward-looking investor doesn't mean that I can ignore asset allocation. Just because I'm long-term investor doesn't mean that I can ignore my risk assessment, my risk profile. Bet according to the risk you can take. And all gold, silver does not have a fundamental way to evaluate. And hence, it should be a reasonable percentage of your portfolio.
Nilesh, it's always a pleasure speaking with you and getting your insights on markets, on mutual funds, investments, and life in general as well. So wish you a very happy Diwali to you and everyone in your team as well. And with that, we'll do one thing. We'll take your leave on this edition of MF Corner, but do stay tuned. More news and updates are coming up next.
Co-powered by SBI. Best है सबको पता है. Powered by LIC, हर पल आपके साथ. Co-powered by SBI. Best है सबको पता है.
Market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Hang Seng, that's managing to hold on to gains of 0.4%.
And Beautiful Day is rising, and now the rebuilding begins.
The United States is pushing for peace in the world. China is financing war.
Absolutely flat, 6 or 7 point change lower is the implied open.
Premiums that they're reporting actually on a day-to-day basis is much higher than what the street is working with.
Our advanced AI revenue this quarter exceeded $100 million mark.
First rates coming up, 25,227. The Sensex at 82,400.
You're not getting valuations at the very cheap, but they are not very expensive.
We got 100% jump in equity collection vis-a-vis the same quarter last year.
If you see on a longer term period, India has been one of the best performing emerging markets.
We are investing in new products, new technologies.
Today, Tata Motors passenger vehicle business lists at rupees 400 per share.
Wholesale price index at 0.13%.
Nifty around that day's low mark. We've recovered from the lows of the day, but still it's a 113-point cut.
That was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Reema Tendulkar. With me are Nigel and Manglam. So we're not quite at the flattish opening that we had in the morning, but mid-session, just about an hour back, we had even dipped below the 25,100 mark. We'd gone down to levels of 25,060. So we're off from the session lows. But all in all, I think the sell-off in the mid-caps is pretty brutal now.
I think it's heartening to see actually that the 20 DMA at least has got defended. You know, we went down to around 25,050 and from there we did see a bit of a bounce. So that's, something to cling on to. And I think, till that 25,000 mark is broken on the downside, I think the bulls will still feel that they have some unfinished business at higher levels. The Nifty Bank has taken a bit of a pause, and that's the reason why, in fact, we are seeing some selling. But broader markets, as Reema said, you have only one stock that's advancing for three stocks that are declining. But there are select names, actually, that are doing well even in the broader markets. Manglam?
Absolutely. You look at some of these IT stocks as well, they're doing well. So we have Wipro for one, which has moved higher in an otherwise wobbly day for IT stocks. Infosys has inched marginally higher. And then if you look at the broader markets, some of these auto ancillaries, you have Sona, BLW Precision up around 4%. Tata Com is another one, which is 4%. Ireda up 3%. MCX has been fairly well bid. In fact, that stock has seen a big surge all through this month. It's up around 20%. And we have a bunch of these other names as well, which are doing well. Though, I take your point entirely. By and large, we have way more decliners than advancing stocks. And importantly, over the last two trading sessions or three trading sessions, what has actually seen a big spike from the lows is the India VIX. Yeah. When we started the week, it was sub 10 or closer to that 10 mark. And then three consecutive days, we've seen that India VIX move higher. And now, today as well, it's at one point was up around 11.5 or thereabouts. From there, it's cooled off to around that 11 mark. So we'll watch out for how this pans out, especially as we move towards the expiry session.
And just one stock that we're looking at is RBL Bank. It's been in the ban for a long time. Today, it's a close call. It could possibly come out of the afternoon ban. Just going by the data, we'll try to revise that at around 3 p.m. But as of now, there are chances that it comes out of the ban.
It's also the Nifty weekly expiry, so that will play out in the last 30 minutes in terms of moves. But weighing on the market sentiment is the weakness across the global markets. So the Japanese markets, which were shut on Monday, they reopened after the long weekend and they ended with a cut of more than 2%, 2.2% lower on the Nikkei. The Hang Seng was down close to about 1.5%. The Chinese markets sold off. So Asia was in the red. And even as we speak right now, Europe is having a bit of a weakish Tuesday. So currently under pressure with the frontline European indices, the CAC, DAX and the FTSE down in excess of, 0.5% now. The CAC lower by 0.8%. The DAX also inching closer towards a 1% fall. So that's the risk off globally is weighing on our markets. But let's tell you the action-packed closing bell that we have for you in the next 1 hour of trade. This is what's lined up. A down day for stocks ahead of the F&O expiry today. The Nifty is trading around 25,160. It's red across the sectors. PSU banks, metals are the top sectoral drags. Shares of Ireda are up and about following strong quarterly results. Profits are up 42% on an annualized basis. What's driving that? A detailed fine print coming up on the show. And Phillip Capital has a sell rating on Dixon Tech. They flagged client concentration risk as domestic volumes for the largest client, Motorola, has declined. MTAR Tech is seeing some splendid news after the news of Brookfield backing the company. It's a key client, Bloom Energy, with $5 billion investment. What does it mean for MTAR Tech? Details coming up also on the show. And we'll put the spotlight on the banking sector in our special segment, Quarter Say, Quarter Tough. For now, let's get in a few trading strategies in the last hour. Mitesh Thakkar is now joining in. Mitesh, you were highlighting how 25,100 is an important support for our markets. We breached it intraday, managed to claw back well above that level. Did you take any trade as we went down to levels of 25,050, and now what are you doing?
I haven't taken any trades, but we recommended buying around this 25,100 with a stop below 25,010. And the idea was that you might have an intraday decline below these levels, but as long as it's held on a closing basis, my belief would remain on the positive side. So I still maintain that the overall market bias is positive, and it's until we get a closing below 25,100. Now, on the upside, similarly, the breakout happens about 350, 400 zone. So these are the two counters to watch for any kind of directional move. On the stock side, I have a buy on HDFC Bank with stop at 974. Look for a target of around 1,000 here. And the second stock which I like, that's also a buy call, that's on Indigo. Indigo is something which I would recommend buying for targets of around 58.70 or thereabouts. One can, possibly keep a stock just below levels of 57.40, 57.39.
All right, we take that point. But meanwhile, important, information at the bottom of your screen. The RBL Bank clarification has come in on reports. Reports of Emirates NBD's purchase of the company resurfaced last evening, and now the company has actually gone ahead and clarified on these reports, saying that there is, nothing that has happened that warrants this kind of disclosure. So the article which came by is incorrect. The bank is always on a growth trajectory, routinely explores opportunities. They're not aware of any info that requires disclosures at this stage. So basically, they're not denying. It is a routine reply that has come into the exchanges. They obviously are looking to, go ahead and engage with external opportunities that would come by.
Yeah, they're keeping it very open, actually, right, in terms of the communication out there. But the street clearly is sensing something.
Yeah. I mean, the stock was in F&O ban on the last day of the previous series and the new series as well. Typically, when you start with a clean slate, this was the only stock that started with the F&O ban. So definitely the street. In fact, yesterday we spoke with Jakes in the Market Mehfil show. He said that the theme for this year for him are some of these banks where there is likely foreign investment coming in. So that could be one of those things.
All right. So we'll have to keep an eye on that. And Mangalam, everyone was saying September wasn't a good series. This stock actually didn't get hurt. So that's the way the street is positioned. If you just pull up a last couple of months chart, you'll see that, that's the one that should be in a radar. Mitesh, I want to quickly ask you about RBL Bank. The stock has had a big run. The street is sniffing something. They're leaving it open-ended as well, going by the clarification. So any view on that name? And I'm not sure whether you tracked this one, Power Mech. The stock saw a one-way correction. And that one has suddenly seen a big spurt up in terms of volumes. And, it appears there is big volume on that one as well. So either of the two.
I'll take RBL Bank because the other one I'm not tracking. See, RBL Bank, if you look at the historical charts, the last significant high had a weekly closing of around 290 and 291, which was one of them was on 15th of December 23, and the other one was 12th of January 24. And we are back to those levels of around 290, 291. I think a weekly close above this will definitely be positive. But for the timing, I believe that this should be some kind of a pivot, which could be an important supply area. This 290 to about 295 kind of a zone. But once we clear that, the stock goes into all-time highs without any kind of historical, not all-time highs, but multi-year highs, but without any kind of historical resistance till the levels of around 360. So I'm quite positive over here. If somebody is holding, a good way to be, would be to take at least 25% off the table. But otherwise, once it gets a closing about 295, expect this rally or up move to extend.
It's 85% up so far this year. What a move on RBL Bank. But let's talk about IREDA. Strong set of Q2 numbers. Gaurav is now joining in. Gaurav, it looks like an all-round beat. There's very strong growth. The asset quality is improved. Give us the numbers.
Well, as when we look at the numbers, first let's talk about the profit ratios. Net interest income that increased almost by 50% on a year-on-year basis, while operating profit that increased almost by 55%. When we look at the provisions now, we have seen some kind of decline, around 80% decline on a sequential basis in terms of provisions. And at the same time, profit, when we look at this figure, that is also up almost more than 40% on a year-on-year basis. Looking at the ratios, it seems that the gross NPAs and net NPAs now they are under control. We are seeing some kind of cooling down effect in these ratios. Remember, last quarter bank actually reported, IRDA actually reported spiked numbers in terms of gross NPAs and net NPAs because of one of the accounts from FY20, but it seems that it's cooling off. At the same time, net interest margins, now they are also expanding almost by 12 basis points in this quarter on a sequential basis. Lastly, let's not forget that IRDA already had given their disbursement and sanction number. We had seen a strong performance there. Loan book that has increased almost by 30%. So all in all round, if we look at it and the numbers, it was higher than the street's expectation and also better in terms of the Q2 that we have seen for IRDA. And as a result, we are also seeing market cheering up for this stock today.
Indeed, market is cheering up for that stock as well. Though we can't, deny the recovery that we're seeing from the lows on the frontline index. When we started the show, the Nifty was down almost 70, 75 points, which itself was a recovery from the day's low. But now, as we speak, it's down about 60 points. And a large part of that recovery can be attributed to some of these IT names which are picking pace and a couple of these FMCG names as well. Case in point, Tata Consumer. That's the one that should come up for you on the screen. Not a big weight on the index, but we are seeing some sentiment reversal in a couple of these names. Tata Consumer at the high point.
Just one stock, Mastech, because Infosys won a large £1.2 billion order from NHS for workforce transformation. And typically, we've seen Mastech do a lot of work for NHS, the UK government, etc. So not sure if the two were competing, but just saying that this was largely a space which Mastech used to occupy, this UK NHS kind of orders. And now Infosys has won that large 15-year contract. £1.2 billion is the order. But IT is doing very well, right? It's not just HCL Tech. Even Tech Mahindra, ahead of numbers, is surging.
And I'll be looking at Reliance, though. Towards the end of this week, the company reports its numbers. So ahead of numbers, typically we see some action in Reliance. And if Reliance can move higher, would obviously take the Nifty higher as well. Dixon Tech, that's the one stock which is under pressure right now. There's a Phillip Capital note which has come in on that one. What we'll do is we'll get to the details of that note in just a bit. But right now we do have with us Dharmesh Kant, who's the head of research at Chola Securities, joining in. Dharmesh, thanks a lot for joining in. What do you feel about the market right now, individual stocks, RBL Bank in particular? Got to ask you that because, the stock's been doing well. There have been reports of this stake sale to a foreign bank. Do you think that happens, doesn't happen? Whether that happens, will this be an investable idea?
Yeah, good afternoon, Mangalam. Thanks for having me on the show. The RBL Bank stock price has moved quite a lot, but the bank has been plagued with series of their own set of problems. If you look at cost to income ratio, it was from 63, 64%, which still was higher. It has moved up to 72% as of now. And at the same time, the asset quality has been a concern for RBL Bank. Credit cost last quarter did decline, and the bank is, poised for restructuring. The biggest problem has been the unsecured book, which around 27% of the book is unsecured, and 17% comes from the credit card business. So there are structural issues which, they are facing, and they are trying to address that. 9% was the advances growth, this quarter, which they have reported. I think, it would be prudent and very good for a bank like RBL, which gets a handholding from a senior, partner, as has been the case, because anyways, the senior top management of RBL Bank has always been not unstable kind of a management has been there, and there has not been any guiding force to carry the business forward. So if the deal happens and it, materializes, it would be, better and a prospect for the RBL Bank. And this will be, again, if it does go through, then it would be third in the line after Yes Bank and Saman Capital. And now we're hearing this for RBL Bank. To my mind, it would be better for RBL Bank if it gets a senior, partner out there.
All right. What about IRDA? Did you track that one? My colleague Gaurav just spoke about that.
Yeah, good afternoon, Nigel. IRDA came out with a very stellar set of numbers. Whichever way you look at it, the numbers were great. And that comes in the light of the stock price has taken a serious, correction from all-time high. It's down 45%. Even year till date, it's down around 25-30%. So it gives you a good, value buying opportunity with that kind of return on equity ratios. They are setting, and P multiple is also normalized to 28, 29 times. Renewable energy is a segment to be in. The government of India focus is there. It's a fast-paced movement started happening. Earlier, there was land acquisition problem with like NTPC Green and all, which is no longer there. So I think offtake of, loan book will be quite high, and IRDA will continue to compound at 25-30%. At 4 times price to book on a TTM basis is not, expensive. I think the stock is in for re-rating, and maybe 20-25% kind of an upside by the time we end this fiscal FY26 is very much on the cards.
All right, take that point. Dharmesh, hang in there because we have a couple of other stocks as well to discuss with you. Meanwhile, Hotel Leela results at the bottom of your screen, 12% revenue growth, 20% EBITDA growth. The bottom line has turned into a profit versus a loss. That's largely on account of their finance costs coming down substantially from about 120 odd crores to 38 crores. And that's the kind of delta that we've seen in the bottom line as well. But for the hotel industry, the second quarter has been, more or less a routine quarter, one of the weakest for the year for all the hotel industry. So we don't expect much in terms of movement coming in here. The business end for this business starts third quarter and fourth quarter, and that is where you would see more growth play out. And for Leela in particular, over the next few years as the new properties come on stream as well. But the stock under pressure, Dixon. Let's go across to Upasna, who's waiting by with all the details from the note that has come in on Dixon from Philip Cap. Upasna.
Well, yet again, Phillip Capital has come up with a sell rating on this stock with a target price of 9,085 per share, which is a downside of nearly 45% from the current market price, highlighting the same bit that was highlighted earlier by the brokerage, that is the declining volumes in terms of the company's key client, that is Motorola. The brokerage says that the domestic volumes for Motorola declined in Q2 FY26 and company faces significant client concentration risk. Now, if we look at FY25, 80% of the company's mobile revenue was contributed by Motorola, which is down to 60% in this quarter, that is Q2 FY26. This is mainly due to a Y-on-Y fall in domestic volumes as Motorola and other Android brands are facing rising competition from Apple. In Q2 FY26, Motorola has outsourced 18% less domestic volumes to Dixon on a Y-on-Y basis, mainly due to increased outsourcing to Carbon, is what the brokerage has highlighted. Now, Dixon is set to miss its guidance given in Q1 FY26, that is a 15% sequential value growth in mobile phones, primarily due to a volume decline in Motorola and also a loss of wallet share that is seen from Longcheer and Xiaomi. It has also said that the consensus FY26 PAT estimates is around 1,200 crores and it expects a double-digit cut in these estimates in the coming quarters. Hence, it has given a sell rating on this stock yet again.
Thank you very much for explaining that. Dharmesh, did you have a chat with Dixon over the course of this quarter with the management of Dixon? And this, loss of, the decline in volumes in Motorola, how much is it likely to hurt? What is your own research telling you? Because it's also a stock which in a way is priced to perfection after the kind of rally and the valuations it enjoys.
Yeah, I mean, the valuations are pretty high. We did not have a chat with the management of late, but this is a silent period, so post-earnings, we intend to do so. I mean, the only caveat out here is the report has been very bold in, pricing it at a much lower, cut out there. I don't think that much damage will happen because it's not only Motorola, which is the client. There are so many in the basket, and if one client loses a market share, other may be gaining. So there is OnePlus as well. Samsung is there, Xiaomi is there, and Toshiba, BPL. There are many clients who are there in the business and at entry-level mobile segment as well. So specifically speaking for the mobile kind of a business, some small hit can be there, but I mean, it's very difficult to say that only Apple will gain market share, and that's because of that you can call a sell rating on Dixon. Valuations were high. It has always been pretty high, but it's one of the finest EMS player presently available in the country, and they are targeting all the diversification whichever is possible. So not only it's LED TVs and home appliances, everywhere they have been getting, and not specifically concentrated to a particular vertical. So our sense is, if it corrects some more, I mean, wait for the Q2 earnings, and post that, if a correction takes place, then definitely it becomes a buy, because management has been pretty aggressive, and we are, we give benefit of, call on the management that they will come out of this pretty well.
Okay, all right, Dharmesh, thanks a lot for joining in this afternoon and giving us all of those details. By the way, KEI is a stock I think that should come up for you on the screen. I think the stock Sunny saw a big uptake in the last few minutes. I think that one should come up for you. And MCX as well, there's some positive news flow that's been coming in periodically. That's another way of playing the commodity space as well. And the premium, as we were highlighting earlier today as well, on a day-to-day basis has been moving up. Quarter 2 was higher than quarter 1, and quarter 3 as well, last week was much higher. The other one is Power Mech, the one that we had highlighted earlier as well. One-way correction in the last 1 year or so. I think it's down close to 20% from the recent peak. Pull up the one-year chart. Today, the stock is moving up on large volumes. But you pull up a one-year chart, it's been a rank underperformer. So giving up some part of that underperformance from the peak of around 3,400, sharp downtick is what we have seen. But let's focus on the star of the day. LG Electronics, it made a stellar debut on the bourses, listing at a 50% premium in comparison to its issue price. My colleague Shilpa Ranipeta spoke to Mr. Sanjay, the Chief Sales Officer at LG Electronics, on the company's growth and the margin outlook. Let's listen in to what he had to say as we take that short break.
LG is a very big company, and say at a 2.9 billion level. And such a big company, you can't see a linear growth. I mean, there would be some fluctuations, but the best part is we are market leader. And even this year, we further improved our market share for refrigerator and TV in the tune of 1.5 to 1.6%. Air conditioners, we improved by 1%, microwave 1%, and for washing machine 0.1%. So it shows that a company, even after 28 years, improving their market share. So it indicates that we have not built our organization on the basis of some short-term disruption.
Right.
It has been built through a very long-term vision and strategy. Our current localization is 54%, and every year 2 to 3% it will improve.
Correct.
And the biggest strength which is contributing to our margins are major key components we manufacture in-house, like compressors or heat exchangers or some assemblies, sub-assemblies. In India, the premium portion of business will grow as the premiumization is happening. And as the premiumization will happen, LG will be the biggest beneficiary due to its premium positioning. And with the premium price, business will grow, your margins will improve because the margins are relatively better.
Welcome back. We're down only around 50 points as we speak. So there's a good pullback. Titan is another stock actually that spiked up in the last few minutes. So I think Titan is the one that should come up for you on the screen. But the action really is in the broader markets. And as always, Hormuz joins in. He's going to put the spotlight on some big movers. Hormuz, take it away.
You know, some of the beaten down names are springing up among the list of gainers today. One of them is Carraro India. It's a recent listing and is the biggest single day gain that the stock has seen since April. The stock is up 10% now and it's gained in 3 out of the last 4 trading sessions. Volumes are the highest in a month, but 13.5 lakh shares of Carraro India have been traded. The 20-day average here is just 2 lakh shares. But despite this move, the stock is still down almost 30% from its IPO price, which is at 704. Now, Repro India, we spoke about this last Monday as well, and since then the stock has been on a bit of a gaining spree. 7 out of the last 9 sessions that the stock has gained. It saw a similar double-digit move, as I just mentioned, last Monday as well. It's up around 9.5% today, but today's volumes have already crossed last Monday's volumes, and so as a result, today we have seen around 4.2 lakh shares change hands. Last Monday, we had close to 3 lakh shares change hands. And this 4.2 lakh shares comes on a 20-day average of just 25,000 shares for Repro India. It's almost turned positive for 2025 now. It was down almost 40% last year. And lastly, Landmark Cars is reacting to its business update. Of course, today the stock is now up 10.5%. It's the biggest single day gain in 4 months for the stock. The volumes are already the highest on record. Had more than 50 lakh shares that have traded today on Landmark Cars, 20-day average being only 50,000 shares. And the stock took support at its 50 DMA and has rebounded from those levels. And courtesy of today's move, the stock has also turned positive for 2025 after declining around about 25% last year.
Thank you very much for that. Let's talk about markets and where we are headed. Alok Ranjan, Head of Equity and Senior Fund Manager at ITI Mutual Fund, is now with us on the show. Thank you very much, Alok, for joining in. We often speak to Rajesh, so it's good to see you on Closing Bell today. So you track you manage the large cap and the large cap mid-cap fund at ITI Mutual Fund. And I was just looking at your large cap fund. It's fairly diversified. You've got about 65, 67 stocks in your holding, well spread across financial stocks, consumer, you've got autos, you've got, IT heavyweights. I mean, what's the broad call that you're taking at ITI now in the markets for the next 12 to 18 months and the sectoral composition of your portfolio?
Thanks, Reema. So to mitigate the risk, we need to be diversified. And whenever it is large cap, you know how the movements happen. So typically large cap stocks would have 60 to 80 stocks in portfolio. Of course, sectorally also we are diversified because in the last 1 year, if you see how the markets have moved, there are no clear outperformers, and definitely, one has to be bottoms up because market is not decisively very attractive. It has not corrected very significantly, and most of the correction has been time correction. And as far as valuations are concerned, now we are almost fair valued or maybe a little bit more attractive than fair value. So that is how we are going to see. So that is what we see in our portfolio. We are invested pretty much across sectors. Of course, there have been pockets of overweight and underweight concentration.
So to beat the index returns and to generate that alpha, because you are broadly diversified, how do you intend on doing that? What are your big overweights? What are your big underweights? What is the call that you're taking?
Right. So you might have seen in capital goods stock, we have remained overweight, especially during last 3 to 6 months. So whenever you have to do bottoms up investing, typically capital goods sector is a very, very wide sector. It has got several pockets. So there are pockets of defense, there are pockets of power T&D, and then there are pockets of basically industrials. And if you are overweight that, then select stocks in those sectors have outperformed. Then automobile, most of the industry was underweight, but you see how things have happened in the last 3 months. The government has given some incentive, and the sector was doing so badly that government has to come up and do something. And now we have seen how auto stocks have done in the last 3 months. So that is pretty much also reflected in IT sector. Things have not gone well for the IT sector, but now we have started coming to a stage where it may not look very good. At the same time, valuations have also corrected quite significantly. So maybe the underweight extent has to reduce, and slowly we need to go around equal or something like that.
Okay, all right. Hi, Alok. Good to speak to you after a while. Nigel on this side. Alok, how do you approach the consumption basket? The street seems to be divided. Some believe that some of these staples haven't done anything. Maybe a case for review. The counter argument is they're not going to grow much, so why to look at them? You rather go for the discretionary names. How are you all positioned on the consumption names?
So again, you see consumption has several pockets. So if you see staples, it's true that it has corrected, and it's true that government has given some incentive. There have been tax deductions, extra money in the pocket of consumer. Everything is fine. But at the same time, if you see how the companies are growing, companies are typically struggling with 5% volume growth also. It's very difficult for them to achieve that. So in consumption, if you see staples, we are not gung-ho on that, and there we are underweight. At the same time, if you see consumer services and consumer discretionary, we are quite overweight there, and that is where we are quite optimistic and bullish.
All right, so you're bullish on consumer discretionary, not so much on staples. What about the auto pack? And, as we move towards post-monsoon, what would you say of cement? Do you think that, infra demand will pick up, that will cause some price hikes in the cement business, volumes? So on cement and autos, what are your thoughts?
Right. So if you see auto, entire industry was almost, there was a consensus underweight. And everybody was expecting autos to do badly, but then came this GST incentive. And if you see auto numbers, they have not been doing well for the last 5 years, 7 years. In fact, in some of the automobile sector, you'll see that number. In absolute terms, they haven't grown beyond 2015. So for the last 10 years, there was a build-up in demand, but at the same time, industry was not doing that well. Now with this kind of incentive, you must have seen, comments from several companies. I cannot name those companies, but you see all the large cap auto companies. The numbers are extremely good, and this is something that is going to continue. And the same is also reflected in the, you see, automobile index. It's high for the year. And all this has happened in the last 3 months. So that is why we need to be fairly diversified. At the same time, the top 3 or top 4 large cap stocks, they are going to do quite well.
Okay, all right. Just a quick question on the cash levels that you all are sitting on, Alok?
Cash would be typically 2 to 4%. That is what we typically maintain. We don't take, as a policy, as a house, we don't take large cash costs, because that can create extreme volatility in the portfolio performance. So we think pretty much we are invested, but 2 to 4% cash generally we try.
Fully invested. Got that, Alok. Good having a short but effective chat. We have lots more questions for you, but that for another session. Thanks a lot for joining in. Well, for the time being, I'll tell you what. I think we should slip into that short break. Come back. We'll continue to focus on markets. We'll also get you a technical call with regard to what to buy for a reverse trade.
Welcome back. The Nifty is once again gravitating lower, 25,150, a cut of close to about 0.3%. Mkts is back with us for a few BTST calls. Mkts?
So, the Nifty, as you were rightly highlighting, has failed to give any kind of a decisive move, just that it's managed to hold on to this 25,100 level, which is what we were also suggesting will be an important level on a closing basis. So, we kind of bounced back from there. Therefore, more trading should be, kind of focus on the stock side, and the calls that I have right now. I have STBT on in Petro. If it breaks today's low, which is around 440, so sell below 440, just bounce back a rupee and a half. 440 below 440, sell with a stop at 444. And look for a target of around 435 to about 432. And ICICI Bank is a BTST. Keep a stop just below levels of around 1376 half and a target of 39.5.
All right, Mkts, thanks a lot for that. 20 minutes to less than 20 minutes to go for close. Nigel, weekly options expiry. What's the F&O setup like?
Well, that's right, Manglam. It appears we're in a bit of a range. And if you just look at the high and the low of today, you'll see that, in fact, the markets is getting into that buy on dips mode. Yesterday as well, there was a buy on dips, as well as in today's trading session. However, that 25,350 appears to be a bit of a zone out there. And even in today's trading session, we went to around 25,310. A few sessions ago, we went to around 25,330, and we did a U-turn from there. So in the near term, that's a bit of a resistance zone. However, at around 25,000, 25,050, which is where the 20 DMA comes up, as that screen is telling you, that's the level that, in fact, is a crucial support zone. Now, individual stocks that I'm looking at, IRDA, that's a stock that's up close to around 3%. It's seen a massive correction from the top. And as of now, you still have shorts that are sitting in the system. Open interest is up by close to around 10%. There's fresh buying on that one. MCX, another stock that's moved up. It's up close to around 5% the last time I checked. And the open interest has swelled up on that particular counter as well. So that's the stock you're looking at. Now, in terms of stocks that could move in and out of the F&O band, it's touch and go, actually. RBL Bank is on the verge. There's very high probability that today or tomorrow it goes out of the F&O band, which it has been over the last few trading sessions. And SAIL, the last time I checked, it's touch and go. That as well is approaching 95% of its market-wide position limit, which effectively means the stock could possibly come into the F&O band. So touch and go on both these two. RBL could very well be out of the F&O band, while SAIL could go in, but very, very close.
Got that. Thank you very much for that. Bank of Maharashtra, which reported the numbers, is sold off close to about 4.5%. But a couple of the other banking names are weak too. So you've got a Bandhan Bank, which is subdued in trade, UCO Bank, Yes Bank, South Indian Bank, all down close to about 3% Bank of Maharashtra's numbers were not bad, seemed pretty stable, but you are seeing weakness there. And the other one is Just Dial. Came out with numbers yesterday. It's been weeks since morning. The problem is growth for the company is very, very subdued, just about 6%, and it's been in single digits now for the 5th consecutive quarter, so over a year. But the stock to watch today will be Tech Mahindra, because it comes out with numbers. Now, both TCS and HCL Tech actually came out with a decent set of numbers. There was a beat on the company's top line. In the case of Tech Mahindra, we're working with a 1% revenue growth, and this comes on the back of 2 consecutive quarters of a revenue decline. Margins for the company have also been on an improving trajectory. Margins had gone to as low as 4.7%, sub 5%, and they've been steadily increasing. This quarter, we're expecting a 60 basis points margin expansion to 11.7%. What is aiding is the rupee depreciation. But other than that, the company has been trying very hard to get its margins back up to the industry average by exiting some of the low margin projects, getting in cost efficiencies. So margins have been on an improving trajectory, and this will drive a jump in the company's profitability by nearly 15%. Now, if you remember, Tech Mahindra is a work in progress kind of a company. There is a turnaround which is underway after Mohit Joshi took over. He gave himself 3 years, and he said at the end of 3 years, that's FY27 end, the revenue growth of Tech Mahindra will be at par with the industry or industry leading, and margins will come up to 15%. So every quarter we track the progress the company is making towards achieving this end goal of industry leading revenue growth and EBIT margins of 15%. So that's about Tech Mahindra this time around. But I think the other big one is going to be Axis Bank, and in just a bit we'll get to the expectations.
All right, so we'll wait for Gaurav. He'll give us the expectations on Axis Bank. But Jay Bala of Cash the Chaos joins us on the show. Jay, You have been saying that this market actually, wow, that's a nice shirt, Jay. Nice and pink. All right. So, Jay, the markets, you have been telling us that it actually eventually is going to be testing those higher levels till I think 24,000, 24,300 is the level that should be protected on the downside. You're as bullish?
That's right, Nigel. I'm bullish from a medium-term perspective, but in the short term, the markets are coming to headwinds. Like I pointed out last week, the global macros are likely to put pressure, and we saw the US markets cave in on Friday. I think that is the beginning of a short-term correction for the US markets. From where the US markets closed on yesterday, the 30th of October, I see a further drop to about 6 to 10%. So that can put short-term pressure on the equity markets, and that's the minimum I'm anticipating. I think the markets should hold off at the minimums, and I'm bullish for the rest of the term for markets heading into 2026.
Okay, bullish, for some more time now. Globally, is there a risk that, say, the US markets run out of steam? Everyone's questioning whether this entire AI theme is in a bubble. There have been a circularity of deals in the data center. Too much money has been committed. Look at OpenAI, $1 trillion in terms of, spend, in terms of deals that they've signed for a company which is perhaps going to generate $20 billion in terms of top line. So since you look at the, global technical indicators also, what's the mother market going to do?
That's right, Rima. See, the bubbles can last much longer than people anticipate. And right now, with the evidence from the charts, I believe this so-called bubble can last at least till middle of 2026. So what we could see as headwinds will probably be just an interruption in the bull market. And we are likely to see, like I said earlier, the US markets drop somewhere about 6 to 10% from yesterday's close. And all three major indices, and even the AI housing stocks index, that's also pointing to a similar picture. So I believe for the bubble to pop, a little more time is left, at least a couple of quarters in my opinion. So I will still remain bullish because there are sizable gains to be made on the long side. So the Nifty, in relation to the global structure, it might just either meander between 25,500 to 23,000, or the short-term trend line. If you draw a trend line from the all-time high of 26,277, that falls through exactly at the September high, and last week's high of very, very close to that September high. Nifty can manage to take out this high of September. I think the Nifty might outperform the global markets, but that's not my base case. I'm a bit cautious. I'm anticipating some pullback to come through in line with the global equities. I want people to book profits that they've made in the last few months and then reduce positions, not go to 100% cash. You can still be somewhere between 50 to 75% long.
And what about gold? We saw a decline in some of the metal prices today, including gold. Do you believe that it's just a correction in an otherwise uptrend, or maybe it's topped out?
Not yet topped out, but it's starting to look parabolic. So that's a danger sign. And if you look at the monthly RSI for gold, it's at 91, and it's sort of unprecedented levels. And the most important thing is we don't want prices to go parabolic. We've seen 20% rise in the last 2 months, and that's a danger sign. It needs some cool off, and I'm anticipating some cool off to come through. Right now, there is no reversal signature, so you need to keep trading stops for London gold at 4,000 odds and London silver at 49 odds.
All right, Jay, thank you for joining in. Just stick with us. We'll take a short break, come back, discuss more market with you on the other side, and also thereafter in Markets Forward. Take a short break, come back.
Welcome back. Well, we are still in conversation with Jay Bala of Cash the Chaos. Jay, as always, it's a stock-specific market. What do you have for us today? Give us 2 picks.
Yeah. See, before I give 2 picks, Nigel, I just want to make it clear that the markets are possibly late stage of this short-term cycle. So you might want to book profits and take that profits and try to put in these 2 new positions. That way you can position size accordingly, and your position size will be small in that sense. So from that point, I have Tata Communications. It's looking quite interesting from a short-term perspective. A stop loss of 1745 for an objective of 2100, possibly fresh 52-week highs and new all-time high. And the other stock I have is JK Cements. This is also looking strong within the cement space. Stop loss at 6202 with an objective of 7735.
All right, Tata Communications and JK Cement, your 2 stock calls. Jay, thank you so much for those picks and your views on the market. We continue our conversation in Markets Forward. But before that, we have closing and some results to contend with. And speaking about results in our special segment, Quarter Se Quarter Tak, ahead of all the big bank earnings this week, we have Axis Bank tomorrow as well. Gaurav joins in to take us through the key expectations from the banking sector this time around. Gaurav, most of the companies have reported their second quarter update.
Well, yes, when we look at the bank, let's understand that the results are underway, and when we look at the pre-quarterly updates, now the update looks fairly balanced. When we look at Kotak Mahindra Bank, that is leading the pack with healthy growth of around 16% on a year-on-year basis in terms of loans, while HDFC Bank loan book that has finally caught up with its system growth at around 10%. Among PSUs, we saw Bank of Maharashtra, UCO Bank, they actually reported the double-digit run, and at the same time, EU Small Finance Bank, that continued to clock more than 20% loan book growth. In fact, most of the PSU banks, they have delivered in line growth with the guidance, and some even beating it. But not everyone had a good quarter. IndusInd Bank, Utkarsh Small Finance Bank, they reported contraction in its loan book. Union Bank, even this bank actually reported a slowed loan book growth at just around 5%. Now, as we head into results, let's understand what we can see. One can expect double-digit loan book growth for banks like SBI and ICICI to continue, while on the other hand, Axis Bank and Federal Bank, now there we may see single-digit growth even in this quarter. Margins are where the pressure is actually building, because net interest margins, they are expected to drop anywhere between 5 to 30 basis points. But the good news here is that we may see them bottoming down in this quarter, considering no further rate cuts. Now, the sharpest compression could be seen for Bandhan Bank, as we will also remain watchful for banks like Axis Bank and EU Small Finance Bank. And for the names like SBI and Federal Bank, we're expecting to see the impact limited between 10 to 15 basis points. And for the large banks, the impact is going to be somewhere in the 5 to 10 basis points. When we look at some of the surprises, now we may see silver lining here in terms of RBL Bank. We have already seen some news flows, and there could be this could be the bank where we may see NIM expansion this quarter, and this is all because of the faster asset repricing for the bank. On the asset quality front, there is some relief actually. Credit cost, it is likely to ease sequentially. However, it is still important to see how the banks are going to perform who already had elevated credit cost last quarter. And for slippages, which spiked last quarter because of agri seasonality, now it is expected to come down, and this time it will be favorable because of the agri seasonality and better rains that we have seen. And expectations are also working around the improving stress in unsecured retail segment, including the MFI. Now let's come to profit. Profit growth, we may see some kind of subdued performance from the bank. The banks like ICICI, HDFC and PNB, they may post marginal gains, but on the other hand, SBI, Axis Bank, Kotak Mahindra Bank, Federal Bank, these are the banks where we may see profit falling on a year-on-year basis. It is likely to be a tougher quarter for IndusInd and Bandhan Bank, because Street is expecting profit to decline anywhere over 50% on a year-on-year basis. Remember, there is one more thing to consider, is the treasury income. Last quarter, we saw treasury income provided a big boost to PSU profits in first quarter, but in this quarter, that is unlikely to happen because of the rising yields, which could keep the gains muted. And that is why we should also see how the gains are going to remain for PSUs. Remember, last quarter, the treasury gains accounted for more than 20% of their total PBT for banks like Bank of Baroda, Canara Bank, PNB and Union Bank. So what should investors be tracking this result season? 2 themes that we should be working out on. First is the net interest margins, which is likely to bottom out in this quarter. The full impact of the 50 basis point repo rate cut in the June will show up this quarter. And second is that the credit growth slowdown. We have already seen analysts are actually building up the credit growth expectations anywhere between 11 to 30% for the full year. So definitely that is something that we should be watching out for. Specifically on the stocks, I will be watching out on Axis Bank, which has been stuck with the single-digit loan book growth. IndusInd Bank for management commentary under new leadership, and also in terms of growth, I will also watch out for Kotak Mahindra Bank, where NIMs and credit costs actually disappointed last quarter, and PSUs to see any kind of impact which is expected because of the lower treasury income. So to conclude, when we talk about second quarter, earnings growth, it is holding up. NIMs, it is likely to be under pressure. Asset quality is improving and profit is likely to stay muted for now. But the silver lining is margins could bottom out, credit growth is inching up, and the second half of FY26 may finally bring some tailwinds back in the banking sector.
All right, thanks a lot for that. Gaurav, second half of this year will bring some tailwinds for the banking sector as credit growth looks like it is picking up and market is likely to expand as well. We'll watch out for how it pans out. Though it's time to now start beginning to wrap up on the market right now. 103-point decline is what we have for the Nifty right now, near 400 points. So yes, it will go down as a red tick, but more importantly, it's a tick where we saw demand at lower levels and supply at higher levels. So it was a range-bound session in that regard. The expiry belongs to the bears this time around. The Midcap index, that was the bigger casualty of today's trading session. Nearly 2,200 stocks which declined for about 700 stocks which ended higher. All the sectoral indices ended in the red today. So we had the Nifty Bank as well as the Nifty IT index, along with all the other indices as well, which ended lower. And towards the end, we saw a bit of a spike once back on the India VIX. Among the top gainers today, we had a couple of these IT names on the frontline index. We had Tech Mahindra, Wipro do well on the way down. We had Tata Motors, which traded ex-CV business, Dr. Reddy's, Tata Steel, among others. The stocks that gained from the broader markets, we had MCX, Tatacom, and Irida. All right, with that, we will wrap up on this edition of Closing Bell. But you stay tuned to CNBC TV 18 as Markets Forward takes all today's action into tomorrow and preps you up for trade ahead of the session.
Powered by LIC, हर पल आपके साथ. Co-powered by SBI, बेस्ट है सबको पता है. Co-powered by SBI. Best है सबको पता है.
Dalal Street fails to hold on to opening gains. A volatile session sees the Nifty and the Sensex end about 0.25% lower. The Midcap index falls nearly 1%, underperforming the blue chips.
LG Electronics India lists at a thumping 50% premium to its offer price of 1140, making it the latest member of the 1 lakh crore market cap club. Attractive valuations, dominant market position and a healthy growth runway see analysts give it a thumbs up.
HCL Technology pips revenue and margin estimates and posts a robust 40% quarter-on-quarter growth in the orders. It also guides for continued strong order inflows and services growth. The IT major also becomes the first one to report AI revenues.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading session. I'm Ekta Batra and with me is Reema Tendulkar. Well, Reema, it turned out to be a session which was weak, but we managed to recover for the Nifty. So we just about closed below 25,150. What stood out was the broader market weakness. We had the Midcap index, which was down around 0.7%, and an extremely dismal advanced decline ratio from the get-go. PSU banks didn't do too well in today's trading session. So the Nifty PSU Bank Index itself was down around 1.5%.
Metals and realty also took a bit of a knock. Both those indices down nearly 1%. On the way up, there was only one sectoral index which managed to close up in the green, and that was your Nifty Capital Market, and that's courtesy PSA. But we've got you covered over the next 20 minutes with all the big news, key developments in Dalal Street, the top corporate voices, and the events to track. Talking about it in greater detail, we'll do the movers and shakers with Hormuz stocks, which reacted to the Q2 update. So whether it's an HCL Tech, whether it's a Bank of Maharashtra, Just Dial slipped on the back of a muted performance. You also have, we'll delve into the key market events to watch out for tomorrow. But as always, let's go across to the first element of the day. Of the show. Hormuz now joins in. Hormuz.
You mentioned PSU banks and they were the big sulks of the day, even as the Nifty did manage to recover some ground from the lows. Not quite the case for a lot of the PSU banks. UCO Bank, Indian Overseas. Of course, these are low free float names, but still down around 3%, and almost all constituents of the PSU Bank Index ended lower in today's session. There were result reactions today. Bank of Maharashtra, well, slippages remaining at slightly elevated levels. So 3.5% lower at one point, was down almost 5% before the final tick. IREDA did well after its results that came out earlier this morning, and Anand Rathi Wealth gained almost 8% on very strong volumes today after its results. A lot of newsmakers dominated proceedings. MTAR Tech was up almost 13% today. Landmark Cars in reaction to its business update, and CE Infosystems was up almost 10% yesterday, adding another 9% in today's trading session. And stocks at 52-week highs despite a wobbly broader market. Stallion India reported results yesterday, continuing to build on to those gains. GM Breweries has been on a bit of a tear after it came out with results last week, and MCX now at record high levels, 5% higher on this stock today as well. And lastly, some of the broader market losers today. Vishnu Prakash Punglia was among the underperformers after a bit of a spurt. Apollo Micro was in a 5% circuit, and Aditya Birla Money was the one that was down around 6% in today's trading session. So some of the broader market sulks in today's trade.
Okay, all right, Hormuz, thanks very much for that. But the big story has to be, it was a blockbuster listing for LG Electronics, which listed at a 50% premium to its offer price of 1,140 rupees. The stellar listing makes it the newest entrant into the 1 lakh crore rupee market capitalization. This is the first Indian IPO to cross bids of worth over 4 lakh crore rupees. Upasna has been following the story. She joins in with more. Upasna.
Well, certainly the most awaited IPO, that is LG Electronics, listed on exchanges today, and it was certainly a bumper listing. Now, the IPO listed at a 50% premium at 1,710 versus the issue price of 1140 per share. The company raised nearly 3,475 crore from anchor investors, and it is a bumper in terms of subscription levels. It is the first Indian IPO to cross bids worth 4 lakh crores. Now, if we talk about the stock movement, the stock was down about 1.6% today at 1687 per share, making the valuation stand around 52 times its FY25 EPS. And the Mkap has also exceeded over 1 lakh crores. Now, if we compare the valuation with the other peers in the large appliances segment, it is somewhere in line with them. Havells, Voltas, Blue Star, the valuation of them stack up 1 year forward PE, that is around 45 to 40 times 1 year forward PE. Now, in terms of financial metrics of these companies versus the peers, mind you that the revenue growth of LG Electronics is lower than the peer average of 19%, but the company certainly outperforms in terms of its EBITDA margins, PAT margins, and also ROCE, which is at a record levels. Now, let us understand what the brokerages feel about this IPO. Now, Motilal Oswal expects the stock to trade at a higher multiple given the strong fundamentals and return ratios. Well, Nomura says that it expects a 10% revenue CAGR from FY25 to FY28, driven by multiple products, exports, and service initiatives taken by the company. Well, Ambit has also given up preferences in terms of line of companies, in terms of large appliances. It prefers LG Electronics the most, followed by Blue Star, followed by Whirlpool, and lastly followed by Voltas. In terms of target prices, Antique has given a target price of 1725, Motilal a target price of 1800, Nomura has given a target price of 1800 as well, Ambit has given a target price of 1820, but MK has given the highest target price, that is 2050 for the share. So overall, it's a good listing, and all consensus have given a buy rating on this one.
LG is a very big company, and say at a 2.9 billion level, and such a big company, you can't see a linear growth. I mean, there would be some fluctuations, but the best part is we are market leader, and even this year we further improved our market share for refrigerator and TV in the tune of 1.5 to 1.6%. Air conditioners we improved by 1%, microwave 1%, and for washing machine 0.1%. So it shows that a company, even after 28 years, improving their market share. So it indicates that we have not built our organization on the basis of some short-term disruption.
Right.
It has been built through a very long-term vision and strategy.
What's also interesting is that LG Electronics India market capitalization is at 13 billion, while its parent company in South Korea is valued at 9.4 billion, which means the Indian subsidiary is 40% more valuable than the parent. We have our guests also joining in on the show, Sudeep Bandyopadhyay and Jay Bala of Cash the Chaos. Sudeep, this pop that we've seen today of nearly 50%, is the valuation arbitrage catching up? It was cheap versus peers, and now with the kind of up move, it's caught up. But from here on, do you see, LG Electronics giving outsized returns? What could be the returns? Because the growth parameters, as Upasana was telling us, on the top line growth, it's not that it's growing very fast, and even estimates, brokerages are talking about a 12-13% kind of a revenue growth CAGR, the margins are better. So if the growth is going to be in line with the peers, now that the valuation arbitrage is played out, what next? You're on mute.
You're absolutely right. The valuation arbitrage was significant. Hello, can you hear me?
Yes, we can hear you. Go ahead.
Sorry. The valuation arbitrage was obviously there, and that led to this kind of rally on the first day of the listing. It was an unexpected lines. Now that to an extent the valuation gap has been narrowed, of course, it now quotes at a multiple which is slightly higher than the comparable peers. But if you look at the return ratios for LG, they are outstanding. I think the brand salience also is significant vis-a-vis many other peers. the spread of their products is also much better than many of the other competitors. So considering everything and considering the return ratios, they do deserve a better valuation. So I don't think the valuation will shrink. I think it can expand a bit more. We probably will give a valuation target of around 1800 based on whatever the facts and figures are there in front of us. So yes, there is scope for some growth further in terms of the valuation. So somebody getting an opportunity to enter or somebody who has the shares can wait a little longer for a better valuation for exit. But having said that, will it compound from here? The answer is no. It will be a performer, but it will not be an outperformer.
Well explained. Let's talk about HCL Tech. Now, HCL Tech closed flat. It opened up in the green with a gain of about 2.5%. But as the trading session progressed, it gave up all its gains to end absolutely flat. That said, the Q2 numbers were good. It was a beat on revenue, beat on margins, beat on deal wins. The company's top line grew by 1%. EBIT margins expanded by 110 basis points sequentially to 17.4%. Deal wins crossed $2.5 billion. And the company also, for the first time, quantified the advanced AI revenue, saying it's $100 million. Brokerages are bullish, neutral calls. The bullish calls are coming in from Jefferies, Nomura, CLSA, where they argue that the company's services revenue growth at 4 to 5% for this year, that's the guidance, is going to put it right on top of the large cap peer pack in terms of revenue growth. So that's what makes some of the bulls bullish on HCL Tech. But what needs to be watched as a trigger going ahead is margin expansion. So the current year margins are 17 to 18%, but historically it used to trade 18, 19%. So when the company gets back to that margin trajectory, we'll decide the re-rating from here on, according to analysts. Jay, considering that, despite the good numbers that we spoke about, the stock closed flat, gave up its gains. What does that tell you about the price action?
Overall, most of the frontline IT aren't looking great. They need to at least clock time for at least a couple of more quarters. And any bump up you see in frontline IT names like Infosys, TCS, and HCL Tech and Wipro, they are likely to be short-term based trading opportunity rather than medium to long-term investment opportunity. If my interpretation of the medium-term charts is correct, I think most of the frontline IT name will be below their all-time highs registered in late 2024, early 2025 for several quarters now. I think it's going to bore people to death being invested in IT. Maybe better off looking at second-rung IT names and third-rung IT names where the chart setup is much more better off. So avoid frontline IT names, including HCL Tech.
Okay, all right. Avoid frontline IT names, including HCL Tech. Well, we have Infosys as well as Wipro, which will be coming out with numbers this week. So it'll be interesting to see what they deliver. But Tata Motors passenger vehicle business, including JLR, kicked off trading in its demerged avatar today. It now commands a market capitalization of 1.5 lakh crore rupees. The pure play CV arm will list on a later date. Sudarshan is here with all of the details on this.
So it's finally happened. Tata Motors demerger scheme has come into effect today with the listing of Tata Motors passenger vehicles at a price of rupees 400 per share. And finally, at the close, the price for Tata Motors passenger vehicle was rupees 397 per share. And the discovered price for Tata Motors commercial vehicle business was around rupees 260 per share. But we'll have to understand what exactly will come under passenger vehicle segment and what will come under commercial vehicle segment. So overall, under Tata Motors, majorly three businesses were there. First, JLR, second, Tata Motors passenger vehicle, and third, Tata Motors commercial vehicle. Now, after demerger, under passenger vehicle, the first segment that will come is JLR, second, India passenger vehicle, and third, company stake in Tata Technologies. Under commercial vehicle, India commercial vehicle business will come that consists of both trucks and buses. Now, going forward, so Tata Motors passenger vehicle is listed. Commercial vehicle segment is going to be listed in next 30 to 45 days. And that time we'll get to know exactly at what price it gets listed. As far as the value goes, some of the brokerages have come out with the valuation overall. So, as per JP Morgan, it has valued passenger vehicle segment at rupees 392 per share, commercial vehicle at rupees 306 per share, Nomura has valued PV at rupees 365 per share, and CV at 367. As per Nuvama, passenger vehicle segment is valued at rupees 410 per share and CV at rupees 280 per share. Apart from that, company has also got approval from Corporate Affairs Ministry for the name change, and for passenger vehicle segment, new name is Tata Motors Passenger Vehicles Limited.
Okay, all right. Well, Sudeep, have you looked at the demerged version of Tata Motors, and what's your sense?
Well, I think it's a good thing they have done. I think it brings in sharper focus because these two are different animals altogether. And with EV coming in the mix, I think it's better they have done it. As far as the valuation of JLR and passenger vehicle piece is concerned, I think we were expecting around 400, got listed there. I think it's trading there as well. We'll have to see the commercial vehicle listing as and when that happens. But I strongly believe that the commercial vehicle segment with a sharper focus will continue to perform and perform much better than probably what it was performing in a conglomerate kind of a setup. So let's wait for that listing of that and the performance of that, because you see the passenger vehicle is a very, very competitive space, and the competition is becoming more intense with electric vehicle coming in the mix. Whereas the commercial vehicle segment, while Ashok Leyland is a competitor, but I think Tata commercial vehicles also will have a very good play, and they can aim for leadership after some time.
Thanks for that. Let's get in some more stocks which are in the news. Just Style slipped after Q2 numbers disappointed. IREDA, IRDA soared. MTAR Tech hit a 52-week high. So let's just get in the news behind these stocks. Ria joins in.
Well, yes, Just Dial ended nearly 5% lower after its Q2 numbers. The slow growth for the company has continued in this quarter. Revenue has gone up by just around 1.75% sequentially and up 6.5% on a year-on-year basis. The revenue growth has been in single digits for the last 5 quarters now for the company, and EBITDA margins have remained steady at 28.7%. Net profit has also gone down by around 22.5% on a year-on-year basis due to an increase in the tax rate. Moving on to MTAR Tech, which on the flip side was higher by around 11% today. Brookfield has backed Bloom Energy, which is MTAR Tech's key client, with $5 billion for fuel cells to power AI data centers. Now, in terms of what MTAR Tech's role is in all of this, they are the key strategic supplier to Bloom Energy, supporting its solid oxide fuel cell as well as solid oxide electrolyzer programs. They are also the sole supplier for Bloom's electrolyzer units, which is a critical, which plays a critical role in Bloom's supply chain. And they also currently cater to approximately 50 to 60% of Bloom's hotbox requirements, which is why the stock was soaring in trade today. IRDA also ended up around 3% today. The net interest income for the company in this quarter has gone up by nearly 50% on a year-on-year basis. Even the operating profit has gone up by around 55%. Provisions, although, have declined sharply sequentially by 80% on a sequential basis, and net profit is also up by nearly 42% for the company.
Okay, all right, Ria. Thanks very much for that. And Sudeep as well as Jay, thanks very much for joining in and taking us through all of your views. We need to take a short break now, but we'll get you all of the top corporate voices along with key market events to watch out for.
Welcome back. Let's get to the key corporate voices of the day. Anand Rathi Wealth Management told us their core strategy remains buy low, sell high. The firm continues to aspire towards 1 lakh crore rupees in AUM by FY26, with the revenue growth guidance maintained for the current fiscal year. They also highlighted that over 200 client additions in the September quarter is now set as the target run rate for the second half of the year too. The firm's near-term AUM target stands at 1,000 crore rupees.
Next, we spoke to KEC, the management, who shared that new orders are coming in with margins above 10% and an average execution timeline of 18 months. The company is currently working on tenders worth 15 lakh crore, with international orders totaling around 30,000 crores. Collections of around 700 crores are pending in terms of the firm's water portfolio project. The firm maintains a margin target in the range of 8 to 8.5%.
And with Diwali around the corner, we'll get you a festive musical glimpse of insightful conversation with India's top market masters, Vijay Kedia, Sridhar Shivaram and N. Jay Kumar, as they join our colleagues Mangalam and Nimesh for a special Diwali Mehfil.
The other asset class that I have been speaking about is gold.
Yes.
And there are a lot of skeptics in the market about gold. In fact, in the last 1 week, I've seen more skepticism on gold than anything else.
Are you really talking about skepticism in the gold? Because we hear, on the other hand, a lot of people actually saying, "Oh my God,
I buy
gold,
ETF?
should I buy gold?"
So the people, I'm guessing that the people who missed out on the gold rally, they come out with, random data that, how gold has underperformed between 1980 and 2000. How gold is a very volatile asset class. And in most cases, they sort of give out a dollar return number, whereas it is for the Indian investor, it is the rupee gold that matters. And as I've said many times, that gold actually is a store of value and also is a hedge against currency. People miss the hedge against currency. So if you go back to 1980, the rupee was 9 rupees. Today it is 85 rupees. So you've got a compounded return of 4 to 5% just on currency. So if I want to put it in a song, I would put it in this way. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल। महफिल ये नहीं तेरी, दीवाने कहीं चल। कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल।
Last 1 year, the Nifty has actually gained just about 4%. Gold is 60%.
Yeah,
60%. Silver is, I think, even
also, yes,
much higher than that. So you had a nice repartee to that. What was that?
श्रीधर भाई को ये बोलना चाहता हूँ भाई कि ठीक है, ये तो गोल्ड मैन है, अपने बोल्ड मैन है। तो मैं इनका बात का जवाब दूंगा कि ना चाहूँ सोना चांदी, ना चाहूँ हीरा मोती, ये मेरे किस काम के। ना मांगू बंगला बाड़ी, ना मांगू घोड़ा गाड़ी, ये तो है बस नाम के। लेता है शेयर ले बदले में सबके, लेता है शेयर ले बदले में सबके। ओरे साहिबा शेयर से सौदा नहीं।
क्या बात।
It's a nice contra to what
So the next 1 year, how do you foresee the next 1 year when it comes to earnings, when it comes to the macros, when it comes to micros? If I had to ask you to bet on a few themes and a few ideas, what would they be for, say, summer 2083 when we hopefully gather once again for a mehfil?
So I'd like to talk about 2 or 3 sectors. My number one sort of bullish case is for banking. I believe that when any economy reopens up or opens up for foreign capital, banking is the first space that will attract money. So I think NBFC consolidation, money coming into private sector banks, more and more deals like the Yes Bank kind of deals, I think we'll get to see and hear. over the course of the next
That
few
be
quarters.
the ones that have fallen so far? Or?
I think it's not a question of follow. I think these are platforms that can't be replicated. Like NBFCs, there are infinite number of NBFCs in a manner of speaking. But there are a finite number of banking licenses, no new licenses to be given. So I think banking sector could attract disproportionate amounts of capital as people, especially foreign banks, come in to take stakes in the Indian context. I think that's going to be a big theme going forward.
Okay, and on that musical note, we're going to get to all of the events to watch for tomorrow. Ria joins in to tell us more. Ria.
Well, yes, we have the industrial production data coming out of Europe tomorrow. In India, we have the trade balance data as well as the RBI MPC minutes to watch out for. A whole host of companies are coming out with their quarter 2 results tomorrow. Watch out for Angel One, Axis Bank, Delta Corporation, HDB Financial Services, HDFC AMC, HDFC Life Insurance Company, as well as IRFC, KEI Industries, L&T Finance, Oberoi Realty, and Tata Communications. HDFC AMC will also be holding a board meeting to consider a bonus issue, whereas HDFC Life Insurance and Wellspun Enterprises will be holding board meetings to consider fundraising options. In other events, the World Bank IMF annual meetings continue until the 18th of October. Also watch out for the IMF Fiscal Monitor press briefing. Fed Chair Jerome Powell gives a speech at the National Association for Business Economics at their annual meeting. And lastly, in the US, we have the G20 Finance and Central Bank Governors meeting on the 15th and 16th of October.
Thank you very much for that. And that brings us to a close in this edition of Markets Forward. Many thanks for watching.
Co-powered by SBI. Best है सबको पता है. Presented by Standard Chartered.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Lal Street fails to hold on to its opening gains. The Nifty and the Sensex end 0.25% lower after a volatile session. The Midcap index falls nearly 1%, underperforming the blue chips.
2, 1.
It's a blockbuster debut for LG Electronics. The stock lists at a 50% premium, eclipses its South Korean parent's $10 billion market cap on day one itself. The management tells CNBC TV 18 premiumization and better margins are their key focus areas. China says it was ready to fight to end till the end amidst the renewed trade tensions with the United States and the tit-for-tat port fee. Beijing sanctions 5 U.S. subsidiaries of a South Korean shipbuilder. U.S. Treasury Secretary Bessent tells Financial Times that China wants to pull everyone else down, but tells Fox News that the Xi-Trump meeting later this month is still on track. Google to invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. This would be the tech giant's largest AI hub outside of the US. Union IT Minister Vaishnav urges Google to make reskilling a part of their AI investment. Infosys wins a £1.2 billion contract to modernize the payroll platform of England and Wales public healthcare system. Under the 15-year contract, Infosys will replace the existing electronic staff record with the next generation payroll platform for 1.9 million employees. The Supreme Court notes that the title is not clean for all 88 Sahara properties that the Adani Group intends to buy. Several pleas in the Supreme Court claim ownership. EPFO issues notice to the Adani Group to clear Sahara Employee Provident Fund dues of 1,500 crore rupees as the proposed buyer. Tata Motors demerger scheme comes into effect in the shares of passenger vehicle segment lists at 400 rupees a share. The commercial vehicle, for which discovered price comes around 260 per share, will be listed in a month. Many families still await the return of bodies of deceased hostages, even as Trump declares the Gaza war is over. The Israel army says 4 hostages have been identified. The US president says he's yet to make up his mind on the two-state solution. Russian forces launched aerial bombs and drones against Ukraine's Kharkiv in an overnight attack, damaged the city's main hospital, injured civilians. Ukraine's President Zelensky says he will travel to the US this week to discuss potential supply of long-range weapons. Well, let's start with the day's market action. The Lal Street ending the day with cuts after a volatile session. The Nifty and the Sensex ended the day 0.25% in the red. Midcaps fell nearly 1% today, underperforming the blue chips. 80 points lower, 297 points lower on the Sensex. The Nifty Bank down by over 100 points in 430-point cut there on the Nifty Midcap, so not being able to hold on to the morning gains. Inflation wholesale price index for September dipping to 0.13%. This was largely led by the softening of prices in food articles, fuel and manufacturing products. Meanwhile, trade tensions between US and China continue to intensify. China's Commerce Ministry has said the government is ready to fight to the end in a trade war with the US. This after US President Donald Trump said he would impose an additional 100% tariff on the world's second largest economy. In a post on X, China's Commerce Ministry spokesperson said, and I quote, "Threatening high tariffs is not the right way to deal with China. The US should correct its approach and act on the common understanding that the two presidents have reached in their phone calls," end of quote. US Treasury Secretary Scott Bessent criticized Beijing for imposing new export controls on rare earths last week. In an interview with Financial Times, Bessent said, and I quote, "This is a sign of how weak their economy is and how they want to pull everybody else down with them. If they want to slow down the global economy, they will hurt the most," end of quote. The Chinese government has also hit back at the Trump administration. The Commerce Ministry announced it is imposing sanctions on 5 US-based subsidiaries of South Korean shipping giant Hanwha Ocean. Now, the Chinese government has accused them of aiding Washington's restrictions on Chinese maritime, logistics and shipbuilding sectors. Eunice Yoon brings us the latest.
China is taking aim at U.S.'s efforts to revive its shipbuilding industry. Today, the Commerce Ministry sanctioned 5 U.S.-linked units of the South Korean shipbuilder Hanwha Ocean. The ministry said Hanwha's subsidiaries in the U.S. have assisted and supported the U.S. government's probes and measures against Chinese maritime, logistics, and shipbuilding sectors. China is strongly dissatisfied and resolutely opposes it. The ministry said that that companies and people here will no longer be able to work with Hanwha Ocean, which runs a shipyard here. China dominates the shipbuilding industry, but Korea and Japan are seen as countries that have more advanced shipbuilding technology. In fact, the Trump administration has said that the two U.S. allies were going to be very important to reviving the U.S.'s shipbuilding industry. The Chinese move also comes, though, as the same day as when both countries are now hitting each other with fresh port fees on each other's vessels. And it also comes as China launches an investigation, a counter-investigation into Washington's Section 301 probe on Chinese shipping and shipbuilding industries. The Transport Ministry had said that they will be undertaking an investigation and looking into countries, companies, and organizations, as well as individuals that help the U.S. undertake discriminatory, restrictive behaviors against China's shipbuilding supply chain. Frank?
Unisoon, many thanks for joining us. A stellar the Wall Street debut for LG Electronics India. The stock listing at a 50% premium, eclipsing its South Korean parent's $10 billion market cap on one day. The stock closed 1% lower than its listing price. Remember, the 11,600 crore rupee issue received bids worth more than 4.4 lakh crore rupees, making it the most bid Indian IPO ever. Upasana is here with more details on the bumper listing. Upasana.
Well, certainly the most awaited IPO, that is LG Electronics, listed on exchanges today, and it was certainly a bumper listing. Now, the IPO listed at a 50% premium at 1,710 versus the issue price of 1,140 per share. The company raised nearly 3,475 crore from anchor investors, and it is a bumper in terms of subscription levels. It is the first Indian IPO to cross bids worth 4 lakh crores. Now, if we talk about the stock movement, the stock was down about 1.6% today at 1687 per share, making the valuation stand around 52 times its FY25 EPS. And the Mkap has also exceeded over 1 lakh crores. Now, if we compare the valuation with the other peers in the large appliances segment, it is somewhere in line with them. Havells, Voltas, Blue Star, the valuation of them stack up 1 year forward PE, that is around 45 to 40 times 1 year forward PE. Now, in terms of financial metrics of these companies versus the peers, mind you that the revenue growth of LG Electronics is lower than the peer average of 19%, but the company certainly outperforms in terms of its EBITDA margins, PAT margins, and also ROCE, which is at a record levels. Now, let us understand what the brokerages feel about this IPO. Now, Motilal Oswal expects the stock to trade at a higher multiple given the strong fundamentals and return ratios. Well, Nomura says that it expects a 10% revenue CAGR from FY25 to FY28, driven by multiple products, exports, and service initiatives taken by the company. Well, Ambit has also given up preferences in terms of line of companies, in terms of large appliances. It prefers LG Electronics the most, followed by Blue Star, followed by Whirlpool, and lastly followed by Voltas. In terms of target prices, Antique has given a target price of 1725, Motilal a target price of 1800, Nomura has given a target price of 1800 as well. Ambit has given a target price of 1820, but MK has given the highest target price, that is 2050 for the share. So overall, it's a good listing, and all consensus have given a buy rating on this one.
यह IPO LG के लिए सिर्फ एक वित्तीय उपलब्धि नहीं है, बल्कि यह एक नए भविष्य की शुरुआत है, जिसे हम भारत के लोगों के साथ मिलकर बनाएंगे.
We are introducing a new lineup of products which will be targeted for the volume zone customers.
Right.
And we want to give them an experience for our premium products.
Right.
And on the other hand, we will also scale up our new businesses like B2B, information display panel, HVAC system, service business, and our third plant will also fuel the next level of growth in our business. That margin is a combination of many things. One is your growth in business. Second is the localization rate. Our current localization is 54%, and every year 2 to 3% it will improve.
Correct.
And the biggest strength which is contributing to our margins are major key components we manufacture in-house.
Well, that's the bumper listing there of LG India, and the man who stole hearts and the show was the LG India CEO. Whole speech there in Hindi. The demerger of Tata Motors passenger vehicle and commercial vehicle business took effect today. A special pre-open price discovery session valued the shares of the company's passenger vehicle business at 400 rupees a share, the stock closing 1.5% lower than the price. The commercial vehicle business is likely to be listed within a month at 260 rupees a share. Now, the automaker's board approved the demerger last year to streamline operations. Sudarshan is standing by with more. Sud.
Tata Motors demerger scheme has got effective today, and now on the screen the price you are seeing is of Tata Motors passenger vehicles. So for commercial vehicles, it will be listed only after a month or say a month and a half, that is 30 to 45 days. Now, what would be consisting of Tata Motors passenger vehicles? So JLR business, India passenger vehicle business, and the stake that company holds in Tata Technologies, that will be part of Tata Motors passenger vehicle business. In commercial vehicle business, both truck and bus business would be part of Tata Motors commercial vehicle. So what's the value that brokerages have put out? As per JP Morgan, passenger vehicle business total, JLR, India passenger vehicle business, and the company's stake in Tata Technologies, value as per JP Morgan is rupees 392 per share, and for CV business is 306 per share. As per Nomura, PV's value is rupees 365, and for CV it's rupees 367, and as per Nuvama, PV value is rupees 410, and CV it's rupees 280. So today Tata Motors passenger vehicle business lists at rupees 400 per share. Now if you derive the price for commercial vehicle business, it comes around rupees 260 per share.
All right, that's the Tata Motors demerger laid out for you. So many thanks. Tech giant Google would invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. This will be the tech giant's largest AI hub outside of the US. Ashmit standing by now with more. Ashmit, it's a big win for India and a big bet that Google's making.
Well, Google today making its big ticket announcement, announcing its single largest investment here, its commitment here to the Indian market, $15 billion to be pumped in, beginning 2026 all the way down to 2030 over a 5-year period. To what purpose, to what end will this $15 billion be used? Well, Google is setting up its largest AI hub in India, the largest, in fact, outside of the United States. This will be set up in Vizag in the state of Andhra Pradesh. What we're also learning is that this will have a capacity of 1 gigawatts. The aspiration that Google has is that subject to demand, subject to takeoff, it is likely to be expanded even further. To make this big ticket announcement, in fact, in attendance were the likes of Finance Minister Nirmala Sitharaman, the Chief Minister of Andhra Pradesh, Chandrababu Naidu was also here, the Minister of Rail, IT and INB, Ashwini Vaishnav, was also in attendance. The commitment that has come from the state of Andhra Pradesh is that they will pull out all stops to ensure that such a project goes through. And in fact, off the record, some of the senior government officials in attendance, they're telling us is that this is the first of many more such announcements to come, that there are many other companies outside of Google which are also looking at India for setting up their data centers and AI hubs. So the first of many for now, Google committing $15 billion for its largest AI hub outside of the United States in Vizag in Andhra Pradesh.
This AI hub will be a very important contribution to the AI mission goals in 3 different ways. First, skilling. We all know that AI is fundamentally changing the way the world moves today. Under such circumstances, there is a serious concern among a lot of IT professionals of what their jobs will be, where they would, how their lives will be impacted. So it's very important for all of us, especially the industry, to reskill and upskill our IT professionals in a major way.
Even Hyderabad, I brought Microsoft at that time. First time Microsoft has come to Hyderabad. Today, Google has come to Visakhapatnam. We are very happy. According to me, we are in an inspiring time.
Andhra Pradesh has been looking for different kind of investments, new investments, futuristic investments. So data processing, AI is one of them. So therefore Google coming is the initial step. Now, we have signed a lot of NDAs with other companies as well, but eventually, all the major companies that require this kind of AI computing power will land in Vizag.
Well, that's Google's big bet on India. Now, ChatGPT maker OpenAI has inked another deal, and this time with semiconductor giant Broadcom. Both companies will develop and deploy 10 gigawatts of custom AI chips and computing systems over the next 4 years. Rachna joins us now with more details. Rachna, take us through the OpenAI Broadcom deal.
Well, another day, another deal by OpenAI. But this one is a bit different, though. Now, OpenAI has entered a strategic partnership with Broadcom to co-design and produce proprietary artificial intelligence chips, marking its first major step into semiconductor development. This move is aimed at reducing OpenAI's dependence on GPU suppliers such as NVIDIA and AMD, giving it end-to-end control over the hardware powering its models and data centers. The timing, however, is striking. The Broadcom collaborations comes just weeks after OpenAI signed over $100 billion worth of long-term GPU supply agreements with NVIDIA and AMD. These deals secured next-generation processors like AMD's MI450 accelerator. Now, these accelerators fuel OpenAI's training and inference workloads through the decade. Under the new Broadcom deal, though, OpenAI will focus on chip architecture and design, while Broadcom will handle fabrication, deployment, and networking integration. Together, the companies plan to develop and deploy up to 10 gigawatts of custom AI accelerators beginning in late 2026. The deal value isn't disclosed, but in September, Broadcom had disclosed that it had a new client and an order of about $10 billion from them. Now, the street believes that it is a part of a broader order that OpenAI has placed, which is now estimated to be about $500 billion. Now, these chips will be used exclusively within OpenAI's own systems and are not intended for external sale. The partnership underscores a broader industry shift towards in-house silicon, which is similar to strategies that we've seen at Google, Amazon, and Meta, who are all racing to secure compute independence amid soaring AI infrastructure costs and global chip supply constraints. OpenAI CEO Sam Altman called custom accelerators critical to the next frontier of AI capability, describing this initiative as a cornerstone of OpenAI's path towards super intelligence level systems. Now, analysts say that this deal signals a new hybrid hardware strategy for OpenAI, securing near-term GPU capacity from the incumbents while simultaneously building long-term autonomy through proprietary chip design. With Broadcom packed, OpenAI effectively joins the ranks of full-stack AI companies, controlling their entire hardware-software pipeline, which is a move that could reshape both the economics and geopolitics of AI compute.
All right, Rachna, many thanks for joining us. Moving on to Infosys, shares of the company up in trade today after it announced that it has been awarded a contract worth £1.2 billion, which will span for 15 years. The contract has been issued by UK's NHS Business Services Authority to deliver a new workforce platform for England and Wales. Under the contract, Infosys will replace the existing electronic staff record with a next-generation payroll platform for 1.9 million employees. We'll head into a break, but coming up next, many families still await the return of bodies of deceased hostages, even as Trump declares the Gaza war is over. That and more when we get back.
investing.
President Trump and the leaders of Egypt, Qatar and Turkey have signed a declaration in Egypt meant to cement a ceasefire in Gaza. President Trump called the day a tremendous moment for the Middle East. However, the president said he's yet to make up his mind on the two-state solution. This came hours after Israel and Hamas began the exchange of hostages and prisoners. Meanwhile, the Israel military has said it opened fire in northern Gaza after suspects approached its forces. This as President Trump reiterated again that the war in Gaza is over.
After years of suffering and bloodshed, the war in Gaza is over. Humanitarian aid is now pouring in, including hundreds of truckloads of food, medical equipment, and other supplies, much of it paid for by people in this room. A new and beautiful day is rising, and now the rebuilding begins. The rebuilding is maybe going to be the easiest part. I think we've done a lot of the hardest part, because the rest comes together. We all know how to rebuild, and we know how to build better than anybody in the world.
I would say that Pakistan had nominated President Donald Trump for Nobel Peace Prize for his outstanding, extraordinary contributions to first stop war between India and Pakistan, and then achieve ceasefire along with his very wonderful team.
Well, that's President Trump and Pakistan's Prime Minister. Now, the International Air Transport Association has said that persistent supply chain challenges could cost global airlines more than $11 billion in 2025. According to IATA's report, postponements in aircraft deliveries and engine repairs are forcing airlines to operate older, less fuel-efficient planes. Madiha standing by with more. Madiha, no let-up there as far as the supply challenges are concerned for the aviation sector?
Absolutely. $11 billion is a huge number. The airline industry is facing a perfect storm of rising costs and delayed aircraft deliveries, as you mentioned. There are about 17,000 aircraft pending to be delivered as of 2024. According to the International Air Transport Association, new aircraft deliveries continue to be delayed, forcing airlines to fly older and less fuel-efficient jets. And that alone means carriers will spend nearly $4.2 billion extra on just fuel in 2025. And add to that an aging global fleet, and the cost pressure is mounting. IATA estimates that another $3.1 billion will be required by airlines to go towards additional maintenance of older aircraft as they require more frequent and expensive checks. Engine issues are compounding the problem. Since engines are spending longer on the ground for repairs and maintenance, airlines are being forced to lease more spare engines, and that's adding about $2.6 billion to their bills. And it doesn't stop there. Aircraft lease rates themselves have jumped 20 to 30% since 2019, tightening margins even further for carriers already struggling with rising costs. So while passenger demand remains strong, supply chain constraints from delayed jets to engine shortages are shaping up to be a multi-billion-dollar headwind for the global airline industry in 2025.
All right. Many thanks, Madiha, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with plenty more.
Presented by Standard Chartered. special partner, Novama. Let's do it right.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. With Diwali just round the corner, gold and silver prices are shining brighter than ever. But let's talk about silver first, where the prices hit an all-time highs at near $53 an ounce in the global markets before pairing some gains amid a historic short squeeze in London. Silver lease rates, which represent the annualized cost of borrowing metal in the London market, have surged to a 36% on a monthly basis. Silver prices have surged 85% so far in this year, surpassing gold's gains, which stands at nearly 58%. In India, too, the silver prices are at a record highs. The geopolitical developments, including the renewed US and China trade tensions, private investment demand, as well as expectations of another rate cut by the US Federal Reserve, are fueling the rally. So where are silver prices heading next, and how will the higher prices impact demand this Diwali? Joining us now to discuss all of that are Nitesh Jain of Purple Jewels and Abhay Ranka of Navkar Sterling Silver. Gentlemen, hi, thank you so much for joining in, and very happy festivities to you. Nitesh Jain, to you first. And first of all, the first question really is about the silver prices. Where do you see them going forward from here?
See, looking at what is happening around us, I think there is a lot of shortage of silver, which the data set tells us. And it's not just the Diwali hype that is there. It is a lot of, the central banks are buying, the governments are buying, the industries want to safeguard their future prices. That's why they are stocking up. So silver, and it is not able to meet the actual demand of the industry. It's not just the Diwali and the domestic, the demand which is actually increasing the prices, but it is an overall overview, like, from every angle, silver is being attacked and silver is moving high and high.
At these levels, Nitesh, where do you see the silver rally stopping?
I think silver is still cheap. You should continue buying silver. We are looking at a much higher target. We have broken the, the highs of all time, and this will, probably silver will set to create a new bigger high, maybe somewhere around $60–65 is what we are seeing.
$60 to $65 an ounce is where silver prices are headed. Before we go ahead in any of this conversation, Abhay, the first question to you also is about the silver prices itself. What is your sense on where are those prices headed?
Definitely the kind of prices that we are seeing now is much like Nitesh has said, the demand जिस तरह से चल रही है, the price should definitely meet up to about $65–70 very soon. We see a smaller correction anytime in between, but then again that will just to create a panic के नीचे आने वाला. After that, it is going to be a bigger rally for sure. It is the price would be at any point by $65 to $70.
All right. So $60, $65, $70 an ounce is where the silver prices are headed, as according to our experts here. But I do want to also understand on what is the demand that we're looking at in the markets right now. Abhay, when you are going out to buy silver for your own manufacturing or your jewelry buying, etc., are you getting silver immediately? Is there a premium that you have to pay? Is there a lot of wait that you have to do?
Definitely, there is a wait of about 15 days for minimum. There is a lot of FOMO buying which has been done recently. People, the one who doesn't want to buy silver, also looking at the price that is going up now. FOMO ke karan, they are just going and buying ke bhai baju wala liya hai, mujhe bhi lena hai. The kind of panic that is created कि मुझे नहीं मिलेगा या फिर लग रहा है कि और रेट बढ़ रहा है. And definitely, every day you're finding a new high. So there is a premium of about 15,000, 20,000 that is going on. Just the one who has the raw material ready, unka price चल रहा है market में.
So people who have been holding silver clearly are ruling the markets at this point in time. Nitesh, what is your sense onto this one? As Abhay tells us, there is a premium, there is a 15 days waiting period if you want to get silver today. Is that exactly what you seem to be facing as well?
Exactly. It's the same throughout. There is no availability of silver with the bullion dealers. They are not getting their deliveries, and because of that, we are not getting our deliveries. And what is happening is even there's a lot of import issues. A lot of silver which has to come from maybe Dubai or London and these places, the silver there itself is selling at a high premium of almost $2, $3, $4 an ounce. So all that silver which was to be sent to India or which has been booked for India has not been delivered, and it's selling off shelf in the market because India does not mine much silver. The overall, whatever silver that comes out from the mining of zinc as a byproduct is what silver we have in India. So we are a lot dependent on imports, and imports are not coming in as of now. So there's a lot of demand for silver. Diwali being there, and a lot of production has to happen, and still we are not getting. This is for the first time we are facing that there's a huge demand, but there's no availability of raw material for manufacturing.
All right. That must be some place to be right now where there's a strong demand. The price is on the higher side as well, but there is no silver into the markets. Nitesh, talk to us about the demand itself. What are really people buying at these higher prices? The festival buying, that is. I understand there are two kinds of buyers in the market right now. One is the invest-in buyers who are perhaps buying bars and coins, but the retail buying, the Diwali buying, the gifting buying, how is that happening?
The retail buying is happening, but a lot of gifting buying is not happening, is what we see.
Okay.
Like today, silver has kind of, jumped so high that, gifting a 10-gram coin, which earlier was the norm, has stopped quite a bit. And there's no availability also. Like today, if somebody has the budget also and he wants to go and buy to gift, say, silver coins, it's not available in the market. And so what generally a jeweler would do is keep a lot of, silver articles and silver jewelry in his stock. So that is what he's able to sell. He's not able to sell silver coins or silver bars because it is not available in the market, though there's a lot of demand for it.
Oh, wow. So you as sellers, are you guys also charging premium? Because you have to pay a premium. So are you passing it on?
It has to be, because ultimately what we try to do is we try to maintain our stocks throughout the year. Because that's our only hedge. We would not like to lose our position on our stock. So what we do is how much ever silver that we are selling, we try to hedge it by buying it against our sell in the market. So what happens is at whatever price that we have is available to us is the price that we would sell it at. So ultimately the premium passes on to the end buyer. But then I feel that's a temporary premium because of the unavailability of silver, and that will come down over a period of time, and that will be the only price correction I think you will see, not in terms of dollars, but definitely in terms of premium. The prices would come down, but it is set to go higher.
But even that 10-15% of a premium that everybody is paying in India, even if that comes off, it would be a good level to start buying there. Abhay, what is your sense? Yeah. Nitesh, you were saying?
No, it will be a good, time for people to enter. Those who are looking at investments, but festive buying is, you do it during the festive time, you can't help it. You have to pay that premium now.
All right. Abhay, what is your sense? What are people buying according to you? And this whole premium story, do you see it going away anytime soon?
It is just a panic buying that is just because there is no raw material available. Uske karan you see a lot of people wanting to buy more. When you say no, they wanted more. The moment you get the availability of the raw material, it will all stabilize, and then probably it will all be set. And looking at the market demand, definitely people are buying. When they are not buying, they're not getting the silver bars or coin, they are moving to puja articles and such kind of buying that's been happening now of late.
Oh, absolutely. Abhay, when we look at MCX, and that perhaps is a reference price for a lot of us, we look at price of around 1,60,000, which has been an all-time high, and currently trading at around 156 or so. What is it that is being asked in the spot markets as of now, if you were to buy a coin or a puja article, etc.?
The retail segment is good, easily charging about 2,02,000 to 2,10,000. The coin are being sold at 220 per gram at a lot of other places also. We see a lot of other people who are coming with the old silver and buying their anklets in small town, 2-tier cities, whereas in tier 1, people are going for cash buying now.
Are you looking at this trend as well, Nitish? A lot of people coming with their old silver. Have you seen that exchange or fabrication demand go higher?
Yes, see, these are prices where, no one thought that silver would be at. But it was, a lot of indicators were there. If you would see, like a lot of industrial buying was happening, a lot of industrial demand, a lot of silver dependency in this new age world. So, these indicators were there, but a common man does not know all this. So for them, this is a very big high, what they have seen in last 1 week, 10 days, 15 days. So they are like, probably these prices are not going to remain, and they want to make the best of it, come and sell their old silver, make some money out of it, and then probably they are thinking they'll buy it at a lower price.
Okay. And what is the quantum really, Nitish? Earlier, I am assuming not too many people would come out and sell silver. So if silver exchange was 5% of a market, where does it stand right now?
It has gone higher, definitely a lot of, because see, people also don't want to, who think that the silver prices are very high, they don't want to invest at these prices. So what they do is, whatever their dead silver or unused silver at home for the festive, or if at all they want to have a marriage at home and still want to give away to their daughter or something like that, what they do is get whatever is left at home which we are not using, let us go and exchange it, and then probably replace that with new buy when the prices are lower. So that's the thing happening. So there's a lot of old silver which has come into market, and that is good in a way, because that will create an availability of raw material for the manufacturers.
Right.
If that silver is refined, and because if we get the cash also for the silver that we sell, we are not getting the availability of metal with our suppliers. So any kind of exchange is good for the market.
All right, whatever is happening right now is pretty good for the market. Festival season, silver prices at all-time highs, but there is demand and there's a premium that is being paid as well. And as Nitish and Abhay tell us that the premium is as high as 10 to 20,000 rupees there, and both of them also believe that you could be looking at 60 and 65 and $70 an ounce of prices going forward. Thank you as always, Nitish, Abhay, for joining in and making sense of really what really is happening in the silver markets when it comes to India as a market there. Well, with that, let's go for a short break. When we come back, we will take you through gold prices, because that's trading at an all-time highs as well. Joining us now would be Sayam Mehra to talk all things gold, jewelry, and of course bullion after this break. Welcome back. You're watching Commodity Champions Diwali special. It's time to throw the spotlight on gold, which has been soaring to new highs every day. Prices in India hit 1.28 lakh per 10 grams for the first time, while in the global markets, gold touched $4,180 per ounce for the first time. So far in 2025, gold has jumped around nearly 59%. Traders have priced in a 97% probability of a U.S. Fed rate cut in this month, and U.S. and China trade tensions and prolonged U.S. government shutdown have also boosted gold's safe haven appeal. Amid the spike in prices, India's jewelry demand is estimated to decline 10% on yearly basis. How are Indian jewelers bracing for this? Joining us now to discuss expectations on gold is Sayam Mehra of Unique Chain. Sayam, hi, thank you so much for joining in. Well, it has been a good surge in gold prices, all-time highs, a string of that, by the way. But what gold doesn't have is the silver squeeze that silver seems to be facing. There is enough gold availability, but even despite that and in spite that, we are looking at a premium being charged in the Indian markets. With the kind of demand that we are looking at for India, would you say did the industry at all expect it?
We are seeing, as you said, Manisha ji, that $30 to $35 of premium or 0.5% of gold, which is higher than the actual MCX rates or other rates are there in the market. Still, when we saw the demand 20 to 25 days, the demand was a little less. There were very less footfall in the showrooms which were there. But since the last few 10 to 12 days, we are seeing that the demand has increased of gold from B2B sector also. There's a lot of jewelry which is being bought in the end retail stores. When the retailers have already kept on buying for the last 3 months, they had kept on buying gold, cutting the gold rates. They are enjoying the whatever gold which was bought from the fellow manufacturers, wholesalers. They are enjoying the benefits of the rate increase also, and they are passing on with some benefits to the end retailers also. So we are looking at this new high also. We are not facing that much heat from the end consumer, and we are seeing a lot of buying which is happening on the ground when it is coming to chains, when it's coming to bangles, to small lightweight jewelry. In the upcoming season, heavy jewelry is also a little bit being sold. International tensions are also making the gold rate go higher. Looking at this, the end consumer also is feeling that in the coming days, the gold rate may increase a little more. So we see a lot of buying happening, and as a jeweler and as end retailers, I think that the industry is not that much stressed when it comes to the sales.
Point taken. Sayam, what is your sense on the exchange of old gold into new? That is a number that we see has held quite on the higher side. What is it like right now?
No, I feel that previously there was about 7 to 10% of old gold which was being sold, which was being exchanged, but now it is being increased to about 17 to 20% of the old gold which is coming from the end consumers back to the retailers. In the last year also, we had seen about 120 to 140 tons of old gold which was coming back to the retailer and then again being exchanged to new jewelry. So this year we are looking that should be increasing from about 130 to 140 tons to about 180 to 190 tons approximately, because we are looking at that the same jewelry will be refurbished and new jewelry will be made from that, looking at the rate hike which has happened.
Oh, absolutely. Sayam, you mentioned to us that there is a demand for most of gold articles, including bullion as well. So what caratages is that people, are they buying? Is it still 22 carats, a sacrosanct caratage that Indians buy, or have they dipped below that?
See, I think 22 carat is, of course, each and every retail store is buying that only. But there is a huge section which we are looking at previously, which was in Haryana, Punjab, or some parts of Maharashtra. Now in the south also, people have started buying 18 carat. And I see that the trend slowly shifting to 9 carat also in the coming a few months or a year or so, because looking at these rates of 1,30,000, the 22 carat rates is approximately 8% down, maybe 1,10,000, 1,08,000. But I think that these rates also the consumer are buying. But I would also like to highlight one more part, that some sectors of the society, where in Maharashtra, small cities in Maharashtra are still selling 24 carat jewelry also when it comes to chain, when it comes to Mangalsutra. Some jewelry is also sold in 24 carat also. the major jewelry is being sold in 22 carat, and about 10 to 15% jewelry now has gone to 18 carat, and in the few months or years time, the jewelry will again come down to 9 carat also in some parts of rose gold jewelry or color 2-tone, 3-tone jewelry.
Sayam, this is a question that does need asking, and that is on what's your sense on where are the gold prices headed? Because after the all-time high that we've seen, there's a bit of a crack now, even consolidation, even some very steep profit-taking. Of course, that got bought into. But how are you looking at the gold prices until Diwali, after that, until the end of this year, perhaps?
See, I see 1,28,000 as you 1,27,000 where you can see MCX 1,26,000, 27,000. I see that by November the gold rates might increase to 1,32,000 to 1,33,000. Then in December there may be a pushback, which is to from $4,300 to approximately $3,800 to $3,900. This year, the gold rate in the end in December, a point of view, a little reduction or little correction can come in the rates. November, I don't see any correction coming in. And next year, I see the gold rates going up to $4,900, which is approximately 1,50,000 approximately in the first 4 to 6 months of the next year itself.
So there are going to be corrections, and people shouldn't buy enough FOMO, and there would be better levels to buy also. Sayam, when it comes to buying, really, what is the ticket size that we're looking at? As you said, there is bridal jewelry that is being sold. Do you see walk-ins? Are people coming in with a set budget that this is all I have and what I will buy is within this as well? Is that happening a lot?
See, I see the customers previously used to come with a ticket size of 2 lakhs, 5 lakhs, and few of them 10 lakhs and above. But I see that the customers still, when they're coming to the shop, they may be increasing their budget by about 10% to 15%, which is maybe from 2 lakh to 2,30,000 or maybe 5 lakh to 5,50,000 to 5,80,000. But I see the number of customers which are nowadays increasing rather than the single customer increasing the pocket size. The single customer, it is difficult for anybody to immediately, with their salary increasing or their increments increasing or Diwali bonuses increasing. So their size of buying is somehow remaining the same. For the higher HNIs, I don't see any difference when it is coming to a bridal jewelry. When anybody of them are buying maybe a bridal set of 20 lakh, maybe 25 lakh or a 30 lakh, and now their pocket sizes is to 40 to 45 lakhs. In that sector, I don't see there a lot of change for wedding jewelry, for bridal jewelry. So that buying is coming in, but for the size from 2 lakhs to 5 lakhs and 10 lakhs, I don't see them increasing their. I have seen that their pocket size or their buying has not increased more than 10% or 15%.
All right, that point is well taken, Sayam. Thank you so much for joining in. So that's the view coming in from Sayam Mehra at Unique Chains, that there is strong demand. The exchange gold also seems to be coming up. Nearly 190 tons is what he's anticipating this festival season. But overall, during the festivities, there is good buying. And as said, people shouldn't really FOMO out. You buy what you want. And there is expected correction in gold and silver both before this year ends. And that is perhaps a good time to get in or invest in. But with that, that's all the time that we have on this Diwali special edition of Commodity Champions. Thank you for watching.
Special partner, Nuvama. Let's do it right. Co-powered by SBI. Best है सबको पता है. In association with Tata Capital. Count on us. And car ka action hero, Acco.
Welcome to News Center. I'm Archana Solanki. The top story we're tracking this evening. It was a stellar the last street debut for LG Electronics India. This came days after its IPO garnered bids worth over 4 lakh crore, the most for any Indian IPO. The stock listed at a 50% premium, eclipsing its South Korean parent's $10 billion market capitalization on day one itself. The management said that going forward, premiumization and better margins would be their focus areas. But guess who stole the show and won hearts at the listing ceremony? The South Korean-born LG India MD who delivered the entire speech in Hindi.
यह IPO LG के लिए सिर्फ एक वित्तीय उपलब्धि नहीं है, बल्कि यह एक नए भविष्य की शुरुआत है जिसे हम भारत के लोगों के साथ मिलकर बनाएंगे। भविष्य में लाइवलीहुड की भावनाओं को अधिक से अधिक भारतीय पर्यटन के साथ साझा करेंगे।
And we are joined by Atul Mehra, Managing Director and CEO at Axis Capital, which was one of the bankers to this IPO. And my colleague Nimesh is also here with us. Nimesh, over to you.
Thanks, Archana. So, Atul, thank you very much for joining us and talking to CNBC TV 18. Atul, you were one of the bankers to this IPO. Hats off to you, to your team as well. And congratulations on the bumper listing. Where's the party today? In India or in Korea?
The party is in India, but before we move ahead, a little bit of correction. We were one of the 5 bankers to the transaction, and we were the only domestic bank, and we were the left lead book running banker to the transaction.
Which is why we called you as well, right?
So that is very important for us to position ourselves correctly in front of everyone.
So Atul, where's the party?
The party is in India.
Okay.
One party has already happened in the morning when the list happened at 50%. A similar debut, probably the best for this current fiscal year. And it's a great thing. If you reflect back on it, what was the reason for it? I would attribute it to 2 things. The vision of the management and the strong fundamentals of the company. Both of them led to phenomenal response from all categories of investor, be it the FIIs, be it the local houses, be it the HNI, be it the retail. And this is probably, Nimesh, you would not be aware, this is the only IPO in the category of 10,000 crore plus, which has got oversubscribed fully on day one. And that is a record of its kind. And we have massive participation, as I said earlier, from all categories of investor, which speaks volume.
Atul, I wanted to also discuss about you spoke about what went right, but I guess even the pricing was right? The kind of discount that it offered to the listed peers, and maybe that explains that almost a 50% premium on day one of listing. What worked? If you can just throw some light or insights on what went to the pricing, why you thought of leaving something on the table, and what else beyond pricing? Was it the brand? Was it the reach of this LG brand in India? What worked beyond pricing for LG to do so well on day one?
A couple of things did the magic. First and foremost, it was, I would say, the responsible and reasonable. I'm using these 2 words, responsible and reasonable pricing, which did the magic. The second, of course, is the great management team, a great product category in which they are leaders across the spectrum. And that had its impact, mesmerizing impact, I would say, on every investor. The response was good, not only from the domestic, but also from the global investors. And this is very important because the popular data that people react to is, oh, the FIIs are selling. But in capital markets, and we have seen this again and again, whenever there is a good company hitting the market, with the reasonable pricing and responsible pricing, the response from both foreign as well as the domestic institutional investors is great. And this was a classical example of that.
Later, Atul, I could also relate to in terms of pricing. The other case in point was NSGL. They came out with the right pricing, and after listing, the stock is up more than 50-60%. So I guess you're right. In IPO, the pricing is very important. But also, largely from an IPO perspective, Atul, India is now turning out to be an IPO factory. $14 billion already raised. A lot of large IPOs are lined up. What's the real mantra for this kind of an appetite? Is it only the domestic money, or you're seeing a lot of global appetite as well? X of secondary market, there is a lot of appetite from global investors as well in IPO market.
So again, we are all new, I would say, humble students of capital market, and we are learning every day. Nimesh, just to put things in context, there is no shortage of money. There is no shortage of money, trust me. And the pipeline is looking robust across the banks on the street. We will see at least $40 billion of fundraising very comfortably happening this fiscal year. And this will be a great year for the capital market, no doubts about it. And if you dissect it, all the IPOs which have happened in the current year or in the last 2 years, two attributes make it very different. Number one is the quality of the companies which are hitting the market generally is very, very good. Two, the size of the transactions which are now happening in Indian capital markets, the average size is much, much bigger. What does it reflect? It reflects that these are companies which are matured, which are very well arrived, and they have a business model which is capable of scaling up. So therefore, the response from the market is very, 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 very positive for these companies. What is again interesting that you have to keep in mind is that there is a whole host of companies which are planning to do the transaction. We have seen a rush of blood before Diwali break where companies got listed. Trust me, we have at least 10 good high quality companies which are planning to tap the market between, I would say, after Diwali and before Christmas. So that you will see a lot of high quality companies, and we are partners to quite a lot of them which will be going public. So the pipeline is very, very robust.
Yeah.
Be dependent on only domestic investors, not 100% true.
Sure.
There is a adequate response which is coming in even from the FIIs. That's what I was alluding to. If you look at the data for high quality companies which are large, which are reasonably well priced, even the foreign money is coming in, be it from the long only FIIs or the sovereign funds. They are adequately active and they're participating in all Indian deals.
Atul, just from a curiosity point of view, you spoke about 40 billion to be raised. Already we've raised $14 billion, big pipeline lined up. If you can just highlight 2 or 3 names to us, which are in the public domain, some large IPOs like LG, what would be those?
No, there are many of them. I cannot speak. It's a little unfair, but a whole host of them which are on the roadshow, right from, I would say, Physics Wala, Grow, I would say Pine Labs, Misho, then there is Lenskart, a series of companies which are planning to hit the market.
Atul, there is one big debate now in the market that maybe you are seeing some sort of a bubble in the IPO market as well. We saw some listings which were tepid, including the recent one the big one which got listed the day before. In general, given your experience of 30 years in the market, are you sensing any sort of a bubble in the IPO market, the kind of companies which are coming in and the kind of valuation in which a lot of IPOs are coming in?
There is no bubble. There is no bubble. I'll tell you simply because if there is a bubble, these IPOs would have not got the response. These IPOs are happening on the back of genuine demand. And the genuine demand is on the back of the money which is flowing into the mutual fund. You look at only one simple statistics. What is the inflow which is coming into the SIPs? 27 to 28,000 crore per month. It is enough and more to absorb all these IPOs that we are speaking about. These will get happily absorbed.
Sure. Atul, one basic question from a viewer point of view and from an investor point of view. If you can tell us, which is the best way to identify a winner in an IPO? Because not every IPO is done well. I was looking at the data. Almost 1/4 of the IPOs are now trading below the IPO price. So clearly, there are only few winners in that IPO basket as well. To you, what is the mantra, or what is the things to identify a winner in that IPO basket? Few things to look out for.
Again, Nimesh, I'm not trying to run a commercial on ourselves, but since you raised this point, I will take this opportunity. So we have so far done 11 transactions in this fiscal year, and out of the 11, 10 of them are trading above the IPO price. Okay, so we are an exception to the rule, to the data that you pointed out. Having said that, it is very important, and I will guide the investors to look at the sponsorship of the company. Who are the promoters behind the company? What is their track record? While we all don't like to do rear view driving, but past is a very good reflection of the future. What does the past look like? What is the future? Who are the management? What is the free float in the market? What is the likely free float that is going to hit the market in the next 2 to 3 years point? These are all very, very important data that we keep in mind. But most importantly, focus on the quality of the management. More often than not, it is the management which makes or breaks the company. So I would focus, I would say 75% of my energy on the management. Is the management having what we say is the fire in the belly? If they have the fire in the belly, trust me, you should invest in those companies. It's my clear objective, and this is how we look at the IPOs when we sponsor them.
Sure. We spoke a lot about the IPOs, Atul, but since you're there, I want to ask a bit on the M&A side as well. The cross-border M&A, the outbound M&As picked up in India. I think you were part to one of the large recent M&A transaction where a small company went out and bought a $1.5 billion deal. What's the appetite there? What's the drive for Indian companies to go out and acquire assets globally?
So I think it's a cycle. Nimesh, we have to understand that Indian companies which are aggressive, which are fast growing, have looked at opportunities within India. And when they believe that the opportunities in India are almost exhausted or not available at the right price, then the option for them as company is to either grow organically, go in for an expansion within India, or look at for acquisition as a route for growth. Today, there are a lot of good companies which are available in Europe and in US at multiples which are, I would say, a third or a fourth of what companies in India trade at. And if these companies are good and there is an integration model, there is a synergy, then these companies make great and immense sense. And which is why you see now Indian entrepreneurs are started looking once again as an outward approach to grow. And I think that there's nothing wrong in it. Time has come for India to go and capture the world. And some of the Indian entrepreneurs are taking this opportunity head on and encashing it. And the good news is, if you make a right acquisition, there is a very active capital market in India which is willing to bankroll you.
Oh, absolutely. Absolutely. Atul, before I let you go, we had 2 successful MNC listings this year, and both have given fabulous returns. Is that going to be a trademark that, look at an MNC IPO and you'll probably make money? Is that a right assessment to make?
You cannot generalize it.
Yeah, I understand.
You cannot generalize it, but we are looking at one more transaction, which is Seneco, which should hit the market very soon.
Thank you, Atul. Thank you very much for joining us today, and congratulations on the bumper listing. Enjoy the party tonight as well.
Very much, and happy Diwali in advance to you.
Thank you, Atul, and to your team as well. Archana, I hope you also made money in the LG IPO.
No, Nimesh, breaking news, but I did not. I stay away from IPOs, but that was a fab conversation. Thank you for enlightening our viewers. Thank you, Nimesh. And with that, it's time for a short break. Stay tuned. We'll be back with a very important piece of news, which is Google plans to invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. We bring you more on this on the other side. Welcome back. Tech giant Google will invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. Now, this would be the tech giant's largest AI hub outside the United States. Ashmit Kumar joins us now with more. Ashmit, please take us through Google's India bet.
Well, Google today making its big ticket announcement announcing its single largest investment here, its commitment here to the Indian market, $15 billion to be pumped in beginning 2026 all the way down to 2030 over a 5-year period. To what purpose, to what end will this $15 billion be used? Well, Google is setting up its largest AI hub in India, the largest, in fact, outside of the United States. This will be set up in Vizag in the state of Andhra Pradesh. What we're also learning is that this will have a capacity of 1 gigawatts. The aspiration that Google has is that subject to demand, subject to takeoff, it is likely to be expanded even further. To make this big ticket announcement, in fact, in attendance were the likes of Finance Minister Nirmala Sitharaman, the Chief Minister of Andhra Pradesh, Chandrababu Naidu, was also here. The Minister of Rail, IT and INB, Ashwini Vaishnav, was also in attendance. The commitment that has come from the state of Andhra Pradesh is that they will pull out all stops to ensure that such a project goes through. And in fact, off the record, some of the senior government officials in attendance, they're telling us is that this is the first of many more such announcements to come, that there are many other companies outside of Google which are also looking at India for setting up their data centers and AI hubs. So the first of many for now, Google committing $15 billion for its largest AI hub outside of the United States in Vizag in Andhra Pradesh.
Right. Thank you, Ashmit, for that. Moving on. They are 3 of India's top investors with a proven track record. But did you know that they were musically gifted as well? Well, this is the ultimate market mashup. Sridhar Sikaram, Vijay Kedia and N. Jaikumar share some melodious investment gyan on the CNBC TV 18 Market Mehfil. We leave you with a glimpse. The entire show is up next.
The other asset class that I have been speaking about is gold.
Yes.
And there are a lot of skeptics in the market about gold. In fact, in the last 1 week, I've seen more skepticism on gold than anything else.
Are you really talking about skepticism in the gold? Because we hear, on the other hand, a lot of people actually saying, "Oh my God,
I buy ETF? Can I buy silver
gold?"
So the people, I'm guessing that the people who missed out on the gold rally, they come out with, random data that, how gold has underperformed between 1980 and 2000, how gold is a very volatile asset class. And in most cases, they sort of give out a dollar return number, whereas it is for the Indian investor, it is the rupee dollar, rupee gold that matters. And as I've said many times, that gold actually is a store of value and also is a hedge against currency. People miss the hedge against currency. So if you go back to 1980, the rupee was 9 rupees. Today it is 85 rupees. So you've got a compounded return of 4 to 5% just on currency. So if I want to put it in a song, I would put it in this way. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल। महफिल ये नहीं तेरी, दीवाने कहीं चल। कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल।
Last 1 year, the Nifty has actually gained just about 4%. Gold is 60%.
Plus,
60%. Silver is, I think, even
also, yes,
much higher than that. So you had a nice repartee to that. What was that?
श्रीधर भाई को ये बोलना चाहता हूँ भाई कि ठीक है, ये तो गोल्ड मैन है, अपने बोल्ड मैन है। तो मैं इनका बात का जवाब दूंगा कि ना चाहूँ सोना चांदी, ना चाहूँ हीरा मोती, ये मेरे किस काम के। ना मांगू बंगला बाड़ी, ना मांगू घोड़ा गाड़ी, ये तो है बस नाम के। लेता है शेयर ले बदले में सबके, देता है शेयर ले बदले में सबके। ओरे साहिबा शेयर से सौदा नहीं।
क्या बात।
It's a nice contra to what
So
the next 1 year? How do you foresee the next 1 year when it comes to earnings, when it comes to the macros, when it comes to micros? If I had to ask you to bet on a few themes and a few ideas, what would they be for, say, summer 2083 when we hopefully gather once again for a mehfil?
So I'd like to talk about 2 or 3 sectors. My number one sort of bullish case is for banking. I believe that when any economy reopens up or opens up for foreign capital, banking is the first space that will attract money. So I think NBFC consolidation, money coming into private sector banks, more and more deals like the Yes Bank kind of deals, I think we'll get to see and hear over the course of the next few quarters.
The ones that have fallen so far? Or?
I think it's not a question of follow. I think these are platforms that can't be replicated. Like NBFCs, there are infinite number of NBFCs in a manner of speaking. But there are a finite number of banking licenses, no new licenses to be given. So I think banking sector could attract disproportionate amounts of capital as people, especially foreign banks, come in to take stakes in the Indian context. I think that's going to be a big theme going forward.
Co-powered by SBI. Best है सबको पता है. In association with Tata Capital, Count on Us. And कार का action hero, Acco. Special partner, Novama. Let's do it right.
जान कहीं तू कहीं हार के
Markets and music, both of them have a very symbiotic relationship. Both of them have their highs and lows. Eventually, if done well, give a lot of joy as well. And that's our show today as we welcome Samvat 2082, CNBC TV 18's Market and Mehfil. I'm Mangalam Malu, with me Nimesh Shah, but more importantly along with us are market veterans whose investment advice you've heard, but perhaps not as much as their songs. So we have with us Sridhar Sibram, we have Vijay Kedia, whose songs and lyrics you've obviously seen and heard, and we have Jakes Jayakumar as well. Thanks a lot, gentlemen, for joining in.
Thank you for having us over.
Thanks for inviting.
Season's greetings.
Yeah, season's greetings.
And everyone who's watching this show.
Yes. So we all know that this is a musical show, but I just want to introduce all three of you all in something which not many people know, right? I mean, Jakes has been an investment banker for many, many years. Something, he does a lot of deals, but he doesn't come out too much on TV and claims those. Vijay, of course, is an all-rounder, singing, composing, everything.
He's living the life.
He's living his life. And Sridhar, today I'm getting this musical side of you, but I know you're a super photographer as well. You travel a lot and you do a lot of wildlife photography as well.
Much.
So, it's not only markets, not only music, but all three of have got a fantastic, personalities which not many people know, and maybe through this show, you'll get to know more about all three.
Given the volatile markets, we need to have other passions.
Speaking about the volatile markets, last 1 year from Samvat 2081 to now, Nifty is just barely 4% higher. So much has happened, yet nothing has happened. So, musically speaking, if we had to describe the last 1 year in a song, how would you say?
Actually, you should see it in the context that everybody's been talking about a bull market. Overseas markets, emerging markets are up 25, 30, 35%. We're barely up 2%. So the elusive search for the bull market is on. And put musically, it would go something like this. Jaane jaan, dhoondta phir raha.
Very nicely put. Exactly, this has been the theme of the market, right? And the mood in the market. I mean, for the last 1 year, it's such a struggle to get alpha, to create alpha in this portfolio. So, well put, Jakes.
So the problems of the fund managers, like
Sridhar. So Sridhar, as Jakes put out, it's been a challenging year, right? I mean, how would you describe this market? Are you been easy to get generate alpha?
Yeah, so this has been a very tough year, actually the tough 18 months, I would say. And finding winners have been very difficult given the valuations in the market. And I would roughly put it in a musical way like this. तुम जो मिल गए हो तो ये लगता है कि जहां मिल गया कि जहां मिल गया.
We've got 1 or 2 winners this year, but we've lost also a lot of money, right? And investors have also lost a lot of money. How would you describe last 1 year?
कभी खुद पे कभी हालात पे रोना है. So I would like to put it in one of my songs, which I have written.
Yeah.
जाने कहाँ गए वो दिन कहते थे हम बन जाएंगे अंकल 2 साल में चाहे कोई भी शेयर ले लो कहते थे हम बढ़ जाएंगे बेचेंगे ना 100 साल में जाने कहाँ.
2 years ago, everyone would want to become Warren Buffett and all the names that you've been speaking about. But the last 1 year, when you're speaking about volatility and policy making and all, the biggest imponderable was the man from the US and his social media account. I mean, how do you musically describe that? How do you first describe that situation, and how does an investor navigate through that situation?
Especially because things change literally every 24 hours.
Less than 24 hours at times.
Yeah. Right. So I'm just being sort of polite, if you will. Yeah. But if there was a song I could pick out which kind of describes what we need to do with these responses, it would be Kuch na kaho, kuch bhi na. बस एक मैं हूँ, बस एक मैं हूँ.
My favorite line in that is क्या सुनना है, क्या कहना है, सबको पता है, हमको पता है. So obviously you got to separate the wheat from the chaff. But speaking about music and markets and all of that, having a relationship, you have a beautiful relationship with both music and market. But if you had to describe your relationship with the market in a song musically, how would you do that?
कौन सा गाने का?
आप
अरे वाह. हम तेरे बिन अब रह नहीं सकते, तेरे बिना क्या वजूद मेरा.
Vijay, very nicely put. Again, you know, all three have seen so much of markets, and we've learned from all of you all, right? Market is a great leveler. और ये आपने गाने में बता भी दिया कि ultimately it's a market. I mean, तुम कितने भी बड़े हो, कितने भी बड़े investor हो, जो भी हो, ultimately market teaches you on the wrong side, on the upside, on the downside. You know, if you want to describe your market journey, and how would you identify your investment styles through market song or any song?
So actually, since they have already spoken about the market, the other asset class that I have been speaking about is gold.
Yes.
And there are a lot of skeptics in the market about gold. In fact, in the last 1 week, I've seen more skepticism on gold than anything else.
Are you really talking about skepticism in the gold? Because we hear, on the other hand, a lot of people actually saying, oh my God,
can I buy ETF? Can I buy silver ETF?
So the people, I'm guessing that the people who missed out on the gold rally, they come out with, random data that, how gold has underperformed between 1980 and 2000, how gold is a very volatile asset class. And in most cases, they sort of give out a dollar return number, whereas it is for the Indian investor, it is the rupee dollar, rupee gold that matters. And as I've said many times, that gold actually is a store of value and also is a hedge against currency. Absolutely. People miss the hedge against currency. So if you go back to 1980, the rupee was 9 rupees. Yeah. Today it is what, 85 rupees. So you've got a compounded return of what, 4 to 5% just on currency. Right. So if I want to put it in a song, I would put it in this way. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल. महफिल ये नहीं तेरी, दीवाने कहीं चल. कोई सोने के दिल वाला, कोई चांदी के दिल वाला, शीशे का है मत वाले तेरा दिल.
last 1 year, the Nifty has actually gained just about 4%. Gold is 60%.
plus, yeah,
60%. Silver is, I think, even
also, yes,
better than
higher than that. So,
हाँ, तो मैं ये श्रीधर भाई को ये बोलना चाहता हूँ भाई कि ठीक है, ये तो गोल्ड मैन है, अपने बोल्ड मैन है, तो मैं इनका बात का जवाब दूंगा कि ना चाहूँ सोना चांदी, ना चाहूँ हीरा मोती, ये मेरे किस काम के, ना मांगू बंगला बाड़ी, ना मांगू घोड़ा गाड़ी, ये तो है बस नाम के, लेता है शेयर ले बदले में सबके, लेता है शेयर ले बदले में सबके, ओरे साहिबा शेयर से सौदा नहीं.
क्या बात.
It's a nice contra to what Sridhar put it.
how do you foresee the next 1 year when it comes to earnings, when it comes to the macros, when it comes to micros? If I had to ask you to bet on a few themes and a few ideas, what would they be for, say, summer 2083 when we hopefully gather once again for a mehfil?
So I think the way we need to look at this is reversion to mean is a big theme in the world that's happening. Because of mass participation both domestically and overseas, moves are getting amplified, highs are getting exaggerated, returns are getting kind of pretty much front-loaded. And then comes this, policy-making maverick behavior that there exists the world over, which essentially means that things revert pretty quickly. Corrections are short-lived, if you will. So the entire buy and hold strategy is actually undergoing a change in some senses. So before I come to that, you need to look at 4 to 6 quarters, 6 to 8 quarters in order to make a thesis play out and hopefully book your profits and come out. I think this buy and hold at one level is probably the biggest change in our lives that's happened. So I'd like to talk about 2 or 3 sectors. My number one sort of bullish case is for banking. I believe that when any economy reopens up or opens up for foreign capital, banking is the first space that will attract money. So I think NBFC consolidation, money coming into private sector banks, more and more deals like the Yes Bank kind of deals, I think we'll get to see and hear over the course of the next few quarters.
The ones that have fallen so far? Or?
I think it's not a question of follow. I think these are platforms that can't be replicated. Like NBFCs, there are infinite number of NBFCs in a manner of speaking. But there are a finite number of banking licenses, no new licenses to be given. So I think banking sector could attract disproportionate amounts of capital as people, especially foreign banks, come in to take stakes in the Indian context. I think that's going to be a big theme going forward.
You'll be an important player in making those deals happen as well, I suppose.
Well, I think that would be... that's kind of out of the syllabus. I leave that out for the moment. So banking is one space. Pharmaceutical, especially now with the dust having settled on the Biosecure Act and the need for generics, etc. I think generics, CDMO, these are the spaces. And the third space is capital goods, where I think a lot of the new money should come in terms of capital investments, which the private sector has been lacking so far.
Right. And Vijay ji, you?
मेरे को ऐसे लगता है कि I'm bullish on tourism. I think now government is awakening that and bent upon giving all this promoting domestic tourism. So मेरे को लगता है टूरिज्म से रिलेटेड जो भी शेयर्स हैं, चाहे उसमें एयरलाइंस आ गया या टिकटिंग वाले आ गए या होटल्स वगैरह आ गए,
इवन एयरपोर्ट बिजनेस,
हाँ वो भी आ गया और लेकिन सब एक्सपेंसिव है, कोई भी सस्ता नहीं है, लूट का माल नहीं है यहाँ पे, सब ये सब पसीने का पैसा है यहाँ पे। तो लेकिन जब भी मौका मिले तो मेरे को इसमें टूरिज्म में ठीक लगता है और मेरे को हॉस्पिटल इंडस्ट्री मेरे को ठीक लगता है।
हॉस्पिटल एंड हॉस्पिटैलिटी।
हाँ, हॉस्पिटल एंड हॉस्पिटैलिटी।
And Sridhar?
I'll put it slightly differently because I followed the emerging markets for many years now, almost 25 years now. And I've seen the ups and downs of India right from 92 when I started. For about 8 to 9 years, India gave no returns. But over the years, if you see on a longer term period, India has been one of the best performing emerging markets. So I think a lot of people are worried that we haven't given returns this year. But I think it's a very short term view. If you look at 5 years, 10 years, 15 years, 20 years, India has done phenomenally well and possibly in the top 2 in terms of dollar returns. So I would say that just bet on the country, just bet on India.
Just bet on the country, just bet on India.
And in fact, if there's something that I could describe in the way things are changing, which is the only constant.
Yeah.
And of course, as I said, musically, since that's the theme for the evening, Har Ghadi.
All right, let's do this.
हर घड़ी बदल रही है रूप जिंदगी, छाँव है कभी कभी है धूप जिंदगी, हर पल यहाँ जी भर जियो, जो है समा कल हो न हो. So the time invested in the markets is important.
Yes. Rather than timing the market.
Rather than timing the markets.
Yes.
Perfect. And
तो अच्छा समा कल क्यों न हो? हो सकते हैं.
Vijay ji, I have to ask you this question because everyone has been now getting that FOMO, 3 words, IPO. Everyone has gone crazy. Like, ये लगना चाहिए, ये लगना चाहिए, ये लगेगा तो तुरंत मैं इतना पैसा बन जाएगा. What is happening with the IPO song?
तो IPO को I will put it again in one of my lyrics, one of my songs I have written on this IPO that I'm going to sing.
Can you spell the lyrics out before you sing the song?
So वो ऐसा यार कि जहाँ जहाँ आजकल मैं हाथ रखता हूँ वहीं वहीं डबल ट्रिपल मैं कर लेता हूँ, रोज रोज सोचता हूँ क्या नया मैं लूँ, कोई भी बता दे कुछ भी जाने नहीं दूँ, संभल संभल के यहाँ पे पाँव रख तू, सालों की कमाई मिनटों में हो जाती छू.
That is very important that you've said because a lot of times people listen to the song and they forget the words that you've said.
Clap for the song and move on.
And then move on.
And they buy more IPOs.
नहीं बाद में फिर मेरे कोई पूछते हैं सर कौन सा IPO में अप्लाई कहीं मिल गया मेरे को ही पूछेंगे. जहाँ जहाँ आजकल मैं हाथ रखता हूँ वहीं वहीं डबल ट्रिपल मैं कर लेता हूँ, रोज रोज सोचता हूँ क्या नया मिलूं, कोई भी बता दे कुछ भी जाने नहीं दूं, संभल संभल के यहाँ पे पाँव रख दूं, सालों की कमाई मिनटों में हो जाती छू, IPO और YPO से बच के रहना तू, पेनी स्टॉक से आ रही है बड़ी बड़ी बू, इतनी सी समझ के बात आसमां को छू, फिर कभी न कहना विजय टोका नहीं क्यों।
Wow, फिर ना कहना कि विजय टोका नहीं क्यों।
We have to be clear that we need to separate the signal from the noise.
Of course.
Yeah.
Any number of people will say a lot of things, and I know that that's important. My guests here have talked about to be careful about India, but one of the things I would like to say is this: participation has resulted in a massive amount of hearsay, and people saying, "I heard this, ye ho jayega, wo ho jayega."
So I'll ask you to hold on to that thought. So he's speaking about India. You're speaking about a lot of noise. So noise to signal ratio has to be improved. And he often speaks about the long term. He's been speaking about the long term, saying, ye hai long term, ye hai long term, ye hai long term, meri jaan. So let's end with all of y'all giving your investment philosophies through a song. Let's start with you, sir.
कभी मैक्रो कभी माइक्रो कभी स्लो डाउन कभी स्केल कभी यूएस कभी चाइना कभी झगड़ा कभी मेल टेंशन के हैं कई नाम यहाँ जरा हट के जरा बच के शॉर्ट टर्म में मेरी जान है दिल है सिंपल कमाना यहाँ यदि लॉन्ग टर्म बस लॉन्ग टर्म ओनली लॉन्ग टर्म मेरी जान.
And you were saying signal to noise ratio. What is that?
On a somber note, कुछ तो लोग कहेंगे लोगों का काम है कहना छोड़ो बेकार की बातों में कहीं बीत न जाए रहना कुछ तो
All right, so the message is clear. Hold for the long term. Ye hai long term, ye hai long term, ye hai long term, meri jaan. And for you, it is avoid all the noise. Just focus on what you have to. Kuch to log kahenge, logon ka kaam hai kehna. But the third part, believe in the power of India.
Ye jo desh hai tera.
Ye jo desh hai tera. Oh wow. Let's end on that note.
Let's do. ये जो देश है तेरा स्वदेश है तेरा तुझे है पुकारा ये जो बंधन है वो कभी टूट नहीं सकता ये जो देश है तेरा स्वदेश है तेरा तुझे है पुकारा कभी टूट नहीं सकता मिट्टी की है जो खुशबू तू कैसे भुलाएगा तू चाहे कहीं जाए तू लौट के आएगा नई नई राहों में दबी दबी राहों
musical note, ladies and gentlemen. Thank you so much for tuning in on CNBC TV 18's Market and Mehfil. We wish you a very happy Diwali, a very happy Samvat 2082, and a very prosperous New Year. Believe in the power of investing. Believe in the power of India.
Special partner, Nuvama. Let's do it right.
Presented by Standard Chartered.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Lal Street fails to hold on to its opening gains. The Nifty and the Sensex end 0.25% lower after a volatile session. The Midcap index falls nearly 1%, underperforming the blue chips.
2, 1.
It's a blockbuster debut for LG Electronics. The stock lists at a 50% premium, eclipses its South Korean parent's $10 billion market cap on day one itself. The management tells CNBC TV 18 premiumization and better margins are their key focus areas. China says it was ready to fight to end till the end amidst the renewed trade tensions with the United States and the tit-for-tat port fee. Beijing sanctions 5 U.S. subsidiaries of a South Korean shipbuilder. U.S. Treasury Secretary Bessent tells Financial Times that China wants to pull everyone else down, but tells Fox News that the Xi-Trump meeting later this month is still on track. Google to invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. This would be the tech giant's largest AI hub outside of the US. Union IT Minister Vaishnav urges Google to make reskilling a part of their AI investment. Infosys wins a £1.2 billion contract to modernize the payroll platform of England and Wales public healthcare system. Under the 15-year contract, Infosys will replace the existing electronic staff record with the next generation payroll platform for 1.9 million employees. The Supreme Court notes that the title is not clean for all 88 Sahara properties that the Adani Group intends to buy. Several pleas in the Supreme Court claim ownership. EPFO issues notice to the Adani Group to clear Sahara Employee Provident Fund dues of 1,500 crore rupees as the proposed buyer. Tata Motors demerger scheme comes into effect and the shares of passenger vehicle segment lists at 400 rupees a share. The commercial vehicle, for which discovered price comes around 260 per share, will be listed in a month. Many families still await the return of bodies of deceased hostages, even as Trump declares the Gaza war is over. The Israel army says 4 hostages have been identified. The US president says he's yet to make up his mind on the two-state solution. Russian forces launch aerial bombs and drones against Ukraine's Kharkiv in an overnight attack, damaged the city's main hospital, injured civilians. Ukraine's President Zelensky says he will travel to the US this week to discuss potential supply of long-range weapons. Well, let's start with the day's market action. The Lal Street ending the day with cuts after a volatile session. The Nifty and the Sensex ended the day 0.25% in the red. Midcaps fell nearly 1% today, underperforming the blue chips. 80 points lower, 297 points lower on the Sensex. The Nifty banked down by over 100 points in 430 point cut there on the Nifty Midcap, so not being able to hold on to the morning gains. Inflation wholesale price index for September dipping to 0.13%. This was largely led by the softening of prices in food articles, fuel and manufacturing products. Meanwhile, trade tensions between US and China continue to intensify. China's Commerce Ministry has said the government is ready to fight to the end in a trade war with the US. This after US President Donald Trump said he would impose an additional 100% tariff on the world's second largest economy. In a post on X, China's Commerce Ministry spokesperson said, and I quote, "Threatening high tariffs is not the right way to deal with China. The US should correct its approach and act on the common understanding that the two presidents have reached in their phone calls," end of quote. US Treasury Secretary Scott Bessent criticized Beijing for imposing new export controls on rare earths last week. In an interview with Financial Times, Bessent said, and I quote, "This is a sign of how weak their economy is and how they want to pull everybody else down with them. If they want to slow down the global economy, they will hurt the most," end of quote. The Chinese government has also hit back at the Trump administration. The Commerce Ministry announced it is imposing sanctions on 5 US-based subsidiaries of South Korean shipping giant Hanwha Ocean. Now, the Chinese government has accused them of aiding Washington's restrictions on Chinese maritime, logistics and shipbuilding sectors. Yunus Yoon brings us the latest.
China is taking aim at U.S.'s efforts to revive its shipbuilding industry. Today, the Commerce Ministry sanctioned 5 U.S.-linked units of the South Korean shipbuilder Hanwha Ocean. The ministry said Hanwha's subsidiaries in the U.S. have assisted and supported the U.S. government's probes and measures against Chinese maritime, logistics, and shipbuilding sectors. China is strongly dissatisfied and resolutely opposes it. The ministry said that companies and people here will no longer be able to work with Hanwha Ocean, which runs a shipyard here. China dominates the shipbuilding industry, but Korea and Japan are seen as countries that have more advanced shipbuilding technology. In fact, the Trump administration has said that the 2 U.S. allies were going to be very important to reviving the U.S.'s shipbuilding industry. The Chinese move also comes, though, as the same day as when both countries are now hitting each other with fresh port fees on each other's vessels. And it also comes as China launches an investigation, a counter-investigation into Washington's Section 301 probe on Chinese shipping and shipbuilding industries. The Transport Ministry had said that they will be undertaking an investigation and looking into countries, companies, and organizations, as well as individuals that help the U.S. undertake discriminatory, restrictive behaviors against China's shipbuilding supply chain.
Unisoon, many thanks for joining us. A stellar the Wall Street debut for LG Electronics India. The stock listing at a 50% premium, eclipsing its South Korean parent's $10 billion market cap on one day. The stock closed 1% lower than its listing price. Remember, the 11,600 crore rupee issue received bids worth more than 4.4 lakh crore rupees, making it the most bid Indian IPO ever. Upasana is here with more details on the bumper listing. Upasana.
Well, certainly the most awaited IPO, that is LG Electronics, listed on exchanges today, and it was certainly a bumper listing. Now, the IPO listed at a 50% premium at 1,710 versus the issue price of 1,140 per share. The company raised nearly 3,475 crore from anchor investors, and it is a bumper in terms of subscription levels. It is the first Indian IPO to cross bids worth 4 lakh crores. Now, if we talk about the stock movement, the stock was down about 1.6% today at 1687 per share, making the valuation stand around 52 times its FY25 EPS. And the Mkap has also exceeded over 1 lakh crores. Now, if we compare the valuation with the other peers in the large appliances segment, it is somewhere in line with them. Havells, Voltas, Blue Star, the valuation of them stack up 1 year forward PE, that is around 45 to 40 times 1 year forward PE. Now, in terms of financial metrics of these companies versus the peers, mind you that the revenue growth of LG Electronics is lower than the peer average of 19%, but the company certainly outperforms in terms of its EBITDA margins, PAT margins, and also ROCE, which is at a record levels. Now, let us understand what the brokerages feel about this IPO. Now, Motilal Oswal expects the stock to trade at a higher multiple given the strong fundamentals and return ratios. Well, Nomura says that it expects a 10% revenue CAGR from FY25 to FY28, driven by multiple products, exports, and service initiatives taken by the company. Well, Ambit has also given a preferences in terms of line of companies, in terms of large appliances. It prefers LG Electronics the most, followed by Blue Star, followed by Whirlpool, and lastly followed by Voltas. In terms of target prices, Antique has given a target price of 1725, Motilal a target price of 1800, Nomura has given a target price of 1800 as well. Ambit has given a target price of 1820, but MK has given the highest target price, that is 2050 for the share. So overall, it's a good listing, and all consensus have given a buy rating on this one.
यह IPO LG के लिए सिर्फ एक वित्तीय उपलब्धि नहीं है, बल्कि यह एक नए भविष्य की शुरुआत है, जिसे हम भारत के लोगों के साथ मिलकर बनाएंगे.
We are introducing a new lineup of products
which will be targeted for the volume zone customers.
Right.
And we want to give them an experience for our premium products.
Right.
And on the other hand, we will also scale up our new businesses like B2B, information display panel, HVAC system, service business, and our third plant will also fuel the next level of growth in our business. That margin is a combination of many things. One is your growth in business. Second is the localization rate. Our current localization is 54%. And every year 2 to 3% it will improve.
Correct.
And the biggest strength which is contributing to our margins are major key components we manufacture in-house.
Well, that's the bumper listing there of LG India, and the man who stole hearts and the show was the LG India CEO. Whole speech there in Hindi. The demerger of Tata Motors passenger vehicle and commercial vehicle business took effect today. A special pre-open price discovery session valued the shares of the company's passenger vehicle business at 400 rupees a share, the stock closing 1.5% lower than the price. The commercial vehicle business is likely to be listed within a month at 260 rupees a share. Now, the automaker's board approved the demerger last year to streamline operations. Sudarshan is standing by with more. Sud.
Tata Motors demerger scheme has got effective today, and now on the screen the price you are seeing is of Tata Motors passenger vehicles. So for commercial vehicles it will be listed only after a month or say a month and a half, that is 30 to 45 days. Now what would be consisting of Tata Motors passenger vehicles? So JLR business, India passenger vehicle business, and the stake that company holds in Tata Technologies, that will be part of Tata Motors passenger vehicle business. In commercial vehicle business, both truck and bus business would be part of Tata Motors commercial vehicle. So what's the value that brokerages have put out? As per JP Morgan, passenger vehicle business total, JLR, India passenger vehicle business, and the company's stake in Tata Technologies, value as per JP Morgan is rupees 392 per share, and for CV business is 306 per share. As per Nomura, PV's value is rupees 365, and for CV it's rupees 367, and as per Nuvama, PV value is rupees 410 and CV it's rupees 280. So today Tata Motors passenger vehicle business lists at rupees 400 per share. Now if you derive the price for commercial vehicle business, it comes around rupees 260 per share.
All right, that's the Tata Motors demerger laid out for you. So many thanks. Tech giant Google would invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Visakhapatnam. This will be the tech giant's largest AI hub outside of the US. Ashmit standing by now with more. Ashmit, it's a big win for India and a big bet that Google's making.
Well, Google today making its big ticket announcement announcing that its single largest investment here, its commitment here to the Indian market, $15 billion to be pumped in beginning 2026 all the way down to 2030 over a 5-year period. To what purpose, to what end will this $15 billion be used? Well, Google is setting up its largest AI hub in India, the largest, in fact, outside of the United States. This will be set up in Vizag in the state of Andhra Pradesh. What we're also learning is that this will have a capacity of 1 gigawatts. The aspiration that Google has is that subject to demand, subject to takeoff, it is likely to be expanded even further. To make this big ticket announcement, in fact, in attendance were the likes of Finance Minister Nirmala Sitharaman, the Chief Minister of Andhra Pradesh, Chandrababu Naidu was also here, the Minister of Rail, IT and INB, Ashwini Vaishnav, was also in attendance. The commitment that has come from the state of Andhra Pradesh is that they will pull out all stops to ensure that such a project goes through. And in fact, off the record, some of the senior government officials in attendance, they're telling us is that this is the first of many more such announcements to come, that there are many other companies outside of Google which are also looking at India for setting up their data centers and AI hubs. So the first of many for now, Google committing $15 billion for its largest AI hub outside of the United States in Vizag in Andhra Pradesh.
This AI hub will be a very important contribution to the AI mission goals in 3 different ways. First, skilling. We all know that AI is fundamentally changing the way the world moves today. Under such circumstances, there is a serious concern among a lot of IT professionals of what their jobs will be, where they would, how their lives will be impacted. So it's very important for all of us, especially the industry, to reskill and upskill our IT professionals in a major way.
Even Hyderabad, I brought Microsoft at that time. First time Microsoft has come to Hyderabad. Today, Google has come to Visakhapatnam. We are very happy. According to me, we are in an inspiring time.
Andhra Pradesh has been looking for different kind of investments, new investments, futuristic investments. So data processing, AI is one of them. So therefore Google coming is the initial step. Now, we have signed a lot of NDAs with other companies as well, but eventually, all the major companies that require this kind of AI computing power will land in Vizag.
Well, that's Google's big bet on India. Now, ChatGPT maker OpenAI has inked another deal, and this time with semiconductor giant Broadcom. Both companies will develop and deploy 10 gigawatts of custom AI chips and computing systems over the next 4 years. Rachna joins us now with more details. Rachna, take us through the OpenAI Broadcom deal.
Well, another day, another deal by OpenAI. But this one is a bit different, though. Now, OpenAI has entered a strategic partnership with Broadcom to co-design and produce proprietary artificial intelligence chips, marking its first major step into semiconductor development. This move is aimed at reducing OpenAI's dependence on GPU suppliers such as NVIDIA and AMD, giving it end-to-end control over the hardware powering its models and data centers. The timing, however, is striking. The Broadcom collaborations comes just weeks after OpenAI signed over $100 billion worth of long-term GPU supply agreements with NVIDIA and AMD. These deals secured next-generation processors like AMD's MI450 accelerator. Now, these accelerators fuel OpenAI's training and inference workloads through the decade. Under the new Broadcom deal, though, OpenAI will focus on chip architecture and design, while Broadcom will handle fabrication, deployment, and networking integration. Together, the companies plan to develop and deploy up to 10 gigawatts of custom AI accelerators, beginning in late 2026. The deal value isn't disclosed, but in September, Broadcom had disclosed that it had a new client and an order of about $10 billion from them. Now, the street believes that it is a part of a broader order that OpenAI has placed, which is now estimated to be about $500 billion. Now, these chips will be used exclusively within OpenAI's own systems and are not intended for external sale. The partnership underscores a broader industry shift towards in-house silicon, which is similar to strategies that we've seen at Google, Amazon, and Meta, who are all racing to secure compute independence amid soaring AI infrastructure costs and global chip supply constraints. OpenAI CEO Sam Altman called custom accelerators critical to the next frontier of AI capability, describing this initiative as a cornerstone of OpenAI's path towards super intelligence level systems. Now, analysts say that this deal signals a new hybrid hardware strategy for OpenAI, securing near-term GPU capacity from the incumbents while simultaneously building long-term autonomy through proprietary chip design. With Broadcom packed, OpenAI effectively joins the ranks of full-stack AI companies, controlling their entire hardware-software pipeline, which is a move that could reshape both the economics and geopolitics of AI compute.
All right, Rachna, many thanks for joining us. Moving on to Infosys, shares of the stock. Shares of the company up in trade today after it announced that it has been awarded a contract worth £1.2 billion, which will span for 15 years. The contract has been issued by UK's NHS Business Services Authority to deliver a new workforce platform for England and Wales. Under the contract, Infosys will replace the existing electronic staff record with a next-generation payroll platform for 1.9 million employees. We'll head into a break, but coming up next, many families still await the return of bodies of deceased hostages, even as Trump declares the Gaza war is over. That and more when we get back. President Trump and the leaders of Egypt, Qatar and Turkey have signed a declaration in Egypt meant to cement a ceasefire in Gaza. President Trump called the day a tremendous moment for the Middle East. However, the president said he's yet to make up his mind on the two-state solution. This came hours after Israel and Hamas began the exchange of hostages and prisoners. Meanwhile, the Israel military has said it opened fire in northern Gaza after suspects approached its forces. This as President Trump reiterated again that the war in Gaza is over.
After years of suffering and bloodshed, the war in Gaza is over. Humanitarian aid is now pouring in, including hundreds of truckloads of food, medical equipment, and other supplies, much of it paid for by people in this room. A new and beautiful day is rising, and now the rebuilding begins. The rebuilding is maybe going to be the easiest part. I think we've done a lot of the hardest part, because the rest comes together. We all know how to rebuild, and we know how to build better than anybody in the world.
I would say that Pakistan had nominated President Donald Trump for Nobel Peace Prize for his outstanding, extraordinary contributions to first stop war between India and Pakistan, and then achieve ceasefire along with his very wonderful team.
Well, that's President Trump and Pakistan's Prime Minister. Now, the International Air Transport Association has said that persistent supply chain challenges could cost global airlines more than $11 billion in 2025. According to IATA's report, postponements in aircraft deliveries and engine repairs are forcing airlines to operate older, less fuel-efficient planes. Madiha standing by with more. Madiha, no let-up there as far as the supply challenges are concerned for the aviation sector?
Absolutely. $11 billion is a huge number. The airline industry is facing a perfect storm of rising costs and delayed aircraft deliveries, as you mentioned. There are about 17,000 aircraft pending to be delivered as of 2024. According to the International Air Transport Association, new aircraft deliveries continue to be delayed, forcing airlines to fly older and less fuel-efficient jets. And that alone means carriers will spend nearly $4.2 billion extra on just fuel in 2025. And add to that an aging global fleet, and the cost pressure is mounting. IATA estimates that another $3.1 billion will be required by airlines to go towards additional maintenance of older aircraft as they require more frequent and expensive checks. Engine issues are compounding the problem. Since engines are spending longer on the ground for repairs and maintenance, airlines are being forced to lease more spare engines, and that's adding about $2.6 billion to their bills. And it doesn't stop there. Aircraft lease rates themselves have jumped 20 to 30% since 2019, tightening margins even further for carriers already struggling with rising costs. So while passenger demand remains strong, supply chain constraints from delayed jets to engine shortages are shaping up to be a multi-billion-dollar headwind for the global airline industry in 2025.
All right. Many thanks, Madiha, for joining us. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a moment with plenty more.
Presented by Standard Chartered.
Hello and welcome to Startup Street. I'm Anand Rathi, and these are the top headlines that we're tracking for you from the startup space. Home resale marketplace House Easy bags $18 million in a Series B round led by HCL, Chirate Ventures and Antler also participate. House Easy will use the funds for tech upgrades, expansion and brand development. Home interiors and renovation platform LiveSpace sustains its growth momentum in FY25. Revenue climbs 23% on a yearly basis and cuts losses by 42%. India remains LiveSpace's largest market, contributing 85% to its operating revenue, while Singapore accounts for the rest. D2C brand Two Brother Organic Farms gets 110 crore rupees in a Series B funding round. 361 Asset, Rainmatter Investments and Marotham Seksaria Family Office invest. The proceeds will be used to expand its processing facilities, strengthen supply chains and increase its product reach in India and the overseas market. VC firm Artha India Ventures announces the first close of 250 crore rupees for its second early-stage micro-VC fund, Artha Venture Fund 2. The fund targets a total corpus of 500 crore rupees with a 100 crore rupee green shoe option, will invest in 36 seed-stage startups across 4 themes: premium consumption, fintech infrastructure, applied AI and deep tech. Google to invest $15 billion over 5 years to set up an artificial intelligence data center in Andhra Pradesh's Vishakhapatnam. This would be the tech giant's largest AI hub outside the United States. Union IT Minister Vaishnav urges Google to make reskilling a part of their AI investment. Those were the headlines that we're tracking for you this evening, but on what's brewing today. From a small village in Maharashtra to shelves of 50 countries, India's Two Brothers Organic Farms has become a global name in clean, traceable food. The company has just raised 110 crore rupees in a Series B funding round led by Avishkar Capital to expand its farmer network, scale production and deepen global reach. Founded by brothers Satyajit and Ajinkya Hange, the brand is already EBITDA positive and aims to work with 50,000 farmers in the next few years, bringing India's organic produce to the world. Joining me now to discuss this further, Satyajit Hange, the co-founder of Two Brothers Organic Farms. Satyajit, thank you so much for taking time out and being here with us on Startup Street. You know, you have built one of India's most trusted organic brands while sort of staying farmer first, right? If you could sort of take us through what you have on offer and the gap in the market that you're trying to address.
Yeah, awesome. Very good evening, Anand Rathi and everybody and the audience. Just to correct the name that you said, who led the fundraise, is 361 Rainmatter and Marotham Seksaria Family Office. So that's about the people who led the fundraise. But yeah, like you said, the gap that we're trying to correct, being farmers' sons and going back to farming in the village, like you rightly said, in Hodni, which is in rural Pune, we figured out that the farming is not sustainably done. There's a lot of use of chemicals and which has ruined soil fertility. And the quality of produce that's coming out is not nutritionally rich. So at the both ends, you know, people lose. Farmers at one end are losing soil fertility and consumers at one end are getting food that is not very nutritionally rich. And that's what made us dwell and, you know, start an organic farm and this range of organic food products. And like, you know, all our products do not have any additive, preservative, binder, filler, color, essence, perfume. So the growing is done with farmers and on our own farms. We have our own in-house manufacturing facilities and we sell primarily through our own website and app, and followed by marketplaces like Amazon and then quick commerces, all 3 of them. We also have consumers across the world. And the gap that we have kind of figured out is that people, I think there's a lethargy amongst people for established brands and, you know, this opaqueness behind what is there in the product actually and no access to information or content around how they have been manufactured and how they have been grown and what their ecosystem looks like. And smaller brands, when we started off, gave this transparency and invited people to the farms and our manufacturing facilities. We've had over 15,000 people come and see everything in person. And this has developed a sense of trust, you know, and there are real people who are doing it and people relate to us. So I think that's helped.
Yeah, and you know, also congratulations on the fundraise, right? You've raised this 110 crore rupees, which is sort of a major milestone for the company. What does this round mean for Two Brother Organic Farms at this stage of your journey, and how do you plan to use the funds?
So we're at a stage now where we are doing approximately 200 crore ARR in revenue. and this year will close at 200 plus for the financial year. Last year, this time, you were doing around 5-6 crores. So in the last 12 months, you have grown close to a 3x. It's a validation of sorts in the products and in what we are doing. And the idea going forward is that how do I work with now 15,000 farmers? We have been working with 5,000 farmers, hand-holding them from seed stage to harvest stage. We have some tech for traceability with them. We have training centers and people on ground. We have our own manufacturing capabilities, like I said. And the idea is how do I go from 60,000 capacity to now over 2 lakh and ultimately form a food park of sorts that has an ecosystem for food manufacturing. And on the front, on the growth side, how do I connect with consumers through various channels, and especially international? We are primarily bought by consumers on our own website. How do I have a presence on offline retail in the US? How do I get into Whole Foods, Trader Joe's, Erewhon's? We have just founded a legal entity in Dubai, and we're trying to make inroads into stores like Almaya's, Grandios, Costco's in Dubai.
Absolutely.
So this is basically where the fundraiser will be used for.
Yeah, and we're running out of time. So if you could quickly tell us, you're already in over 50 countries, right? So what's next on the global roadmap? Which regions are you targeting for deeper expansion? And how important is India as a market? And also, if you could sort of tell us, which products are you seeing the most demand for?
So the products I'll start with, the best products are the ghee, atta, jaggery, wood-pressed oils. And then there are the traditional inspired Chawanprash and Gulkand, which are doing very well. Our atta is a craze now. We have been working on this particular variety of wheat, which is called Khapli. It's low in gluten, high on fiber. We kind of discovered it 10 years back. It's a very heirloom variety, and we've got it to the forefront, creating awareness in the last 8-10 years for this wheat variety. So apart from these, international, we have seen very good response. Like I said, the community for, Two Brothers in the US is very strong. We've been to the East Coast, West Coast, and met over 1,200 customers in person over the last 1.5 years. And the idea is, how do we get closer to them? And so we have taken a warehouse out there and have established a legal entity and being closer and can deliver faster to them. We've also realized that there's a lot of Indian diaspora in the Middle East, and we are now based out of Dubai, and we can focus on them. Also, Europe and especially London is something we'll be focusing on, especially with our partnership with Narottam Seksaria. They have a distribution company in London, in England, and we'll be taking advantage of that and spreading a presence in London also.
Right. And you set this ambitious goal of reaching 1,000 crore rupees in revenue and working with about 50,000 farmers, right? What's your vision for how this expansion will impact rural livelihoods and India's clean food movement?
So being farmers ourselves, we have measured and we have kind of lived that life for 5 years, farming first and then removing the brand later. We have seen how our soil fertility has gone up and our reliance on external inputs, which are purchased with money, has gone down. Though if the productivity initially went down, the quality of yield was very high. And, through this mechanism and through this platform of Two Brothers, we now give farmers a premium of over 25 to 40% for the produce that they produce without any chemicals, and that is clean. And we have seen that positively impact farmer livelihoods, because one is, in organic farming, there is nothing external you are buying. Second, if you're getting a premium for your produce, it's economically viable. So that is a very strong impact. And also, along with this, we protect a lot of biodiversity and heirloom varieties. The cows which we work with are, indigenous varieties. The native seeds, the millets, grains, pulses, legumes, lentils are all native varieties. We have discovered they're more pest resistant, more drought resistant, and nutritionally richer. So we're getting this, sort of back in vogue right now.
All right, Satyajit, we're completely out of time, but thank you so much for joining us on the show, and we wish you all the best on this journey going forward.
Thank you so much, Anand Rathi. Have a good evening.
Moving on, US pizza chain Papa John's has re-entered the Indian market after an 8-year absence. It will be managed by master franchisee PJP Foods India, a joint venture between Ambrosia QSR and PJP Investments Group. The brand has opened 4 restaurants in Bengaluru and plans a nationwide expansion in phases. My colleague Ritu Singh caught up with Tapan Vaidya, the CEO of PJP Investments, at the launch. Take a look.
Guess who's back? It's Papa John's, the American pizza giant that is re-entering India. Yep. After packing up business here a few years ago, they're back for round 2, starting with their first show right here in Bengaluru. So what's different this time around? Let's go in and find out. When Papa Papa John's first came to India, they didn't quite take off and they cited underperformance when they exited the market here in 2017. But this time, they're back promising better ingredients, better pizza with a serious local twist. And the hype honestly smells delicious. Thank you so much for speaking to us here and for inviting us here for your launch. Let's start with why the comeback? Why now?
First of all, thank you for having me. See, India, the sheer size and scale and the dynamism of this market would mean no QSR would want to stay away, can stay away for long. So we always wanted to come back to India, but we had to be ready. Obviously, the brand had learned lessons from the last stint. So we wanted to get everything right. We took more than 2 years. Last 2 years were spent in research and development, in identifying best quality ingredients around the country, because we want the best. You have to go to where the best is made. And then we set about creating a menu that will appeal to the Indian consumer.
Okay, so what exactly do we have on the table here that you brought out from the kitchen?
Now, this is a global favorite.
Okay.
Called Super Papas. It's one of our Super Papas. Yeah, it's one of our largest selling pies around the world.
Okay.
And we know that the Indians would love this too. This has chicken pepperoni. It has chicken sausage. It also has chicken ham and a lots of fresh veggies. It's got green pepper, onion, tomato, and black olive.
Sounds like a loaded pizza.
It is a loaded pizza.
But this is your global favorite, you said, but how are you catering to the Indian palate? I mean, we like spice, we like heat. A lot of us are vegetarians too.
So we have created a special Bangalore-centric creation. It's called the ghee roast pizza.
A ghee roast pizza. Okay, that sounds like something.
Available in both chicken and paneer variants. The sauce is made using aromatic roasted spices in ghee.
Okay.
And every friend and family who has tried it, full marks.
Well, if I may ask, why Bangalore? Why was this the starting point? What is the relevance of the market here?
Bangalore, we all know, is the startup capital of India. Bangalore is also the tech hub of India. And Bangalore probably is more cosmopolitan than most cities in India, in that in Bangalore you would find people from all around India. So if you click in Bangalore, you're probably very likely to click everywhere.
Yeah, well, I read that you're going to start with 650 stores in a decade is the target. 4 stores here in Bangalore. What is the plan? In what phases will you expand? What cities will you go to next?
So today we're opening 4 restaurants on a single day. In December we add 3 more. And then next year we race ahead to 30 restaurants.
Okay.
And then there will be no stopping us. So the idea is to stay focused on Bangalore first.
Okay.
Validate our business model, and then go to Hyderabad, Chennai, Mumbai, Delhi, and so on.
Okay, but the focus is the southern region of India first?
In the beginning, because when we penetrate a market, we usually take the cluster approach. And so the southern triangle between Hyderabad, Bangalore, and Chennai has highest per capita pizza consumption.
Okay, speaking of highest per capita pizza consumption, we're sitting here in Indranagar, the hotspot of Bengaluru. Just down this road, you'll have many competitors, and I'm talking legacy, pizza chains, startups, cloud kitchens. What will make Papa John's stand out?
So our brand promise of better ingredients, better pizza has completely manifested itself in the menu and in our ingredients. So every ingredient is best in class. And the moment you try our pizza, your first bite will tell you, this is not QSR. It does not look like QSR. At the same time, our pricing is so competitive. It ranges from 149 rupees for a regular margarita to 799 rupees for our premium, all the meats.
So the price ranges 149 to 799.
Correct.
All the way up to 799. Well, I know I've been keeping you busy talking, but I had a bite of this and it is delicious. But, you know, let me ask you back to the lessons you learned. You know, when you exited in 2017, the market was underperforming for Papa John's. What makes you confident this time around it's going to be any different?
So while technically this is our re-entry into the market, but we are taking it very much as a fresh entry. We have taken this project very seriously and worked on we've ticked all the boxes. We are very confident what we have is going to work.
Saying that, it's not quick service, it's going to be a slow service here?
No, it is not at all. So it is going to be quick service, but I'm referring to the typical QSR mediocre pizzas that Bangaloreans are exposed to. I think there is something changing for them.
So Papa John's 2.0 is back in India, but the bigger question is, does the market have space for yet another pizza giant? Meanwhile, the ovens are hot, the stakes are higher, and the pizza slices still as cheesy.
On that note, it is time for us to head into a short break. But coming up next, 3 in 5 Indians are aiming to travel more in 2026. What are the key trends in India's travel market? Global travel app Skyscanner and its brand ambassador Surya Kumar Yadav decode. Stay tuned. Welcome back. You're still with us on Startup Street. 3 in 5 Indians are aiming to travel more in 2026. Global travel app Skyscanner and its brand ambassador Surya Kumar Yadav, the Asia Cup winning captain of the Indian cricket team, unveiled 7 key travel trends. My colleague Archana Solanki caught up with them for a super fun chat. Take a look.
This is the year where travelers are bringing in their personality, bringing in their identity. It's not just about where they're going, but why they're going. What we realized is that our travelers are really prioritizing hidden gems, and that's clearly shown through our top trending destinations. Right on top, we have Jorhat from Assam, which has kind of grown for 495% year on year. Of course, it's known for its rich Assamese heritage. It's known for its tea gardens. It's also known as a gateway to the largest river in the island in the world, Majuli. Then we also have Muscat, Oman, in number 3, which is known for its combination of Arabian culture and also modern living across seaside promenades. And at number 6, we have Varanasi. And that just shows that people are kind of embracing not just their touristy side, but also their spiritual side. People want to be part of the largest living city or the oldest living city in the world. And 120% of our searches have grown year on year for people visiting Varanasi. So we're seeing a very eclectic mix of destinations in our top 10 trending destinations, which our travelers going to travel in 2026.
Right. Sky, let's talk about your association with Sky Scanner. Was that deliberate? Tell us more about your association with this brand and your journey as a brand ambassador. And also, the names that Neil mentioned, pick your favorites from that list.
I think the association with the brand is special. Really happy to be a part of this wonderful family. And I think what I feel is this app makes the travel easy. Most important thing, it'll make your job easier if you want to book any travel destinations or go anywhere. And that's how the partnership goes a long way. And also, out of all the places which Neil mentioned, I feel these are lovely destinations. One of those is also my hometown, Varanasi.
Yes.
So I've been there a lot of times. But yes, I would love to go to places where there's no cricket. So definitely Jorhat, Jaffna. I think these are the 2 places I'll pick for now, and we'll definitely love to travel over there.
Lovely. Neil, Sky spoke about Jorhat and Jaffna, which have emerged as the top trending destinations, and you also mentioned about it. What makes these relatively lesser known places stand out for Indian travelers?
Yeah, I feel what we've seen is kind of like a trend all the way from COVID times. After COVID, there was a lot of revenge travel, and people wanted to really prioritize going to touristy destinations. Now, what we've seen in the coming year and the year ahead is that people are really prioritizing places which appeal to their sense of identity, who they are as people, what their philosophies are. And that's kind of led to more discovery, more authenticity, and people are kind of really prioritizing these hidden gems. These are one of the reasons why these offbeat places, which are not globally known yet, but hopefully will after the Sky Scanner Trend report, are getting more and more prominence for the Indian traveler.
Great. Sky, it's very interesting that you spoke about Varanasi and these beautiful places. I wanted to understand from you, with the kind of stardom and success you've seen, has your travel changed? Because now you're a well-traveled person, and we also talk about budget travel. Tell us about your journey. How do you travel these days, and as compared to how you used to travel earlier?
It's the same way. I mean, if you want to travel, as you know, we Indians, we love to travel a lot. So yes, it's still the same. Yeah, I haven't changed anything. Whenever I get an opportunity to go out, to have a vacation with family, we do travel, and it's become easier. As I said, my job has become very easier. You want to travel to any destination, or you want to book any holiday, hotels, everything. Don't have to worry.
Any favorite memory from your childhood of traveling with your family, or now with your wife? Any favorite things that you
childhood? See, we don't remember all when we were very, very young. We just loved traveling at that time. But yeah, now when we travel with family, when I travel with my wife, I think all those people, when we make good memories, I think those are the things which we remember.
Okay.
And we do love to travel in a group, but yeah, whenever we get time, I think me and my wife, we see that we do travel a lot.
India's $500 billion home loan market has a new challenger, and it's betting on AI experience and scale. The company has raised $170 million so far and aims to cross 12,000 crore rupees in AUM over the next 5 years. Three marquee investors, Gaza Capital, Lightspeed and Premji Invest, have joined hands to back People's Home Finance, led by industry veteran Anil Koturi. Here's a report by Rachna Dhanrajani.
For decades, home finance has catered mainly to salaried borrowers. But millions of India's self-employed, small traders, shopkeepers and micro-entrepreneurs remain outside the system. People's Home Finance wants to change that. The new platform, built through a buy and build model, is targeting India's informal economy using technology-led underwriting and AI-based credit assessment.
Home loan AUM in this country is about 40 lakh crore rupees. But however, the small self-employed customer who does not have income proof, that AUM is just shy of about 1 lakh crores. So which means less than 3% of the overall market is this kind of a customer. Now what happens is that because the finances are arrived at through a process of conversation, and the outcomes are dependent on the individual who converses with the potential borrower, they tend to vary. So if you have a technology support this, then the outcomes can be a little better and more predictable.
For investors like Premji Invest, the play is clear. Combine scale, capital discipline and advanced technology to transform traditional lending.
Starting small will probably prompt people to take certain undue risk and also pass on the inefficiencies in cost to the customers, and hence it can create a bad cycle, right? And that is one of the reasons why we thought the first advantage of capital we will get in along with our capital and Lightspeed and Gaza as investors in the cap table, so that we start big.
For Gaza Capital, the partnership marks a return to its roots in management buyouts, a model that empowers experienced professionals to turn entrepreneurs.
Now you have experienced management teams, and in certain sectors, backing experienced management teams makes a difference. There is now a growing M&A market in which you can buy assets. And it's frankly, it's one of the few parts of the entire venture capital private equity market where you have some purchasing power.
What we've done differently over here is we followed an M&A approach. What that M&A approach means is we didn't want to start batting at zero. We kind of want to start batting with a few runs on our leaderboard as already. So we've looked at these few assets which we spoke about. We're going to start with hopefully around 2,000 crores of AUM, with a lot more growth capital behind it as the platform is being put together. 100 plus branches, CXO team ready.
People Home Finance wants to rewrite the rules in a sector that has long been seen as low-tech, paper-heavy and full of conditions like salary slips. It expects this digital reboot to open the doors of home ownership for millions of India's self-employed, making People Home Finance the HDFC of affordable housing. In Mumbai, Rachna Dhanrajani.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Presented by Policy Bazaar.
CNBC TV80, the Policy Bazaar Insurance Show.
Imagine saving thousands of rupees every year on your insurance premium, and that without even changing your policy or reducing your coverage. That's the power that a tax component on insurance could bring. Specifically this time around, the GST component as far as insurance is concerned. Welcome to the Policy Bazaar Insurance Show. I'm your host Yash Jain, and in this episode we explore how GST relief can take away a lot of burden away from policyholders across India. And to break this down further, joining me on the show today are Sharad Mathur, Managing Director and CEO at Universal Sompo General Insurance Company, Mahesh Balasubramaniam, MD and CEO, Kotak Life Insurance, Saravir Singh, Joint Group CEO, PB Fintech. So we have a blend of the entire insurance ecosystem, of course, the distributor, life insurance company, as well as the general insurance company, which gives a fair bit of understanding as far as health insurance is concerned. Let's start with you, Sharad. What exactly was the government's announcement as far as GST on health insurance is concerned? Could you break down that for our viewers just to understand the basics and clear out the foundation for it?
The industry has been asking for it since quite some time, and it's a very welcome move. The whole concept revolves around customer affordability. And when government announced GST, we have been hearing that whether benefit would be passed on to customers or not. So in no way insurance industry, whether it is non-life insurance or life insurance or standalone health insurers, ever thought to have it in pricing adjustments. So it is for the customers, for the common man, and this would going to get passed to them. As a result, say if there was a 100 rupee premium, for example, so policy now would be reduced by 18%, say in case of individual health, PA, and accidental and travel insurance. So it would help us in achieving our end objective, which is insurance inclusion, reaching out to the last mile. We have seen that there are various government schemes for underprivileged communities and for affluent population, which are in urban, semi-urban state capitals. We have seen that affordability is not much of an issue and they are able to buy health insurance, so to say. But the middle group, we call them missing middle. I think affordability was one of the elements where we were seeing that there is not enough offtake willingly also. So now we have to work, industry would be collectively working on the reachability element. Affordability seems to be getting addressed with this GST got implemented on 22nd September. So it is a great benefit for the common man and would have insurance inclusion. And I think sooner, why we should await until 2047 as the government and regulatory goals are.
To you, Saravir, their cuts have been announced as far as GST is concerned on various aspects, and you deal with all those products, health insurance, term life insurance, ULIP, as well as endowment and annuity. In your understanding, how would these different categories benefit different kinds of users? What is the adaptability of these different products? Do you think that the benefits would be quite equally distributed amongst all these important products?
I think, yes, first, just to reiterate, I think what has been announced is that all individual life and health policies, there will be no GST, which means that for term and health insurance, there is an 18% reduction in the total outgo from a customer's perspective. In ULIP and endowment products, it's a little different. In ULIPs, the amounts involved are smaller and they are part of the product construct as well. In endowment and non-par policies, there's a 4.5% GST in the first year and 2.25 in the succeeding years. So that will be removed. So I think that is the context in terms of how much a customer will benefit. From our perspective, I think the most important thing is that protection products, right, which from a middle class perspective are the most important. I think for a middle class family, having term insurance, having health insurance are very, very critical. And both these products will enjoy the highest benefit of 18%. So what we expect is that, and in fact, what the early days are showing also, is that on the protection side, both term and health insurance, there is a very smart pickup in demand in September towards the end of the month. And this is something which we hope will continue going forward because I think this has been a long-standing demand of the industry, of consumers as well, that on such basic necessities of life, we should not have GST. So I think it's a really very, very big monumental move that the government has done. And I must tell you that even amongst countries around the world, this is one of a very, very, I would say, forward-looking step where a country has recognized that these basic forms of insurance are essential and should not be charged GST.
Very fair point. This has been a demand from the industry that GST shouldn't be so high as far as the basic necessity like insurance is concerned. But to come to you, Mahesh, we often have this discussion, but more often than not, it remains inconclusive. Was a tax cut or a GST cut in this situation the only trigger as far as making insurance affordable is concerned, or are there more elements to it which will have to be pushed together to make insurance affordable? We speak about the penetration, of course, that is very low as per global average, but do you think only making a lower tax or exempt tax on insurance the single solution to drive affordability and hence penetration?
First of all, as an industry, we laud the Prime Minister, the Finance Minister, and the GST Council for exempting individual life insurance products from GST. I think it's a landmark initiative, and it'll go a long way in increasing penetration in this country. Life insurance penetration is a paltry 2.8% of GDP. But what's more worrying, as Sarabveer pointed out, is a protection gap. Because real insurance is basically the term insurance that people take. The protection gap is as high as 80%, valued at about $16.5 trillion. The retail sum assured as a percentage of GDP, which is reflective of the extent of protection in the country, is less than 25%. Even neighboring countries in Southeast Asia are close to 100%. So obviously there's a long way to go. And there's a very significant step in that direction. But is that the only reason why the penetration was low? Obviously, the answer is no. And that is where the industry has been working towards building what we call now the AAA of insurance: awareness, accessibility, and affordability. This addresses the affordability portion. The accessibility and awareness is being worked on by the industry. If you see, I think across both LI and GI, a slew of campaigns have been going on from the LI Council and the GI Council in the last 1 or 2 months, where we are trying to make the awareness of insurance significantly go up. And accessibility, of course, through increased distribution network, increased online presence, etc. So all channels are being activated for increasing the accessibility as well. But AAA is what is required: awareness, affordability, and accessibility.
Okay. Sharad, to come to you, help us understand a GST exempt from earlier 18% with no input tax credit benefit, no inverted duty structure benefit. How does that impact the industry's revenue, profitability, financials as a whole?
What is coming out very clearly that the impact currently, commercial impact, would hover around 3 to 4%, which I do not think is so substantial as opposed to the upside, which is it would result into increasing penetration on population base that currently we still have about 35% population of on a base of 1.40 billion population, which has some or the other form of health insurance. So I believe if this results into solid uptick in gross revenues, premiums for the insurance companies. So the downside, which is loss of 3 to 4%, which would be charged to the revenue input tax credit, which insurers are not able to claim now, would going to fizzle out. So we are not seeing this transactional element as impact on the insurance sector, but the strategic upside, which is increase in revenue and enabling insurance sector to support in increasing the contribution to nation's GDP. We have at an industry level rolled out campaigns, and as individual insurers also we are doing a lot of promotion and creating awareness around. So this thing would going to uphold our initiatives which revolve around transactional as well as strategic as we go and bring the entire nation into social security ambit. Health insurance, life insurance are something in the most developed market. If I talk about health insurance, say Australia, for example, we have 70-80% population having health insurance. Or in not so, or say developing markets like Vietnam, also about 60-70 population has health insurance. So I think those are the things which we have started incorporating in our scenarios, and we are making 3 to 5 year projections and how we will use this, leverage this benefit which government has been kind enough to roll out for the common man, to make sure that now common man finds it easy to have coverage under health insurance.
Mahesh, just to follow up on what you said, given that from September 22nd, insurers won't be receiving any GST. So what happens, to the input tax credit that they were using so far? Will it be borne by the policyholders? If so, what could be the net benefit that policyholders might get as far as the GST changes and everything that it brings together with itself is concerned?
So there are input tax implications, I think, for the life insurance industry, and all of us have been doing our workings. And as an industry, we have understood the impact on the input tax credit, right? But right now, I think we need to look at the bigger picture. I think all of us unilaterally as an industry participants have all passed on the benefit of the prices to our customers, both on the fresh policies and the renewal policies. I think the big picture is we all need to support this initiative of the government in terms of increasing awareness and protection in this country. Along the way, I think some of these issues will be taken up. The industry is in dialogue with all its constituent stakeholders, and I think appropriate solutions will be found over a period of time. But right now, I think the most important thing is to make sure that the communication that now insurance is GST free is something that we need to communicate to the broader spectrum of the society, and the price benefits have all been passed on to all the customers across the board.
Saraveer, let me come to you and let me bring you a very specific scenario. Just to understand, suppose a policyholder buys a long-term policy, say a 5-year plan. This, let's say, assuming was bought in May 2025. Now, if GST relief is announced, which becomes effective September 22nd, how will the tax on that particular product be calculated? Will GST apply on a pro rata basis for the period from May to September, or will it be charged on the entire first year upfront? How would the math behind this in a situation of a long-term policy be applicable?
I think the fact of the matter is that it all depends on how you're paying for the policy. If you've already paid an annual premium, then for the first year, you've already paid GST, and that is over and done with. If you are paying with on a monthly or quarterly basis, as your payments come due, at that moment, post September 22nd, no more GST will be charged. So just as an example, supposing you pay every month, so when your installment for October will come due, let's say it's on the 5th of every month, on 5th October, you will not have to pay GST. So it's fairly straightforward. Till September 21st, there was GST. After September 21st, there is no more GST, and all payments will not include any of the GST charge.
Thank you so much, Saraveer. But on that note, let's take a very short break. We continue the discussion on the other side of this very short break. A few more important clarifications, a few more points of understanding lined up on the other side of this break.
CNBC TV 80, the Policy Bazaar Insurance Show. CNBC TV 80, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. And, on this particular episode, we are exploring the most important development that would have happened in the insurance sector, the changes with respect to GST, the relief which those changes bring as far as policyholders across the country are concerned. Sharad, let me start the second segment with you. Also, and just to understand this thing better, if a policy had to be renewed, let's say before September 22nd, which is before the GST changes became applicable, and the policyholder did not renew it using the grace period for renewal, let's say he postpones the renewal by a month, will they be able to avail the GST relief in that situation?
Yeah, so if policy start date is beyond 22nd September, so then they will going to get the GST benefit. And there are quite a few cases we have seen that people had put their renewal on hold, and we supported them, and they got renewed very recently in the current week, and they got GST benefit. Because it's very simple, any policy being issued, renewal on 22nd September and beyond 22nd September, so they will be eligible for GST benefit.
Okay. Saraveer, to you, what happens, to group policies purchased by, let's say, a particular corporate for its employees? Will the GST benefit automatically flow through into those individual members also? Or does that remain out of the ambit as far as the GST exempt category is concerned?
Yes, so the rule is very, very clear. It is only for individual policies bought by individuals where this rule applies. For group policies, whether there are various kinds of group policies, including the health example that you gave. In that case, the GST will continue as it is at 18%. So I think that there should be absolute clarity on this. It's for individual life and health policies. Group policies continue as they were earlier.
Mahesh, to come to you, do you see insurers using GST reduction as an important opportunity to rather innovate with low-ticket mass market products, or will the savings simply make the existing insurance policies cheaper? Which way do you see insurers going largely?
Well, I see dual impact, Ayash. First and foremost, India is both an uninsured country and an underinsured country, right? The way I see it is that an 18% reduction can translate in two ways. It can bring in new people who are hitherto not insured to the fold of insurance because they'll find it cheaper. The existing customers can upgrade their cover now because India is also a large underinsured country, right? So both the phenomenon, I see that certainly playing out. But having said that, I think the mass market innovations continue. I think even before the GST era, I think many of us experimented with mass market innovations, sachet-sized products, etc. There, I think the environment needs to be a little bit strengthened in terms of the data flowing through. I think the biggest problem insurers face when they try to do mass market policies is the element of frauds which creep in. Because these are masked underwritten policies where it's pre-underwritten, etc. So therefore, it's light on underwriting, which also means that it exposes the risk for the insurers. So I think these experiments continue, innovations will continue. In fact, last 3-4 years have been a great period for life insurance industry. And Sarbir will corroborate that because he also sells most of these products on the platform, whether it is annuity, whether it is return of premium on term, whether it is ULIP blended with term insurance. I think a lot of innovations are happening. And this will only probably hasten the innovations because affordability goes up, which means any product we put out there, we'll be able to address a larger population than what we did in the past. No? So I think it's a continuous exercise, and this is only going to energize the innovation stream. Having said that, I think all of us continue to innovate across the various platforms available in the life insurance industry.
With that, we've almost come to the end of this discussion, but one final question as far as all three of our esteemed guests are concerned. And this question relates to the larger goal of insurance for all by 2047. The question is that GST relief is certainly a first step towards achieving that aspirational goal of insurance for all by 2047. What more can be expected and should be done by the government and the regulator? If I could have one suggestion from all our guests, starting with Sharad, what is that one thing that you would want the government and the regulator to look at and do? Because there is this intent from the government, and hence we have the GST changes also coming through. There's a new chairman at the regulatory body, so can't be a better time to understand this thing. With you, Sharad, starting one suggestion.
So with GST exemption, which in itself is a big move, we need trust and transparency to be enhanced amongst all our existing customers or potential customers, those who have not bought insurance yet. And as we want to achieve insurance inclusion, it becomes all the more necessity to have all service providers, all health entities in the insurance ecosystem, in overall health ecosystem. So the point I'm trying to make is health hospitals, if can also be brought under regulations, only to ensure that there is enough transparency and its standardization of rates for various procedures will going to create a lot of comfort for people, those who have not yet bought health insurance. So affordability plus enough transparency, visibility to how all health service providers ranging from hospitals or insurance companies, diagnostic centers, wellness service providers. So all under one ambit would going to make a big difference. And also to begin with, the National Health Claims Exchange, a government initiative, if we can also have hospitals there. So that itself will going to be a big initial move to support the two elements of trust and transparency.
Mahesh, to you with the same question.
I think I would probably answer this in two parts. One is what I call triple B of insurance, which is Bima Sugam, Bima Vahak, and Bima Vistar. I think we need better execution, faster execution of all three initiatives that will probably aid in the awareness, affordability, and accessibility. The second is use of data. I think across life, health, motor, non-life, etc. I think if we can all put together a very robust ecosystem of data, I think we'll be able to underwrite better quality, and we'll be able to reduce the instance of fraudulent claims, which can all translate to better pricing and better insurance penetration in this country. So I would say data and triple B execution is what I would say are the critical levers going forward.
Saravir, finally, one suggestion coming in from the entity which does a great job at distribution, managing, of course, the regulations on both health and life side. What will be your suggestion?
I think, yes, we are the voice of the consumer. I think the voice of the consumer is very clear. Insurance is a very, very important part of social security in India because I think consumers need it. They want simplicity. I think there has to be simplicity in terms of what is the contract, what am I paying for, and how much will I get when I need to make a claim. So I think whatever we can do, and I think it's not just on the regulator and the government. I would say that both the regulator and the government have done their part. And I think now it's incumbent upon the industry, participants, all of us, to make sure that we communicate this message very clearly that, look, this is what the industry is doing. These are the number of claims that are being paid out. These are the instances where things have not gone well, so that, again, there is full transparency on that. And I think the more we can simplify the product at heart is a very simple product. You pay premium, you will get a claim. But we have complicated it needlessly sometimes. And if we can simplify it, I think customers will buy this themselves. I think the era of insurance being sold should change to the insurance being bought. And I hope that it will happen very soon.
Well, very well said. The era of insurance sold should come to an end, and that should be replaced by insurance being bought. But on that very positive note, that's all we have as far as this special edition of the Policy Bazaar show is concerned. We will see you soon with a new topic, with a new set of guests. But until then, it's time to say goodbye and take good care of yourself. Stay safe, stay insured.
CNBC TV 80, the Policy Bazaar Insurance Show.
Welcome to Indianomics. The Reserve Bank is proposing to liberalize rules governing financing mergers and acquisitions. Currently, companies don't get bank loans, nor can they raise foreign loans to do acquisitions. These restrictions are going to end soon. Companies will soon be allowed to tap bank loans and foreign loans to finance acquisition, but there's more. Foreign loans can also be used to buy real estate, purchase and development. That's not allowed now. Also, banks can lend more against REITs, units of REITs and InvITs, and also without any limit, they can lend against debt securities, listed debt. Companies can also raise much short-term foreign loans. Originally, it was 5 to 10 years. Now, ECBs can be raised for 3 years. What's the impact of all these huge changes? Will there be a flood of M&As, especially in industries like, say, cement, textiles, where there's fragmented capacity? Will dollars flow into Indian real estate, make real estate expensive for Indians? And will dollars flow in per se? Today on Indianomics, I have 3 experts to discuss these. Renuka Ramnath, founder and CEO at Multiples, Srinesh Srinivasan, Managing Director at Kotak Alternative Asset Managers, and Rahul Saraf, India Head of Investment Banking at Citi. Gentlemen and Renuka, thank you very much indeed for your time. Renuka, starting with you, since you have spearheaded so many companies into the market, is there going to be a spate of M&As?
No, I would look at it as a reform which will have extremely positive long-term impact. Nothing can change overnight. What India needs is enormous debt coming in for the kind of growth that we have planned. CRISIL has estimated about 120 lakh crore debt that corporate India need in the next 5 to 7 years. So this reform will really play into that need extremely effectively. The other thing is that large corporates in India denied access to global capital on an even platform like their global peers, right? We are building companies here in India of global scale, global relevance, competing in the global market.
No, we could raise for raising capacity, but they could not raise to buy someone else's capacity.
Yeah, but there were other restrictions on the borrowing. It was not a level playing field. So I find the reform in the ECB guidelines extremely comprehensive. So it helps large corporates to get into a level playing field, and it helps small corporates to borrow now for M&A activity. Okay. Third, I think we should remember that in India, we had no mechanism to unlock the amount of value that is sitting in equity. Today, there is roughly $7 trillion by value between listed and unlisted put together of equity. We still have, India is a very fragmented market. You know, if you look at average market cap per company, we are at billion, and the next highest is China at 2 billion and US at 15 billion. Okay. So we are an extremely fragmented corporate, which brings with it a lot of inefficiency, and especially in the going forward global situation, these companies cannot compete and survive. So M&A consolidation is a must rather than a desire for us to go to that growth, keep the jobs, and move progressively rather than see a demise of a lot of companies around us. And I think this reform will definitely hugely facilitate it.
Certainly, huge financial muscle given to corporates, or at least when the rules are finalized. Srini, your first thoughts on the ECB rules, but I also wanted to know about real estate. That was a sacred cow because land becomes expensive for an Indian buyer. Do you see money rushing in? Because it's I would think, a very lucrative business.
First of all, if you look at the entire package that RBI has put out for the banking industry as well as M&A financing, the summary that you mentioned, I am most excited about it. And as we were discussing just before the show, this is the 1992 moment for the credit markets in India. 1992 was when foreign investors were permitted into the equity markets.
It was the equity moment.
Right. So in one stroke, RBI has opened up ECBs in terms of what is the end use that you can use it for, in terms of the pricing that you can price it is linked to market conditions, and most importantly, in terms of who can actually provide ECB loans. If you look at the draft of what they have put out, it could be anybody who can provide an ECB loan.
Earlier, like it was my uncle living abroad can give it.
Exactly.
It says any resident abroad.
Any resident abroad can provide an ECB loan. So this is a great moment for ghar wapasi of all our dollars.
Okay. Yeah, especially since it shows more growth.
Absolutely. But what it also does for the banking industry, and I think as far as the banks are concerned in India, they've done two things. They have unleashed the banks in terms of the kind of reforms that they can operate as a conglomerate. And I think many banks which operate as conglomerates in multiple facets of financial services will find it so much easier to do business.
Yeah, overlapping rule restriction is gone.
That is one. Secondly, they've also, kindled the animal spirits of the banks which have an overseas presence, because the ECB regulation provide the overseas branches of banks also to participate in this whole financing market. And if, as Renuka said, if M&A financing is going to be a big play and which grabbed the headlines, M&A financing can be done by domestic banks, both rupee and foreign currency. It is a very interesting play of, what could potentially play out with regard to the credit markets.
We don't know that BOB has one of the largest number of foreign branches.
Exactly.
special partner, Nuvama. Let's do it right.
Gold and silver are glittering again, not just as ornaments, but as serious investment opportunities, with prices surging and global uncertainties adding shine to these metals. But the big question is this rally just getting started? And how can investors participate smartly in this rally via the mutual fund way? Welcome to the special edition of Mutual Fund Corner. And on that note, let's welcome Nilesh Shah, Managing Director at Kotak Mahindra AMC, to understand everything about this gold rally, the precious metals rally that we are seeing, and his insights on that as well. Nilesh, always a pleasure speaking with you. Thank you so much for joining us today on this special occasion. And you know, all we can talk about apart from equity markets now is the rally that we are seeing in gold and silver prices. There are a lot of things that are happening. What can you pin down in terms of reasons why we are seeing this rally in gold and silver prices that investors should be aware of, because there is increasing interest that's coming by in this asset class?
So there's only one thing which is happening in gold market apart from what was happening before: the central bank buying. Global central banks, post their experience of Russia-Ukraine, where Russian $500 billion FX reserves were seized by Western world, and that prompted every central bank about safekeeping of their reserves. The gold which was lying with Russian central bank remained in their custody. This prompted everyone to shift part of their allocation from securities into gold. If we see Western world central banks, 60 to 70% of their FX reserves in US Fed, in Germany, in Switzerland is in gold. The Eastern world, Japan, India, China, their allocation is about 10%. Now, Eastern world central banks have to increase their allocation to gold, and some have even started dabbling in silver. So it is the central bank buying over last couple of years, from 2022 especially, which has resulted into this kind of price movement.
Okay, so you know, usually when people talk about gold, it is not the main portfolio when they look at it, because it's usually the satellite side of things. When we look at gold, they say, okay, if some amount is left, we should look at investing in gold. What do you suggest the allocation to gold or silver be in someone's portfolio? And while we talk about other asset classes like Bitcoin, people say there's no underlying. If people are buying it, that's why it is surging or going down. What explains the move apart from central bank buying? I'm talking about a novice investor who doesn't know what is the underlying for gold.
So even we don't know what is the underlying for gold or silver. There's no dividend, there's no bonus, there's no cash flow, there's no fundamental things to value gold or silver. They are store of value because of thousands of years of history. They are internationally tradable because everyone believes in that history and storage of value. This creates unique characteristics for gold and silver. And the reserves of Russian central bank, which were seized by Western world, that has acted as a catalyst for gold and silver price up move. Gold moved first because central banks were buying gold. Silver has now started moving, partly backed on industrial demand and partly backed on central bank buying. So please be aware that both these assets, despite their sharp run-up, despite their long history, should be a limited percentage of your portfolio. These are assets where there is no fundamental value, or there is no way to determine fundamental value. It's always in the belief that someone else will buy it from you at a higher price. So do invest in gold and silver, but being aware that these are the assets which are difficult to value fundamentally, and hence should be a limited part of your portfolio. Is it 5, 10, 15? That depends upon your risk appetite, that depends upon your time horizon.
Totally take that point. So now that you're saying people buy it because they think they'll sell it at a higher price going forward, but it has already run up so much. Now there is a fear as well, what if I buy and the price goes down? So do you think we are in the early stages of a multi-year uptrend in gold prices? How sustainable is this up move that we are looking at right now?
So I 100% believe that commodity prices fluctuate. If they have gone up, they will come down also. And when there is a sharp run-up like this, the correction also will be there. You have to observe two things. One, the central bank intervention. As long as global central banks behave like Indian housewife, buying gold and not selling, you can be sure that gold prices will remain in uptrend. Does it mean that every day it will go up? Answer is absolutely no. We became bullish gold somewhere in 2020, post-COVID. At that point of time, the mining cost of gold was reasonably close to the market price of gold. And hence we thought that the jewelry demand will ensure that gold prices move further up. 2022, we became super bullish on gold once Russian central bank's reserves were seized. Today, do we have similar confidence? Answer is no. We have to wait and watch at what level, up to what level central bank will keep on buying. In the past, central banks have become net seller of gold also. There was a time when gold prices, if I remember correctly, touched $800, and then it corrected 75% to about $200.
Wow.
This was all driven by frenzy getting cancelled and central bank turning sellers because they thought this appreciation was too much. So do remember that gold prices have corrected in dollar terms by large percentage.
That's a big cut, actually. That's the news for me as well. Since the time I've started tracking, it's always been in that $1,000 mark, and that's a very important point as well. So this is about gold. We are seeing a lot of interest coming in from central banks. Silver, you said, of course, there's industrial use, and that is the theory that we saw during COVID as well, right? There'll be increased industrial use, new energy that we are looking at in terms of transition. For now, is it a catch-up that we are seeing in silver prices, or do you think this is also a rally which could continue? Of course, there'll be fluctuations, but it is start of a structural up move for silver.
So in silver, at least in Indian context and in ETF context, I'll break it up. Undoubtedly, there is industrial demand from electric vehicle, from solar cells. There are also some central bank buying in silver. Gossip is that there is more inquiries about central bank buying. And then there is momentum which is built because gold-silver ratio moved too far in favor of silver. The frenzy has now reached Indian shore, where silver is in short supply, and it started trading at 10 to 12% premium to their international parity price. This is reflected even in silver ETF. When you buy silver ETF today, you are paying 10 to 12% premium to enter silver ETF. In many periods, 10 to 12% was a return of silver over 1 to 2 years.
True.
So you are, in some sense, paying that kind of premium to just enter into silver trade.
Say somebody who's starting right now, somebody who's very young, wants to start investing gold. What is the best way to go about investing in gold and silver? What do you suggest?
So one, be aware of the risk. Central bank buying, industrial demand supply. Second, please don't expect the last year's return to come in next 1 year. There will be ups and downs, and the returns will not be comparable to last year. So if you are investing in precious metal, ensure that it is a reasonable percentage of your portfolio, not significant overweight, looking at the past performance. Whether it's 5, 10 or 15% depends upon your risk appetite. If you can do SIP in gold and silver, that is even better. You will buy something at higher price, you will buy something at a lower price, and you can continue to invest. The one thing which people should monitor, when lab-grown diamond came, natural diamond prices crashed. Could there be manufactured gold? Well, there are two possibilities. One experiment was in CERN where they converted lead into gold, few nanograms, few nanoseconds unstable. So that's not a serious concern. It will take years before we hear on them. But the second experimentation, as claimed by a startup in US, where they converted mercury to gold through nuclear fusion. Now that technology is probably going to happen faster. So keep a watch on that. Like lab-grown diamond crashed natural diamond prices, manufactured gold could impact natural gold prices.
Oh, Okay, yes. And you know, you spoke about nuclear fusion and that entire science being used. And India is looking at investing a lot there as well. So let's see if that is used domestically as well to do what the scientists are preferring to do with gold. It's a very interesting conversation. We have a lot more to catch up on as well, Nilesh, but we have to get into a quick commercial break. We'll come back and we'll now delve into how to take exposure into gold. Is it via ETFs? Is it via gold funds? Or physical buying is the best way to take exposure? But stay tuned for that conversation on the other side of the short break. Welcome back. You're still tuned into this special edition of MF Corner, where we are discussing everything in terms of moves that we are seeing on precious metals, gold and silver, stellar rally, and what is a better way to discuss this during the festive season on this special edition. Nilesh, we have discussed what are the reasons why gold and silver have gone up. But do you think between the two there is one of the precious metal which has more advantage? Do you think one will move better than the other?
So undoubtedly there has been ups and downs in silver-gold ratio. When central banks are buying gold aggressively, gold does well. When industrial demand is pushing the prices, silver does well. And both of them have fluctuated over the years. Directionally, they move in the same direction mostly, but there are fair amount of divergence.
Okay, so there's no real number that we can put to that as well, of course. That point is taken. For somebody taking exposure to gold, what is the better way? Is it gold ETF? Do you stick to our traditional way of looking at physical gold, or is it gold funds?
So when you're buying physical gold, you are taking the risk of higher transaction cost if you are buying in smaller denomination. We all buy gold on Akshay Tritiya, Dhanteras, Lakshmi Pujan, but the transaction costs are higher. Second, quality of gold. Now with hallmarking, those worries are behind. But if you're buying it in ornament form, there is making charges and there is some worry on quality. Third, if you buy physical gold or silver, you have to store. Silver is bulky, so storage will become a challenge. Many people put gold in their bank lockers. If there's some mishap over there, it's your responsibility and your cost. When you buy ETF, it's an online purchase. Second, the custodian keeps this gold and silver. They keep it in earthquake-proof structure. There are CCTV cameras, there's insurance on it. So protection and storage doesn't become your headache. It is managed by the fund. And most importantly, the transaction cost of trading in gold and silver ETF or fund of fund is far, far lower compared to buying physical gold or silver. So I will recommend, do consider gold, silver, ETF and fund of fund as part of your portfolio. There are many female who do SIP or Vishy with roadside jeweler. They give money for 11 months and then 12 months they get the ornament. Now, this has worked well for women over a period of time. But then there are also mishaps in this. Recently, Taurus, a jeweler, disappeared in Mira Road and a lot of people lost money. Some time back, Goodwin Jewelers had disappeared. When you are investing in ETF, fund of fund, you don't have to worry about such kind of mishaps. So if you want to consider SIP in gold and silver, this option also can be considered apart from your jeweler.
So, we of course are talking about the benefits of getting into ETF, but investing is a lot about behavior, and Indians are emotionally attached to the idea of buying physical gold. In fact, if I have a conversation with any elderly person in my family as well, they'll be like, you do not hold that asset. This is an asset which should be held. So just being a devil's advocate here, you're saying not entire exposure should be through physical. There could be a split between the two.
Absolutely. See, you won't be able to wear a statement of account of gold and silver ETF and go to the wedding. You will require ornament. But you can always have space for both in your portfolio.
Yes, so it's not entire no for physical gold. Of course, it is something that you can hold for your daily purposes or for festive purposes as well. But for investment, look at ETFs and fund of funds as well. Now, Kotak AMC also has both gold funds and silver funds. How do they work in terms of strategy? How are they different from the other ETFs or sovereign gold bonds? I know now the sovereign gold bond issuances are not coming in, but people are not warming so much to the idea of ETFs as well. How do you think we can tell them, or you can tell them, in terms of the benefits that ETFs have or the passive markets have when it comes to even investing in commodities?
So one, it's a convenient way. For buying physical gold, you have to go personally. There's digital gold available, but that's again not as popular as ETF. ETF is online. Storage and protection, you don't have to worry. And the transaction cost is lower. The only negative for ETF is that you can't wear like an ornament. but then we are not talking about making charges either. Many a times people have bought gold saying that jeweler will do the buyback. Now, please remember the amount of jewelry sold by him versus what liquidity he has. So there will be challenges on the liquidity also. Compared to that, in mutual fund, liquidity is reasonably better. So overall, it's lower cost, better convenience product. But certainly, both physical gold, silver, and ETFs will have part in your portfolio.
So, you know, with such funds where ETFs or gold funds which are tracking a commodity, the tracking error part becomes a thing that investors often ask about. So, if one is looking at a lot of ETFs, all gold ETFs, but provided by different AMCs, what is the best way to, you know, look at tracking error or take some investment in one of them?
So, what is tracking error? It's basically difference between the price movement and net asset value of ETF. That's primarily driven by transaction cost, expense ratio, and execution cost. Now, wherever tracking error is less, you could be reasonably sure that we are as close to the price as possible. So, lower tracking error as a thumb rule can be interpreted as a better managed ETF, which gives you exposure to underlying asset class. So, while evaluating fund, do consider size as well as tracking error.
So, you know, you have both silver and gold ETFs. You said you were first bullish in 2020, then all the more bullish in 2022. We've seen a massive rally already. What is the realistic return, internal returns that you have, you know, come across or thought of for these funds in the next 3 to 5 years? Again, I know it is not a number that you can put, but I think the main question is, do you think this asset class will continue to outperform going forward?
So their outperformance will be dependent upon two things. Central bank activity. Are they buyer? Up to what price? At what price they become seller? I have no doubt in my mind that if they become seller, prices will correct. If they stop buying, prices will correct. Prices will rise only up to that price at which central bank buying will be supporting. On silver, obviously, apart from industrial demand, we have to see what is this central bank activity. So central bank activity becomes a fulcrum around which gold and silver prices will move. The second thing is technology. The day manufactured gold appears, there will be adverse impact on gold prices.
Technology can be a bane or a boon for at least this asset class. Now that we are talking about so many factors that could happen or not happen, and that will impact commodity pricing. But if someone is looking at gold today, do you think they can play their investment thesis via gold or silver versus equity markets? Because markets are always subjective, so are investments.
So my recommendation is that please follow dharma of your asset allocation. Equity, there is fundamental value attached to it. Hence, it could be larger part of your portfolio. Gold, silver, crypto, there is no fundamental way to evaluate their worth. Hence, they should be smaller part of your portfolio. You could have everything in your portfolio. Equity, debt, real estate, precious metal, crypto. But it should be according to your risk appetite. Whenever price is correct, you should have ability to average. If you're only playing the momentum game, it may work in the short term, but over a period of time, it will create pain.
Okay, so, you know, I'm talking from a perspective of a long-term investor, not somebody who is playing just the momentum, as you said, or playing short-term gains. So in the long term, somebody who's looking at investing today, keeping it for 20 years, do you think gold could be, say, 25-30% of their portfolio?
So in order to be alive in long term, you have to survive the short term. When there are ups and downs, the long-term investor also ends up losing their patience. We had seen in COVID-20 where people who didn't need money also redeemed because markets were correcting. That was the worst mistake of their life. They converted their notional loss to real loss. So to me, asset allocation is the dharma which you have to follow every day. Just because I'm 20-year forward-looking investor doesn't mean that I can ignore asset allocation. Just because I'm long-term investor doesn't mean that I can ignore my risk assessment, my risk profile. Bet according to the risk you can take. And all gold, silver, does not have a fundamental way to evaluate, and hence it should be a reasonable percentage of your portfolio.
Nilesh, it's always a pleasure speaking with you and getting your insights on markets, on mutual funds, investments, and life in general as well. So wish you a very happy Diwali to you and everyone in your team as well. And with that, we'll do one thing. We'll take your leave on this edition of MF Corner, but do stay tuned. More news and updates are coming up next.
Special partner, Novama. Let's do it right. Presented by Nuvama. Let's do it right. Co-powered by C8 Cross Drive. Grip you can trust.
Good evening. Thanks for joining us on India Business Hour. I'm Shireen Bhan. The top stories that we're tracking for you this evening.
3, 2, 1.
It's a blockbuster debut for LG Electronics India. The stock lists at a 50% premium with a market cap of $13 billion. LG Electronics India is 40% more valuable than its South Korean parent. Google to invest $15 billion over 5 years in India to set up an artificial intelligence data center in Visakhapatnam. This will be the tech giant's largest AI hub outside of the US. China says it's ready to fight to the end even as trade tensions with the US escalate. Beijing also sanctions 5 US subsidiaries of a South Korean shipbuilder. US Treasury Secretary Scott Bessent tells the Financial Times that China wants to pull everyone else down, but tells Fox Business Network that the Xi-Trump meeting slated for later this month is still on track. The International Monetary Fund revises its FY26 growth projections for India by 20 basis points to 6.6%, cites a strong momentum in Q1, which more than offsets the impact of US tariffs, but revises global growth outlook downwards to 3.2% for 2025. The IMF also warns of global overexposure to artificial intelligence, says if the expected transformative productivity gains do not materialize, it could throw elevated tech and AI valuations for a loop. Adds that a bursting of the AI boom could rival the dot-com crash of the 2000s. Gold and silver recede from record highs, but the slip is short-lived. Gold prices hit a fresh record above $4,100